Yes, good afternoon, one and all. Online, is everything looking good? Yeah. Yes. Yes, happy afternoon, one and all. Okay, we'll wait. Today you will get early dinner, don't worry. Today we'll wind up a little lot earlier than yesterday, so don't worry. Yeah. No, everyone has their own concern, no? Okay. Yes, people, I think we will start off. Yes, happy afternoon, one and all. So today we'll be starting with the next session of our marathon, and we'll be taking up in the first session topic called investment decision. Okay, a big ticket topic. This and working capital management usually is considered to be a big ticket topic in our FM. So we'll be starting with this. The agenda is very simple. We'll finish this topic and then take a break. Resume and do one more topic and then data. Bye bye for today. Okay now. All right. Sir, investment decision. So what this topic is trying to assess is, sir, suppose we want to buy an asset. We want to buy it. Now, if you want to do any particular project, you need fixed assets for it. Now, if you want to buy an asset, these decisions, people, are not pretty straightforward. You'll have to take these decisions carefully. Like, just to give you an example, let's say one company, they want to buy a plant and machinery. They are a manufacturing company. To produce a goods, they need a help of a machinery. Let's say this machinery, sir, it can be purchased via two options. There are two options to purchase the asset. One, locally you can purchase by paying 8 crore rupees, and that local machinery will last for 8 years, and it can be used for 10 hours every day if you purchase it in India or locally itself. Or there is an option two, you can import the same machinery, let's say from Germany, for 9 crore Indian rupees. Useful life is still same 8 years only, but imported machinery you can use for 12 hours a day. Now this particular decision, it's straightforward? No. Company may want to choose option 1, or they may want to go for option number 2. So that means you need to use your mind and accordingly decide. So there must be some techniques or methods which helps in deciding all this. Yes. So that is what we're going to be studying in this particular topic called investment decisions. Whether should we buy this asset or not? Whether should we expand or not? Should we diversify or not? All that will get covered in this particular topic called investment decisions. Now in this topic, these sort of decisions, sir, to take this, there are certain techniques or there are certain methods that we call it as capital budgeting or capital budgeting techniques. So these are simply methods which helps you to decide whether should we go for option 1 machinery or option number 2 commissioning. Basically simple techniques. There are about 5 or 6 techniques. That's what we have to learn in this particular topic. That's all is the scope of this topic. Yes, people, everybody? All right. The reason why this capital budgeting technique is required is, one, sir, all these decisions will involve huge amount. Like here, 8 crore rupees is small amount or looks quite big. The amount of this investment decision risk, these sort of decisions will have a huge expenditure and they will have an impact on a long period of time. See, once you buy a machinery, this machinery you have to use it for how many years? 8 years. So whatever decisions you take, you have to stick with it for 8 years. So that means it has an impact for short duration or long duration? Long duration. So before you blindly take the decision, you need to do a careful analysis. Hence, this particular technique becomes a necessity. Okay, sir? Alright. Now, sir, Normally we take the decision based on profits. Normally we take our decisions based on profit. But capital budgeting techniques, no, they don't worry about profits. They do the decisions based on cash flows. Here the decision is taken with the help of cash flows. And in majority of our problems, cash flows data will not be given. Cash flow we need to estimate or we need to find out. That is one of the crux of capital budgeting techniques. In some problem, cash flow will be given to you directly, so that becomes a very straightforward question. Some problems they will not give cash flows, and this is what we're going to do. I have picked up some few questions where we'll be doing from the beginning till the end, but I'll give you a quick overview now for the time being. So we need what for these sort of decisions? Profit or cash flows? Cash flows, and cash flows will be given, or we may have to estimate. We may have to estimate. Now, what usually they will give you in these sort of problem is they will give you sales. They will give you sales. They will give you sales data and some income expense data. We don't need sales income expense. We need what? Cash flow. Finally, how much is the cash flow? So from sales, we need to find out cash flow. Tell me, you have done leverage topic yesterday. We have discussed from sales. If you reduce variable cost, you will get a contribution. From contribution, if you reduce fixed operating cost, you will get EBIT. From EBIT, if you reduce tax, you will get EBT. Then if you reduce tax, you're going to get earnings after tax. So till here, it's the same drama. Okay, they will give you sales. First arrive at what? Earnings after tax, or also known as profit after tax. Sometimes it is also known as net profit. One and the same. Comfortable, sir? Now this supposes 1 lakh rupees. Do we need this for our in capital budgeting techniques? No, because this is what? This is profit. We need what? Cash flow. Now from this, we need to arrive at cash flow. You are able to see here this number. From here, we need to arrive at this number. How do we get that? Very simple. Now, profit will consider all expenditure. Profit will consider all expenditure, whether it is cash expenditure or non-cash. Everything will be considered. One example is depreciation. Is depreciation a cash expenditure or non-cash? Like salary, 1 lakh rupees is there. Will the company pay 1 lakh rupees salary to the employee? Yes. That means will there be cash outflow? Yes. When I say cash, I mean cash in hand as well as cash at bank. Will there be a cash outflow due to salary? Yes. Suppose company charged 1 lakh rupees depreciation. Will 1 lakh rupees go out of company bank balance or cash balance, or it's a non-cash expenditure? Non-cash. But you already reduced. Because how do you get profit after tax? After reducing all the expenditure. Yes, for the purpose of tax, for the purpose of calculating tax, you have to reduce all the expenditure. But now from profit after tax, we need to derive what? Cash flow. So the first adjustment you do is you add back depreciation. For the purpose of tax, we reduce depreciation because that's an expenditure which is allowed for tax purpose. But due to depreciation, did cash go out? No. Hence what to do? Add back depreciation. That was one such adjustment. Other than this, in my regular class, I used to say, do not forget to consider 4 things. Other than depreciation, usually 4 things as a checkpoint I used to tell you. Anybody remembers that? One is the salvage value. Another one is your working capital. Once I'll quickly tell so that the regular class students can comprehend better. One is salvage value. Another one is working capital. Then is your opportunity cost. Another one is your additional cash flow item. This 4 items, no sir, it may be there in all problem. It may not be there in all problem. Maybe only one component will come, or maybe all the 4 will come. It varies from problem to problem. But what I have constructed here is a format. So I brought in everything. Is this okay with you? All this should be considered. Now all this I will explain to you in problem one by one. Okay, now don't have to worry. I'm just giving you a summary. All this we'll have to do some adjustment, maybe plus or maybe minus, depending on the data given to you in the question. Once you do after depreciation 4 adjustments if you consider, then finally you will get what, sir? Annual cash inflows. You will get from profit, you will get what? Cash flows. But all this cash flows, no, you will not get immediately, you will get in the future. Because now here, if you buy the asset, today only you will get the benefit, or you will get benefit over 8 years. You will get benefit over 8 years. That means the cash flow that you have arrived over here is a present value of cash flows or future value of cash flows? Future value of cash flows. But are you doing the decision in future or today? Are you deciding tomorrow or today? Today. That means can we decide based on future value, or we need present value? We need present value. So take the future cash flows, whatever you got. From that future cash flow, arrive what's the present value of cash flows. From future value, how do we get present value? Multiply by the discount factor, you will get present value. Alright. Using present value of cash flows, we find out usually NPV. You will use some techniques. The most common techniques we use here is the NPV. How do you get NPV? Present value of cash inflow minus present value of cash outflow. All these are present value of cash inflows. From that, reduce present value of cash outflow. If NPV is positive, go ahead and accept the decision. Otherwise, reject the proposal. That's all. This is simple perspective. Understood, everybody? That's just an overview. Don't have to worry. I'll take you a couple of questions where we will work from sales until the bottommost number. Done, are people? Yes. So again, just to sum it up, for all these decisions, we need a profit or we need cash flows. Cash flows. But what will they give in the problem? They will get sales or expense and all. So what we have to do? Do your normal activity and arrive what? Profit after tax. From profit after tax, 5 adjustments you'll have to do. First is add back depreciation because it's a non-cash expenditure. Then if you have any salvage value, you have to consider that. If you have any working capital, consider that. Consider opportunity cost and consider any additional cash flows given to you in the question. By doing this, you will get future annual cash flows. Multiply discount factor to get the present value of cash flows and take the decision. A summary. Fine, people? Now, alright. Now, this is the overview of things. Now, we will dive into some techniques one by one of capital budgeting techniques. Alright. Sir, you have September 24 book. Can I use the same? September. I've made some changes in my latest batch. So, it would be preferable if you can have the latest batch book, if possible. Alright. Alright, great. Now, moving along. Now, first technique of capital budgeting we are discussing is payback period. Payback period. Name itself is saying paying back period. Payback period is simply trying to calculate in how many months or in how many years you will recover your initial investment. Now, to buy a machinery here, how much you spent? 8 crore rupees. Yes, now suppose you wait for option 1. In option number 1, what is the value of the assets, sir? 8 crore rupees. You are investing 8 crore today. Payback period is trying to calculate in how many years company can recover 8 crore rupees. Basically, 8 crore rupees is your II as an initial investment. In how many months or in how many years you will recover your initial investment, that only payback period is trying to calculate. Easy? Okay. Now, before you calculate payback period, let's understand payback period with the help of a small example. Let's say initial investment is 12 lakh. I purchased an asset worth how much? 12 lakh rupees. By using an asset, I'll get some benefit. Sir, every year, let's say my annual cash flow, net cash flow is 3 lakh rupees. From this asset, how much benefit every year I'm getting? 3 lakh. That means in how many years I will recover my initial investment? I've spent 12 lakh now. Every year my net cash flow is how much? 3 lakh. So in how many years can I recover this 12 lakh? 4 years. How did you calculate that 4? 12 lakh divided by 3 lakh. Express that in formula for me in words. So payback period is given by initial investment divided by annual net cash flow. Correct. That's what I've written over here. Fine now, people. Okay. So you can do this only if annual net cash flow is a constant. Constant means annual net cash flow what you're getting is same every year. If annual net cash flow what you're getting from using the asset, if it is same every year, then payback period is given by the formula initial investment divided by annual net cash flow. That's what we did over here because every year ka cash flow was same. But is it mandatory every year cash inflow has to be same or it could vary? It could vary. If it changes, what to do? So if it changes, you can't use this formula. We have to adopt something called cumulative approach. We have to follow something called a cumulative approach. How this works? Simple, same example. I'll take it forward. Let's say initial investment is still 12 lakh only. But by using the asset now, I'll get the benefit. First year 1 lakh, second year 2 lakh, third year 4, fourth year 5 and 6. I've assumed. That means cash flow, net cash flow every year is same or changing? Changing. Now what you have to do is you have to find something called cumulative cash flows. Cumulative means English definition. Cumulative means what? Cumulate means accumulating. Accumulating simply means adding up. Simply adding up. So first year do you have anything to add up or only one number? One number. So first year cumulative cash flow will be 1 lakh. Second year how much cash flow you got? 2 lakh. First year already how much you got? 1 lakh. That means what is cumulative cash flow? From the beginning how much have you got now? First year you got 1. Now second year you got 2. So totally how much you got? 3 lakh rupees. Third year how much did you get? 4. So 3 lakh plus 4 lakh you do. How much you going to get? 7 lakh. Now 7 lakh plus 5 lakh you do. How much you going to get? 12 lakh. 12 lakh plus 6 lakh how much? 8 lakh. That's how you calculate cumulative cash flows. Easy. But concept of payback period is still same. In how many months or in how many years you will recover your initial investment. What is the initial investment? 12 lakh. So look for this 12 lakh number here. Which year is having 12 lakh? 4. Therefore, payback period is how many years? 4 years. As simple as that. So if net cash flow is same every year, you can use this formula. If it is not same every year, you have to use cumulative cash flow and figure it out. Comfortable? Okay. So suppose initial investment is, let's say, 14 lakh rupees. Suppose initial investment is 14 lakh rupees. Now check, is any cumulative cash flow having a number of 14? In this case, what to do? Now you have to identify the range. Possible that the scenario also can come. Is 14 lakh available anywhere here? No. But just check. 14 lakh comes between what year to what year? Up to 4th year, how much you have earned? 12 lakh. Up to 5th year, how much you have earned? 18 lakh. That means, can I say 14 lakh investment lies between year 4 to year 5? That 14 lakh, this 14 lakh is lying somewhere between 4 to 5. Now, how do you do payback period in this cases? It's lying between 4 to 5. No, take the lower number. What is the lower number? Lower year? 4. Plus, if you want it as formula, I've showed you multiple ways. Maybe we'll stick to formula. You'll get the answer faster. 4 plus required cash flow divided by actual cash flow. 4 plus, why 4? Because the lower number is what? 4. Plus what? Required cash flow divided by actual cash flow. What is required cash flow? So up to 4th year, how much we have? 12 lakh. How much we need? 14. Up to 4th year, how much you have recovered? 12. We need how much? 14. That means how much more cash flow you need? 2 lakh more. That's what we mean by required cash flow. Required cash flow is basically 14 lakh minus 2 lakh or 12 lakh, which is 2 lakh. Comfortable? Divided by what? Actual cash flow. In the 5th year, how much cash flow is actually earned? 6 lakh rupees. So do that number. Comfortable? By doing that, you will get something called 4.33. That is your payback period. Easy, everybody. That's all is the payback period for all the 3 scenarios. Any case, they can test an exam if they are asked. One, they can make annual cash flow constant, or they can make it different, but cumulative cash flow number will tie out exactly with initial investment. Or third case will be cumulative cash flow number will not agree with initial investment. You'll have to find it out like this. Everybody understood this, Paka? Okay, that's your payback period. Can I go for the next one? This is one such technique. So this technique only covers what, sir? In how many months or in how many years you will recover your initial investment. After you recover your initial investment, this technique does not worry. That's all is the scope of this particular technique. Okay, Saru? Okay. Next is payback reciprocal. Payback reciprocal is not really a technique. It is just an extension of payback period. Just an extension. Now, name itself is saying payback reciprocal. Reciprocal means something ulta. So, payback reciprocal is ulta of what? Payback period. That means payback reciprocal ka formula is what? 1 divided by PP. PP as in payback period. If your payback period is, let's say, 4 years. If payback period is, let's say, 4 years, then how do you get payback reciprocal? 1 divided by 4, which is 0.25. Okay, now people, that's how you calculate payback reciprocal. So why do we calculate payback reciprocal? Sir, some people have done a study, and as per that study, the outcome is payback reciprocal. Sir, payback reciprocal will be approximating to IRR. Have you heard of this IRR? What is IRR? Internal rate of return. This payback reciprocal now will be more or less equal to IRR. If life of the project is at least equal to twice of the payback period. If the project ka total life, if it is twice of the payback period, then the payback reciprocal and IRR will be almost the same. So this is, you could say, one shortcut way of finding the IRR. This payback reciprocal. What does this mean? Life of the project is twice of the payback period. How much is payback period here? 4. What is twice of that? 2 into 4 is how much? 8. So if the project ka life, here project was machinery, that project could be machinery, it could be whole project, whatever. If machinery ka life is 8 years or more, if machinery ka life is 8 years or more, then 25%, 0.25 itself becomes your IRR as per some study. Is it okay? Sir, can we follow this for exam? Don't. When they ask you to do IRR in the normal way. Only they ask you to calculate payback reciprocal, calculate like this. Okay? But this is why, one of the reasons why they calculate the payback reciprocal. Usually payback reciprocal, we have seen, come as a 2-marker theory question. Explain payback reciprocal. You may have to write 2 to 3 pointers. That I've seen a couple of times coming in the examination. Any problem so far, anybody? All good? So we have discussed only 2 techniques. In fact, second is not a technique, it is just an extension. First we discussed payback period. Another one? Payback reciprocal. I'll discuss 3-4 techniques. Then I'll take up one question which has all the techniques. We will arrive through the numbers. That's the way we will do. Is that okay with you? Okay. Next is ARR. ARR as in accounting rate of return, or also known as average rate of return, or also known as book return or book rate of return also we call it. The multiple names, meaning is pretty much the same. Okay. Alright. Sir, one second. Usually capital budgeting techniques use profit or they use cash flow. Majority of the capital budgeting techniques use cash flow. But there is one technique of capital budgeting which uses profit. That is your ARR. ARR does not use cash flow because ARR is accounting rate of return. In accounts, we show cash flow or we show profit. So using accounting value, we take some decision. That is what accounting rate of return. For accounting rate of return, we don't need cash flow. We need to take the help of profit. Comfortable, sir? There are multiple ways you can calculate IRR. You can form ARR. Both the ways are acceptable in examination. I'll tell you. First way to calculate ARR is take average profit after tax, average PAT, divided by denominator could either be initial investment or average investment. So average PAT divided by average investment or initial investment, if you do, you will get something called accounting rate of return. Okay, people, it's a very simple adjustment. Sir, if you want to earn a return means you need investment. If you want to earn return means we need to have investment. Suppose we invested 10 lakh rupees. We invested how much? 10 lakh rupees. We earned, let's say, profit of 1 lakh rupees. Can you tell me how much is the return? We invested 10 lakh and we earned a profit of 1 lakh. How much is the return? If you're confused, think about this way. How do you calculate GP? GP is also return, no? How do you calculate GP? GP divided by sales into 100. Here also same thing. You take, instead of GP, take PAT divided by sales. Here you're getting the return with the help of what? Investment. I mean 1 lakh divided by 10 lakh. Since we want it in percentage, we multiply by 100. So this is your ARR. That's all. That is what I've expressed as formula now. Tell me what is this 1 lakh? PAT. But they will not give you 1 year PAT. They will give you about 5 years ka, 6 years ka. So hence instead of PAT, we take what's the average PAT. Instead of PAT, it will be average PAT in the numerator divided by, directly you can take initial investment in the denominator. That is acceptable. Or you can also take, if you want, average investment. My preference is average investment because in numerator, what are you taking? Normal or average? Average. In numerator, if you are taking average, for better result, in denominator also you should take average. My preference is average, but study material accepts both. Initial investment also, average investment also. Easy now, people. Now, how do you calculate average PAT? Tell me, how do you calculate average PAT? If they give you 5 years profit, what do? All the 5 years ka profit divided by 5. If they give you 3 years profit, add all the 3 years profit divided by 3. Suppose in that 3 years, 1 year is a loss means profit means you will add. Any year loss means you will minus. Correct? That's how you find out average PAT. Easy. Any problem? No. Initial investment should we have to calculate or it will be given to us in the question? It will be given to us in the question. Average investment we need to calculate. Now, average investment you can calculate in a very straightforward way like this, which I have discussed in class. But our study material uses fancy formula. So let's present like that only in the examination. Okay. All right. So how do you get average investment? Is half of initial investment minus salvage value, close the bracket, add salvage value and add working capital. WC for working capital. In these sort of problem, working capital will not be given to you in the problem. If at all they give, add it. Why add it? I'll tell you in one or two problems later on for the time being. Okay, people. This is how our ICA calculates the average investment. Okay. It's very simple actually. Suppose you bought the asset for 10 lakh rupees, or let's say you bought the asset for 10 lakh rupees. Salvage value is, let's say, 1 lakh. Useful life is, let's say, 9 years. That means, tell me, sir, how much is depreciation every year? As per straight line method. How do you calculate depreciation? Original cost minus salvage value divided by life. How much are you going to get? 1 lakh is the depreciation every year. How many years you will use the asset for? 9 years. That means, can you tell me what is a depreciation for 9 years? For 1 year, it is 1 lakh. For 9 years, total will be 9 lakh. That means, can you tell me what is the closing balance of plant, or maybe 1 minute. What is the opening balance of plant and machinery? How much did you buy the asset for? How much did you buy the asset for? 10 lakh. What is the closing balance of plant and machinery? How do you get closing balance? You bought it for 10 lakh. How much did you depreciate the asset? 9 lakh. That means after depreciation, whatever balance is remaining, that only we call it as closing balance. I'm talking about closing balance of the asset at the end of which year? At the end of Nine years is useful life. Huh? So 9 years. How much will it be? 1 lakh. Comfortable. Huh? Now, sir, calculate. How do you get average of this? Tell me, how do you calculate average? Average is nothing but what's an opening balance plus closing balance divided by 2. So one simple way to calculate average investment is 10 lakh plus 1 lakh divided by 2. How much is that? 5.5. Yes, sir, people. That is what I've written in my chart book. Okay. Initial investment plus salvage value divided by 2. Because if you just check, closing balance of the asset is how much? 1 lakh. What is that 1 lakh? Salvage. So if you take opening balance, which is 10 lakh, plus if you do salvage value and divide by 2, automatically you will get average investment. But our study material doesn't like this approach. They give one fancy formula. Can we test that? What is that fancy formula? They will calculate average investment like this. Half of initial investment minus salvage value, close the bracket, add salvage value. If there is any working capital, add that. Most probably working capital will not be given to you in the question. If at all they get, add up. Okay. Half. Calculate, sir. How much is initial investment? 10 lakh. What is the salvage value? 1 lakh. So minus. Plus what? Salvage value. Plus working capital 0. Calculate this. 10 minus 1 is 1 lakh or 9 lakh. 9 lakh divided by 2 is 4.5 lakh. 4.5 lakh plus 1 lakh plus 0 is how much? 5.5 lakh. Answer is any which way? C. Okay now? But better to sync up with study material for the sake of examination. Okay, so that's the reason I said this is a formula. Done now, people? So now you know how to calculate PAT also. You know how to calculate average investment also. Any doubt till here? Sir, class 1 is removed when you re-upload. Yes, it will be re-uploaded again. Give us some time, another 2 days time. Yesterday's session also will be re-uploaded. Don't have to worry about that. Okay. Accounts marathon, you can refer to the existing one. For the January, we will not be doing any accounts marathon. Some RTP, MTP questions I will record and I will put it up. But existing marathon, you can refer for accounts. That is good enough for Jan exam. Now, coming to this component. Overall, this is okay. There is one more adjustment which usually can come in the examination, has come 1 or 2 times. What they do is, they will not give you every year ka profit. They will not give you every year ka profit. Sir, we have to calculate ARR means we need average PAT. To calculate average PAT, we need profit of all the years. But profit will not be given. Instead of profit, they will give you cash inflow and they will give you cash outflow. Instead of profit, they will give you cash inflow and they will give you cash outflow. And they will ask you to find out ARR uses cash flow or it uses profit. Profit. That means, can we take cash inflow and work it out, or we need to find the profit? We need to find profit. In that case, what to do? That is why I have taken a small example over here. Let's say they tell you in the problem that every year cash inflow, every year cash inflow is 1 lakh rupees. Every year you are getting a cash inflow of 1 lakh. For how many years I assume? 10. That means what is total cash inflow? For 1 year, it is 1 lakh. For 10 years, it will be 1 lakh into 10, which will be 10 lakh rupees. Any problem? No. Now, this is your total cash inflow. But to do this particular project, let's say we have purchased a machinery and so outflow is how much? 2 lakh rupees. It's very simple. If they don't give you profit, there is a workaround to get profit. There is another way to get profit. Very simple. How much total cash inflow you have got? 10 lakh. How much cash outflow is happening? 2 lakh. 2 lakh you invested. How much you are getting? 10 lakh. So how much extra you got? 8 lakh. That 8 lakh only becomes your total profit. That 8 lakhs only becomes your total profit. Is this exactly profit or one shortcut method? One shortcut method to get the profit. Is that okay with you? How did we get the profit again? Tell me. Total cash inflow minus total cash outflow. Your total cash inflow for 10 years is 10 lakh. Total cash outflow I have assumed it to be 2 lakh. So 10 lakh minus 2 lakh you do. How much you going to get? 8 lakh. That 8 lakh is what? 1 year ka profit or total profit? Total profit. For ARR, we need total profit or average profit. How do you find out average profit? Total profit is 8 lakh divided by number of years. How much is number of years here? 10. So 8 lakh divided by 10 you do. How much you going to get? 80,000. That's another workaround or another shortcut method to get profit. Yes, sir, people. We understood. Again, all this I'll apply one more in the question. But quickly doing one discussion. So far good. Can I move forward? Okay, next is a technique which you are already comfortable called NPV. NPV stands for net present value. Alright. Now 1 minute. This two techniques, sir, this payback period and ARR, no, they don't give a damn about present value. They will say they are non-discounting techniques are also known as traditional technique. That means, do we need any discount factor required for them or no discount factor? No discount factor. If we have checked over here, anywhere I use the term present value for payback period or for ARR, anywhere did I even utter the word present value? No, because they don't take the present value techniques at all. And that's the reason we call them as what, sir? Non-discounting technique, or another name, traditional technique. Now we are moving towards those techniques which take the help of present value, which uses discount factor. That the techniques are, you know this already, those are NPV, profitability index, IRR. So these are the three techniques. Okay, Zaru. First is NPV. So first discounting technique is NPV. How do you get NPV? NPV ka full form is net present value. How do you get NPV? Present value of cash inflow minus present value of cash outflow. Alright. So you just need to find out present value of cash inflow and deduct the present value of cash outflow. The final number we call it as NPV. Done. Okay. So to find out present value, we need to take what? Discount factor. That discount factor, mind you, should always be after tax cost of capital. If they give you before tax, we should take after tax. Remember, we have already done in chapter number 4 called KO. KO, what is KO? Overall cost of capital. How did you find out KO? By taking before tax or after tax? After tax. Okay, so you should always take after tax cost of capital, KO, as a discount factor and find out the present value. Some problems they will give you before tax. So what you have to do? After tax. How do you get after tax number? I already told you in previous, remember. If you want to directly jump to after tax number, we simply multiply it by 1 minus tax rate. I'll show you through another problem also over here, but just say. Okay, sir. So this is your discount factor. And this is your rate basically. Then how do you calculate discount factor? How do you get DF? We already discussed this. DF, discount factor, is given by 1 divided by 1 plus I whole power n. Alright. This, I think, well, I'll take you through one question, and any which way you have done it, so I'm pretty sure you know it. Next is your PI. PI as in profitability index, or also known as present value index. Sometimes it is also known as desirability factor. Different names, one and the same. Sir, a profitability index is just an extension of NPV. It is same like NPV. How did you calculate NPV? Present value of cash inflow minus present value of cash outflow. Profitability index, no sir, there you reduced, no, here you divide. So profitability index is nothing but present value of cash inflow divided by present value of cash outflow. So why do we do this, sir? It's very simple, sir. How do we decide this? Based on these techniques, company will take the decision whether should we buy the asset or not is decided by these techniques. How? Sir, if NPV is greater than or equal to 0, then you can accept the proposal. Meaning you can buy the machinery or whatever. Meaning decision can be accepted. If NPV is negative, accept or reject. Like this. Okay, now. So calculate NPV if it is 0. In fact, usually in our old version of study material, 0 means the choice was with the company. If NPV is exactly 0, company can either accept or they can reject. Because neither they are getting benefit nor they are incurring loss. So if NPV was exactly 0, our previous version of ICI material used to say either you can accept or reject. But in the latest version of study material, they brought in a small change. They said if NPV is 0 or more than 0, accept. If NPV is negative, then reject. So this they have brought in. So be aware of that. So those of you who are using my old study material, be aware of this. I've corrected I've changed this in the new material. But just see, though some of you said that I heard that you're using old material. So I wanted to bring that to your attention. Then people. Now let's say you have two machineries. First machinery ka NPV is 1 lakh. Second machinery ka NPV is 1.5 lakh. Which one will you select? You'll always select that asset or that project which gives you higher NPV. So among the two projects, if you are comparing, means you will select the highest NPV. Like that. If you are doing only decision for one project, you don't have two machineries. You have only one machinery. Then calculate if that machinery ka NPV is 0 or greater than 0. Accept. If that machinery ka NPV is, if that one machinery ka NPV is negative, means reject. Like that. I've also written that, but just saying. Okay, people. Same goes for profitability index also. If profitability index is exactly 1 or greater than 1, accept the proposal. If profitability index is lesser than 1, then reject the proposal. I've written the decision here. I'll come to that, but just saying once. Okay. All right. Now another technique is IRR. IRR means internal rate of return. So IRR is basically a rate at which two things will be equal. What are those two things? Present value of cash inflow will be equal to present value of cash outflow. If inflow ka present value and outflow ka present value is same, means at what rate they become same, that we call it as IRR. Or you can reframe IRR like this. IRR is basically a rate at which NPV will become 0, because inflow and outflow are same, no? If inflow outflow is same, means even if you calculate NPV, it will become 0. Okay, Saru. And how to calculate IRR, you know this already. We have to assume two rates. Usually, sometimes some problems they will only give you the rate. If question gives you the rate, assume the same rates. Don't bring in creativity. Okay. If they don't give the rates, then you are free to assume. And then plug the numbers into formula. What is that formula? We applied it in the previous topic only. IRR is given by lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Plug this into the numbers. Accordingly, you will get the IRR. Usually, majority of our problem, IRR will be in decimals. So, you have to assume some two rates and work it out. Any problem so far? Decision rule, as I've already told, maybe we'll run through this also. Acceptance rule for the project. First, NPV. If it is individual projects, you tell me, sir, what do you do? If NPV is only one project is there, how will you decide based on NPV? If NPV is 0 or greater than 0, accept. If NPV is negative, means reject. Based on profitability index, how will you accept? Profitability index should be 1 or greater than 1, means accept. Okay, like this. IRR. IRR is what, sir? It's a return. If the return is greater than the cost, if IRR is greater than, which cost are we talking about here? KO. Because to buy a machinery, to do an expansion, we need funds. For that funds, we calculate a cost. That cost only we call it as what? KO. If IRR is greater than or equal to KO, you can accept the proposal or you will reject the proposal. This is on this three. Any problem? So if you have multiple projects, how will you decide based on NPV? You will select that project which gives you the higher or highest NPV. Same goes for this also. If you have multiple projects, you will select that project which gives you the highest profitability index. If you have multiple projects, you will always select that project which gives you the highest IRR. Okay, Saru? Now, if you have to decide based on payback period, pretty rare, but anyways, if they give you in the examination, if you have one project, they are asking you to decide based on payback period. What they will tell you is, suppose you calculated the one project, project A, you calculated the payback period for project A to be 5 years. Assumption. This project, first of all, what does payback period mean? If payback period is 5 years, means what does it mean? Within 5 years, you will recover the initial investment. That's what payback period is trying to calculate. Yes. But company, no, sir, they have an internal policy. They have an internal policy, meaning they will only accept the project if the payback period is lesser than or equal to 4 years. Only those projects they will expect or accept whose payback period is 4 years or lesser. Now you will tell me, you will accept this project or reject it? Reject. Why? Because company has an internal policy of taking only those projects which have a PP of 4 years or less. That's how you take the decision. So if the payback period is lesser than expected period, then you will accept. Here it is lesser or higher. Expectation is 4, but actual payback period is 5. That's the reason you will do what? Reject. So now suppose payback period is only 3 years. In this case, what you will do? You will accept it because it is 4 years or less. Comfortable? Huh? That is for payback period. Sir, if they give you multiple projects, how will you decide based on payback period? Payback period means the time within which you will recover your initial investment. You want this duration to be highest or lowest? You want to clear examination in the long CA exams in the longest duration or shortest? Same goes for payback period also. If they give you 2 projects ka payback period, you will select that project which has the lowest or lower payback period. ARR. ARR is accounting rate of return. Okay, now you will select lowest return or highest return. If they give you multiple projects, you will always select that project with the highest ARR. Now, if they give you only one project, how will you select? Suppose you have a project B, you calculated ARR for project B, you got it to be 15%. Return is how much? 15%. Company has an internal deadline. They will only take up that project which has a return of 12% or more. They will only accept that project whose return is 12% or more. Now you tell me, this project B, accepted or rejected? Accepted. Why? Minimum expectation is how much? 12. This is achieving how much? 15. So what? Reject or accept? Accept. Same if I modify, ARR is only 10%. Minimum expectation is 12%. Now what? Accept or reject? Reject. That's your decision rule. So you will compare ARR with expected return which company has as an internal policy, then accordingly you will accept it or reject it. These are your decision rule. Any doubt? Anybody till here? Comfortable? Okay, now let's do a thing. Let's take up one question and all the techniques we have gone through. 1 minute. Where is? Let me find. This one, I think. Question number 20. Question number 20. The expected cash flow of 3 projects are given below. Earlier you said accept or reject. Now only accept. Is that right? What accept or reject you are talking about, Dinesh? Which technique are you talking about? I'm sorry, I get your chats a little delayed, so the response may be a little delayed, but type in your full question so that I can answer it in one go. You can type in Macha. I'll finish this question and then I'll come back to your doubt. Okay, look at this, everybody. The expected cash flow of how many projects? 3 projects are given below. Cost of capital is 10%. Cost of capital here refers to KO, right? And first of all, to find out present value, we need KO only given. Calculate payback period, great. NPV, great. IRR also we need to calculate. ARR also we need to calculate. One question you have to calculate everything. Okay, then you have to give a rank. Ranking you already know. No? Obviously, based on payback period, if you have to give the rank, means you will give the what? First rank you will give to the lowest payback period. Based on NPV, if you have to give a rank, means that the project which has the highest NPV you will award first rank. Based on accounting rate of return, if you have to give rank, means that the project which has the highest ARR will get first rank, like that. Okay. Now let's calculate. How do you get payback period? For that, first you check. There are 2 approaches. You will check whether an annual net cash flow is constant or whether it is changing. They've given for 3 projects. Maybe 1 or 2 I will show. Everything is not required. Yes. Check project A ka. They only given, sir. For all this technique, we don't need profit. We need a cash flow. Have they given cash flow? Yes. That means we don't have to do any working note. They have only given the cash flow. If you get, they're given period. Year 0 means what, sir? Year 0 means, at year 0 what will happen? You will invest the money. So year 0 is outflow or inflow. At year 0, first of all, to do a particular project, you need to invest, sir. Investment will happen at year 0 in majority of the cases. Then from year 1 to year 10, in fact, that's the reason they're given also here. They're denoted in negative. Usually for these problems, inflows usually are correct way only. For these problems, inflows are denoted as a positive number, outflows are denoted as a negative number. You are able to see negative 5,000. So that means this is inflow or outflow? Outflow. Year 0 means what, sir? It is nothing but year 1 ka beginning or initially. Alright. 1 year here means end of first year. 5 year means end of 5th year. Like that. If you do project A, every year you will get a cash flow and the cash flow is changing or same? Same. That means annual cash flow is constant. How do you calculate payback period? Tell me here only. Initial investment, which is 5,000, divided by annual net cash flow, which is 900. How much is that, sir? 5,000 divided by 900. If you do, you will get 5.56 years. That is the payback period for project A. Any doubt? Any doubt? No. I'll do it for project C. Easier. Or maybe I'll do it for project C. Project B, you do it. It's okay. I will anyway put up the solution. In the interest of time, that's all. Project C, how much is outflow? 5,000. Every year inflow, same or changing? If it is changing, can we do formula method or cumulative method? Cumulative method. So I'll show you the cumulative method. I worked out for B also. In the interest of time, I'll just take up C. Where is C? C not there only. Okay, C is not there over here. Okay, no problem. We'll take up B only then. Done. Sir, if you just check project B ka cash flow, is it same every year or changing? That means what you have to do, first from year 1 to year 10, copy the cash inflow column. We need only what, sir? Cash inflow. Don't take cash outflow over here. Okay? Take only the cash inflows. And then what do you do? Cumulative cash inflow you have. First year, where is cumulative cash inflow? Cumulative means adding up. First year, can you add anything? No. So that means this will be 700. Next year, it will be 700 plus 800. It will be 1,500. Then 1,500 plus 900. How much? 2,500. Then go on adding like this. What is the initial investment of project B? 5,000. Check any number is having exactly 5,000 here? No. But 5,000, can I say, is lying between here? This is 4,500. This is 5,700. So payback period is lying between year 5 to year 6. Tell me, we did this. How do you calculate payback period? Take the lowest number. What is the lowest year? 5 plus what? Required cash flow divided by actual cash flow. 5 plus required cash flow. Up to 5th year, how much you have earned? 4,500. How much is your initial investment? I mean, how much cash flow more you need? From 4,500, if you have to go to 5,000, the cash flow you need is how much? 500. So the required cash flow is 500. Divided by actual cash flow. For 6th year, how much actual cash flow you earn? 1,200. So required divided by actual you do, you will get the number to be 5.41 years. That is the payback period for project P. See, I've done it directly. That's okay. You got the fund now? Just quickly revising so I don't have to take up every question. Yes, sir. So payback period we have done. Next is NPV. How do you calculate NPV? Simply take the cash flow. Here you will start from year 1 or year 0. Because for NPV we need a present value of cash inflow also. We need a outflow also. I don't know where is that NPV. Maybe. Okay, I'll do it. I'll just check over here. Okay, check, sir. Project A ka. If you just check cash flow, is it different every year or same every year? Sir, if it is same every year, one option is you can have 10 columns and take PVIF. PVIF means present value interest factor, which we discussed. But is cash flow different or same? If it is same, then we can use shortcut method. What is shortcut method? PVAF, present value annuity factor. Since it is same, we'll use PVAF. So for project A, year 0, how much is initial investment of project A? 5,000. That will come at year 0. Then I'll write in the year column year 1 to 10. How much you're getting every year? 9. So here I will use what? PVIF or PVAF? At what discount factor you will take? For NPV calculation, you will take discount factor as cost of capital. Have they given? Yes. How much is that? 10%. So calculate at 10%. How do you calculate this? 1 divided by 1.1. Press equals to button 10 times. Then there is a button called a GT button. Press that in your calculator. You will get PVAF. How much is that? 6.1445. So multiplying these two, you will get the present value. What is this, sir? Total present value of cash inflows. This is your cash outflow. At year 0, discount factor is always 1. Because year 0 means year 1 beginning. Year 1 beginning means now. Now means this 5,000 is already on what platform? Present value platform. Something which is already there on present value platform. Should we again calculate present value of it or not required? Not required. Hence we say for year 0, discount factor is always 1. So multiplying these two, you will get what, sir? 5,000. This is your present value of cash outflow. This is your present value of cash inflow. Add up, what are you going to get? 530. That is your NPV. And what is the decision rule? If NPV is, if you have to do only for project A, if you have to decide, then if NPV is positive, meaning if it is 0 or more than 0, accept. If it is negative, reject. They not ask decision rule, just saying for your reference. Done? Any problem? No. Next, did they ask you only NPV in the problem or also IRR? For IRR, we need one discount factor or two discount factor. One already we have got it 10 here. That means we'll assume another rate. Ideal scenario for IRR is one NPV should be positive, one NPV should be negative. So at 10% when I calculated, I got how much, sir? 530. The trick is the discount factor as you increase, NPV will go on reducing. The discount factor if you go on increasing, let's say here from 10 I made it to how much? 14. Check how much I got NPV? Negative. As you increase the discount factor, NPV will go on reducing. Now I'm testing it at 14. Should you also compulsorily do it at 14 or your choice? Your choice. I've taken 14 because of this IRR. This is actually NPV calculation. Because they asked IRR, I'm doing, instead of showing the table once again, in this table only I have solved it out. Now find out the discount factor at 14%. At year 0 it's always 1. Now at 14% for 10 years, I need PVIF or PVAF? PVAF. So now you will do what? 1 divided by 1.14 because the rate now is 14%. So 1 divided by 1.14, press equals to button 10 times and then press GT, grand total button. How much you getting? 5.261. So this is your cash flow, this is your discount factor, multiply. When you multiply, you will get this 5,000, this 4694.5. This is what? What is this 5,000? Present value of cash outflow. What is this? Present value of cash inflow. How do you get NPV? Present value of cash inflow minus present value of cash outflow. Okay, when you do it, you will get 305. Done, people? Now, is 10% or 14% my IRR or neither of them? Neither. Because if 10 or 14% was IRR means my NPV at IRR will be what? 0. Is any number 0? No. That means IRR is lying somewhere between what? 10 to 14%. Now plug the numbers into formula. What is the formula for IRR? Lower rate, plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. I've assumed two rates. What are those two rates I've taken? 10 and 14. So should we always take 10 only? No, your choice. Two rates are your choice. Since one rate I've already taken for 10 to calculate my NPV, which they asked, then I took the other one as 14. If you want, you can take 11 and 14 also. Any other rate is also acceptable. So among 10 and 14, which is a lower rate? 10. So I've taken 10 here. Plus at 10%, what is NPV? 533. So divided by NPV at lower rate minus NPV at higher rate. Higher rate is 14%. At 14%, how much is NPV? 305. It's already negative. I have to reduce. So negative of negative will become what's positive. Into higher rate minus lower rate. Higher rate is 14, lower rate is 10. 14 minus 10 you do, you'll get what's 4. So multiply, you'll get the IRR to be 12.53%. Understood? This is about calculating IRR using shortcut. What is the shortcut? PVIF or PVAF method? PVAF. You can use PVAF only under one circumstance. What is that? Cash flow should be constant. Only if cash flow is constant, you can use PVAF. Otherwise, you have to do each year ka discount factor separately. Done. I'll also show you maybe for project C. Now, if you just check project C ka cash flow same or different? Now, can I use PVAF or PVIF? PVIF. They ask you NPV also, no? So let's calculate how much. Same for project C. Let's calculate. Where is it? Here. What is the year 0 ka cash outflow for project C? 5,000. What are the inflows? 2,000, 2,000, 2,000 and 1,000. I've copied that. Now this 2,000 rupees you will get now or at the end of first year? End of first year. I mean this 2,000 is present value or future value? Future value. This 2,000 when will the company get? At the end of second year. That means this is what? This 2,000 is also what? Future value. But we need what? Present value. How do you get present value? By multiplying the discount factor. For NPV calculation, we should take what discount factor? Cost of capital. How much is it given to be? 10%. Now take 10% discount factor and calculate. For year 0, discount factor is always 1. Now for each year I need to calculate. How will I calculate discount factor for each year? 1 divided by 1.1. Press equals to button, you will get first year ka discount factor. Again press equals to button, second year ka. Again equals to third year ka. Again equals to fourth year ka. If that equals to button and all, if it is not working in your calculator, buy a new one which works. Okay, because these are all necessary for FM. Done, people? This is your cash flows, this is your discount factor. Multiplying, what are you going to get? Present value. So if you add up all the present value, how much NPV we got? 657. That was one of the requirement of the problem. That's the reason I boxed. Whenever you get an answer, no, have this boxing system. So that invigilator will directly check the answer and give you off the marks. He doesn't have to go through your whole answer sheet to award the marks. So this box system can be followed. Now they asked only NPV or also IRR. IRR. One rate I've already taken. For IRR I need two rates. One I've already taken. Other one maybe since above I've already taken 14. No? Here also maybe I'll stick to 14. But is it mandatory or any rate is okay? In fact I've changed. At 14% maybe it is not coming. That's the reason I took it as 19. Alright, because ideal scenario for NPV calculation is one should be positive and one NPV should be negative. Okay. If it is not, ICA will increase the interest rate and get one NPV positive, one NPV to be negative and then plug in the normal. So if I assume different discount factor, will my answer match? No, answer will not match. There will be a variance. Instead of 19%, if you take 18%, your answer will not match. That is fine. That is acceptable because IRR works in this fashion. But usually in IRR questions in exam, what they will do is, they will only give you the discount factor so that every student will assume the same rate. So every student will also get the same answer. But if rate is not given, you are free to assume and you don't have to worry about the final answer. It will change. So at 19% if you discount, now here can I take PVAF or PVIF only? PVIF and I've calculated, plug in the numbers into the formula and you will get the IR. Quickly reviewing. Okay, no? The pattern of solving we have got it, no? That's okay, right? Now this is about your calculation of payback period and NPV and IRR. They also asked ARR in the question. Capital ARR they've asked. Huh? Okay. ARR. Tell me, sir, how do you get ARR? One, ARR uses cash flow or it uses profit? Profit. But if you just check the question, they give you what, sir? Expected cash flow. Did they give you expected profit or expected cash flow? For ARR, we need profit, but profit data is missing. That means now, do you know a way to find out profit? Yes. How do you get profit, sir? Total cash inflow minus total cash outflow. If you do that, what you will get? total profit. We don't need total profit. We need average profit. How many years is project A? 10 years. Calculate, let's see. Total cash inflow. I've done it, but you calculate. Let me see how you have understood. From year 1 to year 10, 900 into 10. What is the total cash inflow? Inflow is 900 into 10. How much is that? 9,000. How much is outflow, sir? 5,000. From total inflow, if you reduce total outflow, what are you going to get? Average profit or total profit? How much is total profit? 4,000. We want total profit or average profit? How do you get average profit? Total profit divided by number of years. How many years will project A go for? 10 years. That means you do 4,000 divided by 10, which is how much? 4. Easy now. So you got your average profit. Then calculate ARR for me. What is ARR the formula? Average profit divided by, either you can take initial investment or you can take average investment. Okay. If you take initial investment, what will be the answer? 400 divided by, how much are you investing for project A? 5,000. 400 divided by 5,000. Sir, ARR is a return. Return we want it in percentage. So we multiply by 100. How much is that? 8% if you'll get if you take initial investment. If you take average investment, number will be same or different? Sir, how do you get average investment? We just now looked at fancy formula. What is that? Half of what? Initial investment minus salvage value, close the bracket, plus salvage value plus working capital. Most probably working capital and salvage value will not be there in these problems. What is initial investment? 5,000. Salvage value 0. Plus salvage value 0. Working capital 0. If you do that, how much is it? 2,500. Now calculate ARR for me. Average profit is 400 divided by average investment, which is 2,500 into 100. If you do, you get 16%. Both the answers are acceptable. You can calculate ARR using initial investment or average investment, your choice. That's what I've worked out over here also for your reference. For project A. Yeah, I worked out using average investment over here. My preference is average because in the numerator maybe we are considering average. So I personally would suggest average investment, but I say they've solved the question using both. So in examination, your choice. So this question was kind of a recap of all the techniques. Manageable. Can I move forward to the next? So capital budgeting and EAC we need to do by default. EAC we have not discussed much. I'll wait for a minute. 1 minute. I'll come to that. I'm just going step by step. Okay. So till here we have covered. So we'll come back to our chart book. So we have covered till what, sir? IRR. Can we move forward? Alright. There is one more called MIRR. One more called MIRR. MIRR is modified internal rate of return. Modified IRR. What is this MIRR ka concept is? It's simple. Let's say you are getting cash flows. Year 1, 2, 3, 4, you are getting cash inflows. Let's say you're getting 10,000, 15,000, 12,000 and let's say 20,000. By doing a particular project, you are getting cash inflows for 4 years. This I assume. Now, sir, with the company, at the end of first year, how much they got? 10,000. Will they keep this money idle or will they reinvest? Reinvest. Yes, no, into the project. If it's a suppose we are doing CA coaching now. If it's a profitable project, we will do 1 batch in a year or think to do more. Instead of 1, we will try to do 2 or maybe 3, maybe morning batch, afternoon batch or evening batch like this. Correct or no? Same with the company. If first year if they get 10,000 rupees cash inflow, will they keep that 10,000 rupees cash idle or will they reinvest? Reinvest. Into which project? Same project. And how many years can this amount be invested? 10,000 you got it at the end of first year. Project will run for how many years? 4 years. That means this 10,000 you can reinvest for how many years? 3 more years. Comfortable? If you reinvest this, will it be still 10,000 or its value will increase? That means that value, we call it as TCF, as in terminal cash flow. Terminal cash flow. So you reinvested 10,000. For how many years can you reinvest? 3 years. They will give you cost of capital. Let's say cost of capital is at 10%. Cost of capital is 10%. That means this 10,000 you can invest for 3 more years. Means what will be the value? 10,000 plus 10% plus 10% plus 10%. You do. How much is that? Quickly, for everyone do. One of you do and tell me the value. I don't have calci over here. 13,300. Like this. Okay, now sir. If you don't want to do like this, sir, this 10,000 is a value at the end of first year. We want value at the end of 4th year. That means this 10,000 becomes your present value. We have to calculate the future value. You know, mathematics may have formula. So to calculate present value, what do? We take future value into 1 divided by 1 plus I whole power n. This is what is discount factor. Future value we multiply by discount factor. If you have to calculate future value, what do? Present value, and this you might send it to the other side. So it will become what? 1 divided by 1 plus I whole power n. Correct? You can also calculate like this. 10,000 is present value into 1 plus I. I is how much, sir? 10%. How many years can you reinvest? 3 years. So calculate 10,000 into 1.1 whole power 3. 1.1 into 1.1 equals to button you press. 1.1 into 1.1 press equals to button. Again press equals to button. How much you going to get? You're multiplying and telling me. Yeah, if you do the calculation, final number will also be 13,300. Whether you calculate like this or whether you calculate simply by adding percentage, answer will be C. Then Asaru, any problems, Asaru? No. Tell me, sir, for second year, this 15,000, when did you get? At the end of second year. Okay. Now, this 15,000, for how many years can you reinvest? You got it at the end of second year and project ends at the end of fourth year. That means you can reinvest for how many years? 2 years only. That means what will be its value? 15,000 you can reinvest for 2 more years and return you will get is how much? 10%. That means you will add 10% how many times? 2 times. How much is this? 18,150. Now this 12,000 you can reinvest for how many years? You got it at the end of third year. Project ends at the end of fourth year. That means you can reinvest for 1 year. So here you will do what? 15,000 plus 10%. How much is that? Huh? 16,500. Okay. Huh? Which one? Oh, this is actually 12,000 into. Okay, fine. Cash flow is only 12,000. Okay, 12,000 plus 10% is 13,200. Okay, fine. Now this 20,000 you have received at the end of fourth year and project ends at the end of fourth year. How many years can you invest? No, you can't reinvest. Don't write 0. So simply that means what, sir? Its value is what? 20,000. No, because this is the value at the end of fourth year. It's done now. Now add all these are values now or at the end of fourth year. Why fourth year? Because here project is ending at the end of fourth year. That we call it as terminal. Terminal means ending. Terminal means ending. Here project is ending on which date? Fourth year. So add up all the terminal cash flow. How much is that? 64,000. My RR is simple, sir. First of all, you tell me what is IRR. IRR is basically a rate at which present value of cash inflow will be equal to what? Present value of cash out. That is your IRR. Correct now? MIRR is a modified internal rate of return by considering what? Reinvestment factor. MIRR is trying to calculate at what rate present value of cash inflow. Now what do we have? Terminal cash flow. At what rate present value of terminal cash flow will be equal to present value of cash outflow. Now we have to see at what rate 64,650 will be equal to present value of cash outflow. Let's say present value of cash outflow is 20,000. Assumption. At what rate this 64,650 and 20,000 will become equal. Now what do you have to do? Same drama. How do you find out IRR? By assuming 2 rates. Here also you have to do the same 2 rates assumption. Plug the numbers into normal IRR formula. But the percentage you get, no, it is not IRR, it is MIR. That's the only distinction. Got it, Asaru? Any drama, sir, or got it, sir? Sure. Now I have one question also. Can we quickly 2 minutes review that question? If you have got this. So again, MIRR full form is what? Modified internal rate of return. MIRR considers the reinvestment element because every year cash flow what you get, company will not keep it idle. They will reinvest. At what rate? At the cost of capital itself, which in this example I have assumed it to be 10%. That means now we don't need cash inflows. We need what? Terminal cash inflows or terminal cash flows. So calculate total terminal cash flow and try to equate it with what? Present value of cash outflow. At what rate present value of terminal cash flow will be equal to present value of cash outflow. Such a rate we call it as MIR. And step of calculating MIRR is same as IRR. You have to assume 2 rates, plug the numbers into formula and get the answer. Now 1 minute, I'll show you one normal problem also. Question number 14. This is again I say a question only. Question number 14 is an MIRR question. I'll bring the solution a little closer. Hang on. No, maybe it's over here only. Okay, check here, sir. An investment of 1,36,000. What is this 1,36,000? I'll write it as present value of cash outflow because outflow happens immediately. So that means it is already on what platform? Present value platform. yields the following. Yields means gets you the following cash inflows. This is profit before depreciation but after tax. So tax is already deducted. Before depreciation means, I told you in the problem, we need for all this analysis profit or cash flow. First, what do you do? Find out profit after tax. Then first adjustment you have to do in every problem is add back depreciation. If you add back depreciation, you will get one number, no? That we call it as profit before depreciation but after tax. Meaning tax is already deducted and depreciation is already added back. That means what is this? This is only your cash flows. That means they have done. Should we have to find the cash flow or they have already done? They have already done. So this is nothing but your cash flow because they have deducted tax and added back depreciation. Since you have added back depreciation, they call it as profit before depreciation and after tax. Okay, sir. There's nothing but your cash flows. Okay. Now all these are what? Cash inflows. What is your cost of capital? 8%. Now this 30,000 company will receive inflow at which year? End of first year. Will 30,000 company keep it idle or reinvest? Reinvest. At what rate? At cost of capital itself, which is how much? 8%. That means what, sir? Will this cash flow be same? So that's what I've done here. 1, 2, how many years cash inflow you're getting? 5 years. Cash inflows I've copied from the question. Then I brought in reinvestment factor. Reinvestment factor, you can do it in multiple ways. One simple way is take 30,000 and add what? 8%. Now you tell me this 30,000 you can invest for how many years? Maybe I'll write it as reinvestment years over here. How many years can you invest this 30,000? You received at the end of first year and project is ending at the end of fifth year. You can reinvest for how many years? 4. This 40,000 you got it at the end of second year and project is getting over at the end of fifth year. So how many years can you invest? 3. This one, 2. This one, 2. This one can you reinvest? No. Correct. Fine, people. That means you will add. If you have to use a shortcut method, you will take 30,000 and add 8%. How many times? 4 times. Like that you can do and get the terminal cash flow. That is one way. Our ICI uses present value, future value technique. How do you get future value, sir? Present value into 1 plus I whole power n. This 1 plus I whole power n, no, in study material books, they call it as a reinvestment factor. Instead of discount factor, they are calling it as reinvestment factor. You can also call it as future value factor. Because using this, we are finding future. Okay, that is nothing but 1 divided by 1 plus I, or rather 1 plus I whole power n. Either directly you can do it in your calculator or you can multiply the reinvestment factor and get it. The choice is yours. Okay, people. Let this calculate terminal cash flow. That's it, or add up. Add all the terminal cash flow. How much are you going to get? 2,13,586. MIRR means what? In fact, they're asking us to calculate MIRR only. Determine MIRR. MIRR means it's a rate at which present value of terminal cash flow will be equal to present value of cash outflow. At what rate terminal cash flow and present value of cash outflow will be same? That rate we need to find. For that we need to what? Assume a rate. First rate I've assumed it to be 10%. Okay. Alright. Now outflow will happen at which year? Year 0. How much is present value of cash outflow? 1,36,000. At year 0 discount factor is always 1. So present value of cash outflow is 1,36,000 only. Now this terminal cash flow, nice music, but keep it on silent. Terminal cash flow is how much total? 2,13,000. This you'll get it now or at the end of the project. Here project is ending on which year? 5th year. That means this 2,13,586 you will get it at the end of 5th year. So at 10% for 5th year, calculate PVIF for me. 1 divided by 1.1, press equals to button 5 times because we need 5th year ka PVIF. How much is that? 0.6209. Correct. Multiply these two, you will get the present value of cash inflow or present value of terminal cash flow. Present value of terminal cash flow. This is your outflow. This is your present value of terminal cash flow. Add it up. What are you going to get? 3385 negative. Sir, if 10% is your MIRR means NPV should become 0. NPV should become 0. Has it become 0? No. Then you'll have to assume one more rate. But if you just check first rate only gave me of negative. Ideally, what do I want? One positive, one negative. As you increase the discount rate, NPV will go on reducing. But here it is already negative. I mean, I want one positive number. So rate I will increase or reduce. So instead of 10%, maybe I'll take 5%. You can also take 4, 3 or 6 or 7, your choice. I've taken 5. At 5%, if you work out, you got a positive number of 31,344. So is 5% my MIRR? No. If 5% was MIRR means this instead of 31,344, it would have become 0. So basically MIRR is lying somewhere between 5 to 10. Now plug in the formula. Same formula. What is that formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Do that, you will get the answer 9.5. This 9.5, don't call it as IRR, call it as MIRR, modified internal rate of return. Easy, people. Okay, so this is done. I'll move on to the next concept. Where is that? 1 second. So we have done payback reciprocal, ARR. Then we looked at what's a NPV over, PI over, MIRR also over. All this is over. Next, we will move on to certain extra technique. Now, one simple question for you. Just 1 minute. So far, everyone is understanding? Online also, everything going good? According to NPV, what is cash inflow, outflow according to whom? NPV is always found out from company perspective. Okay. Only cost of capital chapter may we give the signs from investor perspective. Only when you're finding cost of capital, cost of debt or cost of equity under IRR, we put the signs from investor perspective. But because here, no, who's doing the project? No? Company. So who will get the return? Company. In the cost of capital chapter, company was taking money, so it was cost. In who was giving the money? Investor. For whom it was a return? Investor. Hence we gave the sign from investor perspective. But in all this topic, company only is doing the project, so they will only get the cash inflows. So you get the positive, negative signs from company perspective. Great. Okay. Moving along. Next is certain extra cases or some extra fittings. Now, if I give you two projects, if I give you project, let's say two projects, project A, project B. One NPV of project A is, let's say, 50,000. For project B, it is 1 lakh. What will you select? You will select project A or project B? Project B, because selection rule says what? You will always select that the project with higher or highest NPV. Yes, sir. But hang on. Outflow of project A is, let's say, 20,000. Outflow of project B, let's say, is 80,000. Okay, that means these two projects are having same outflows or different outflows? Different outflows. That is a special case. Now we are looking at two special cases. So you can't do the selection only based on NPV. It will be not right, because bigger project, if you do big project, you'll always get big NPV. Right? So big project cash flows will be in crores. That means NPV also really will be high. But to do big project, you also need a big funding. So if you do the selection just based on NPV, that will not be right. You also need to consider what? Outflow in mind. Because these projects are having same outflows or different outflows? Different outflows. That we call it as capital budgeting under capital rationing. Capital budgeting, this decision or these type of problems, we call it as what? Capital budgeting under capital rationing. To ration something means what? To safeguard, to keep it. Yes, no? Like you are rationing your time now. Every day you're figuring out what I should study, how much I should attend class and all. That is what is rationing. Rationing means safely utilizing or carefully utilizing. You are carefully utilizing what here? Outflows. Now in these sort of problem, how it works is, you can't take the decision just based on NPV because outflow of the projects are different. You also need to consider the outflow and then make the decision. Such a scenario we call it as what? Capital budgeting under capital rationing. I'll do a thing. Or I have an example. Maybe I'll take you through a small example over here. Then we will see if required. We will take one more question. Or may not be required. Just check. Sir, let's say, sir, we have three projects. A, B, C. For project A, the investment required is 50,000. Initial investment is 50. Here it is 40. Here it is 25. Same number or different number? Different number. If you do project A, no sir, you get a total NPV of 15,400. I've assumed all this number. B will get you 18,700. C will give you 10,100. Now, plainly based on NPV, if you do the selection, you will select which project? You will always select that project which gives you the highest NPV. Which gives the highest NPV? B. So you will do that selection. But hang on. All the projects ka investment same or different? Different. That means investment is on one platform or different platform? different platform. But to decide, everything has to be on the same platform. So what do we do over here is, or how they will ask this question is, they will say, company has, like this they will tell, company has a budget of 1 lakh rupees. Company has how much budget? 1 lakh rupees. Now you tell me, if you want to do all the 3 projects, how much money you need? 50 here, 40 here, 25 here. That means to do all the project we need 1 lakh, 15,000. But company has a budget of only 1 lakh. With 1 lakh, can you do all the 3? No. That means we have to select. We have to select. So this scenario is nothing but capital budgeting under capital rationing. So we are not choosing one project here. We are choosing multiple projects. Now, which one will you select? Will you do A and B? Will you do B and C? Or will you do A and C? That we need to suggest. Done. But straight away we can't decide that, because investment for all the projects same or different? Different. So the first thing you have to do here is get NPV to one platform. Get NPV to one platform. What is the one platform? Simple. 15,400 is the NPV for how much investment? 50,000 as an investment means you will get how much NPV? 15,400. I will bring everything to 1 rupee platform. Just for comparison purpose, I will bring every investment to 1 rupee platform. Meaning if 1 rupee is outflow means how much is NPV? Like this. Understanding now? For all the projects, I will bring the NPV to which platform? 1. Sir, it should be mandatory 1, sir. No, you can take 1,000 also. No problem. Answer will be same. For easier calculation, I have assumed how much? 1 rupee ka platform. If outflow is 50,000 means NPV will be how much? 15,400. If outflow is just 1 rupee means how much NPV? Calculate. How do you get? How much is this? X. You have to cross multiply. So it will be what, sir? 15,400 divided by 50,000. If you do, how much is that? 0.308. Tell me this in formula. We can aram se look into it. How do you get NPV for 1 rupee outflow? NPV divided by initial investment. Can I say? Can I like call it that? NPV divided by initial investment. 15,400 divided by 50,000. How much? 0.308. Do the next same thing. 18,700 divided by 40,000. How much? 0.47. 10,100 divided by 25,000. How much? 0.40. Everyone okay? Now check the screen. All these are NPV for what? All these are NPV for what? 1 rupee investment. Now they are on different platform or same platform. Now can I compare? Yes. Everything is NPV for how much investment? 1 investment. Now you can do your normal investment. Now a normal rule. You will always assign. Now we have 3 projects means how much maximum rank you can assign? Now we have to assign ranks. How many projects are there? 3. That means maximum rank you will assign is 3. If you have 5 projects, how many ranks will you give? 5. Now you tell me, first rank you will give it to what? The project with the lowest or highest NPV? Highest total NPV, highest NPV for 1 rupee outflow. For 1 rupee outflow, which is the highest NPV? 0.47. That means first rank will be given to project B. Next, which is the highest NPV for 1 rupee investment? 0.4. Second rank will be given to project C. Third rank will be given to project A. That means you will take up the project in this order. First you will take up what? B. Then you will take up what? C. If still money remains, then you will take a project A. This is what is nothing but capital budgeting under capital rationing. Understood? Now, if budget is 1 lakh, we already know now. First priority will take up which project, sir? Project B. Project B, to take up project B, how much money we need? 40,000. How much NPV will we get totally? So 40,000 investment will be going there, and NPV will get how much? 18,700. Second rank to which project? C. C requires how much investment? 25,000. How much NPV totally C will get you? 10,100. Stop. How much have you spent so far? 40 you spent for B, 25 you spent for C. Totally you spent how much? 65,000. You have a budget of 65 or 1 lakh? You have a budget of 1 lakh. How much you have spent? 65. Money is remaining still? Yes. How much? 35,000. Because if you add all this, how much you going to get? 1 lakh. Okay now. Now don't say project A ka NPV is 15,400. Oh, no. If you spend 50,000 for project A, then you will get an NPV of how much? 15,400. If you spend 50,000 outflow for project A, then you will get total NPV of 15,400. Are you spending full amount for project A or only 35,000? If 35,000 is the outflow means how much NPV you will get? Proration. Understood? Once again, got it. If 50,000 if you are spending on A means you will get an NPV of 15,400. You are not spending 50,000. You are only spending 35,000. If 35,000 you are spending for project A means how much NPV you will get? How much if you prorate that? X will be 35,000 into 15,400 divided by 50. If you do, we'll get 10,070. Okay. Sir, this you can do only if the question says projects are divisible. Projects are divisible means you can do part project. You can do part project. Like our CA coaching. If you do CA foundation coaching, mandatorily we should do CA inter also. No. Right now here at CF and ArivuPro, currently we are giving CA foundation coaching fully, CA inter coaching fully. CA final currently my subject is only one, which is actually available currently. In another 2-3 months, other subjects, other faculties also will come. Why? Because these are what, sir? Separate projects. Because these are what projects? Divisible projects. Divisible project means you can do only 10% of project A. You can do 40% of project A, or if you want, you can also do 100% of project A. Question will mention whether the project is divisible or not divisible. Suppose they say project A is not divisible, like that if they say, then what do you do? Can you do part project or not acceptable? Then A, you cannot take it up, you have to cut it off, like that. Okay, Saru? The question will usually say that these are divisible projects because these are good adjustment, so they will ask like that, if at all they want to ask the scenario. Done, Abhipal? Yes. So this is scenario, we call it as capital budgeting under capital rationing. So in simple terms, what is it? Simple. We have one budget too. In that budget, we want to select one project or multiple projects. Multiple projects, but all that projects has same outflow or different outflow. So what do we do? Since they have different outflow, obviously they will also have different NPVs also. You get them all on one platform. Which platform is that? To a common platform you get, which is that find out NPV for 1 rupee investment. Should it be mandatorily 1 rupee or anything else is also okay? Anything else is also okay. Final answer will not match, but I say also calculate NPV for 1 rupee investment. Based on that, you assign ranks. So you'll always select or you'll give first priority first to which project? First rank project. Next priority to second rank project. If money is still there, then you will do other projects like that. If projects are divisible means you can take up part project. Otherwise, you cannot take up the part project. Understood the scenario fully? I think I can go for the next case then. Yes, sir, people. Okay. Now the next case is, what if project has unequal life? Project has unequal life. Let's say over here, we have two projects, projects A and B. Let's say outflow for project A is also 10 lakh, B is also 10 lakh. Outflow is same. Now NPV here, let's say is 15 lakh, here let's say is 19 lakh. Now you tell me, sir, which one will you do the selection? Which project will you select? Both outflow are anyway same. Now you will compare NPV and select the lowest or highest. Highest. Correct? But hang on, they will give you one more information. Project A can last for, let's say, 4 years. Project A can last only for 4 years. B can last for 5 years. Now you tell me, can you decide based only on NPV? No. Why? This project has a life of only 4 years. Other one has a life of 5 years. Can you ignore this life or consider the life? Consider the life. In the previous case, we considered outflow because they were on different platforms. Now we have to consider the useful life. Understanding this scenario only we call it as what? Projects with unequal life. This is actually a 2 minute. I doubt that they will ask all this for a 5 marker or anything. Usually for 2 marker MCQ question, all this can come because pretty straightforward calculations. Now, how this works? Very straightforward. They have given NPV, no sir. They have given NPV, but this NPV is for how many years? 4 years. That means we need to find out something called average NPV. We need to find out the average NPV because this 15 lakh is an NPV for how many years? 4 years. This 19 lakh is an NPV for how many years? 5 years. So we need to find out for our decision making purpose, we need to find out average NPV. This is not simple average because we calculate NPV in a straightforward way or using discount factor. Discount factor. And is all the 4 year discount factor same or different? Different. So you can't do simple average because how do you get simple average? 15 lakh divided by 4 if you do, you will get simple average. But NPV calculation doesn't work based on simple average. It works based on discount factor. And every year discount factor is same or different? Different. Hence, how do we calculate average NPV? Is here we don't use the word average NPV. We call it as EAC. Instead of average NPV, we call it as EAC. Equivalent annualized criterion. Equivalent annualized criterion. So basically in simple terms, it means what? Average NPV. So what you have to do is very straightforward. You have to first find PVAF. You have to first find PVAF. PVAF means what? Present value annuity factor. They will give you the discount factor. Let's say discount factor is 10%. Calculate for me, sir. For 4 years at 10%, what is the PVAF? How will you calculate? 1 divided by 1.1, press equals to button 4 times and then press GT button. How much is that? 3.169. Great. Similarly, at 10%, same discount factor, for 5 years, calculate PVAF for me. How much is that? 1 divided by 1.1, press equals to button 5 times and then GT button. 6.96. One number. I don't have, I can't confirm. 3.790. Okay, now pakkana 1 divided by 1.1, press equals to button 5 times and then press GT button. Good enough? Okay. No. How do you calculate average NPV? Is very straightforward. Take the NPV and divide by PVAF. Take the NPV and divide by PVAF. Because you found out NPV using what? Discount factor only, So you find out average NPV also using what? Discount factor. That's all it is. Okay. So 15 lakh is your NPV divided by 3.169 you do. How much is that? 15 lakh divided by 3.169. How much is that? 4 lakh, 41, 47. Okay. 4733. Okay, I'll keep it as 4733. That's 4,73,000 some change. Similarly, calculate for project B. Take NPV. How much is the NPV? 19 lakh. Divided by 3.790 you do. How much you getting?
5 lakh 1.
501? 319. Correct. Now you will do the selection based on not total NPV but average NPV. So first project is giving how much average NPV? 4,73,000. Second project is giving how much average NPV? 501. Which has the highest average NPV? 3. That means you will select which project? Select project B. That's all it is. Understood the calculation? So simple way, how do you calculate EAC? Take the NPV. In all this problem, NPV will be given to you in the question. Even if they don't, you know how to calculate NPV? Calculate NPV divided by what? PVAF. At what rate? At cost of capital, which will be given to you again in the problem. So NPV divided by PVAF will give you average NPV. Just that we don't call it as average NPV, we call it as what? EAC. Equivalent Annualized Criterion. Done, Azaru. And selection rule is what? You will select the lowest or highest EAC. Highest EAC. But be careful, don't blindly mug up. Here it was what? They are given NPV. NPV means what? Net present value. Meaning if NPV is positive means, can I say benefit is greater than the cost? If NPV is positive means benefit is greater than the cost. So if they give you NPV, you will do the selection this way. You will select what, sir? You will select the project with the higher EAC. In some questions in a previous papers we have seen, they will not give you inflows. They will only give you cost. They will only give you cost. Like when you buy a machinery, they will say, for next 5 years, we don't have any inflow. We have to invest now to buy the machinery. For next 5 years, we have to incur some repairs and maintenance also. They call it as running cost. To maintain the asset, there is some repairs and maintenance. Year 0 also there is an outflow. For next 5 years also outflow. Okay, like that data they will give for project A. Project B they will say year 0 outflow, 7 years repairs and maintenance. How many years? 7 years. First project ka how much maintenance ho? 5 years. Second project ka how much maintenance ho? 7 years. You have inflow data or only outflow data? Outflow data. Yes. Same way you calculate. But here EAC is from benefit angle or cost angle? Cost angle. How do you calculate EAC? Same. Find out the present value of cash outflows. All here you have, can you find out NPV? In fact, how do you find out NPV? Tell me. Present value of cash inflow minus present value of cash outflow. Inflow is not even given. So that means can we find out NPV? So only thing you can find out here is what, sir? In these sort of problems, you can only find out present value, or maybe I'll build up a small scenario. You answer this question for me. You will find out present value of cash outflows by considering the discount factor. You got that to be, let's say 10 lakh. Here you got it to be 11 lakh. Any problem? No. Same number or different number? Different number. And same life, different life. Different life. When there is a different life, first thing you need to find out is what, sir? EAC. To get EAC, we need two numbers. One is the cash flow. Here we don't have NPV, so we will use present value of cash outflow. And then we need one more number called what? PVAF. Calculate at 10%. Tell me PVA for 5 years. I think you already. Let's maybe do a thing. Let's take 4 and 5 only, better instead of recalculating. Anyway, we calculated in the last problem only, no. So we'll make this as 4 and 5 years only. So what is 10% ka PVA for 4 years? We already wrote it here. How much is that? 3.169. Take that number, 3.169. Here also it will be what, sir? 3.169 or 3.790? 3.790. This is what, sir? Cash outflow, right? So we want what? EAC. EAC here is what? Average cost. It's not average benefit. It is average cost. How do you find out that? 10 lakh divided by 3.169. How much is this? 3 lakh? 360? 316? 3,16,000 I'll write. Okay, leave. It's fine. Here it will be what, sir? 11 lakh divided by 3.790. How much is this? 2 lakh. I'll keep it as 2 lakh 90. Okay, now you tell me the decision rules. Above me, you took the highest EAC. Here you will take the highest EAC or lowest EAC. Above me, it was benefit. So whenever you're working from NPV angle, you'll select the highest EAC. But when you're working the same data from cost angle, what will you do? You'll select the lowest EAC. So don't bug it up. Check what data you are working with, and accordingly EAC ka decision rule will change. All this we have done in our regular class. I think it's okay. I mean, you understood this one, no? Same question. Yes, that we need to calculate. Done, people. Yes. So you do capital budgeting, people. One more thing is which comment out we get is capital budgeting in EAC. No, you calculate only if question asks. Otherwise, not required. Okay. Because usually in investment decision chapter, no, the problem will already be lengthy. They'll give you 2 projects. Many cases, that project life will not match. But project question will already be lengthy. So what ICA does with bigger problem is they'll directly give the answer based on NPV. They'll not calculate EAC. If you calculate EAC, it is not wrong. Just that ICA is saying that it is not required to be done. Okay. If they ask you to specifically calculate. Otherwise, don't calculate. Comfortable? Even if you calculate, it is not wrong. In fact, if you ask me, calculating EAC is more appropriate because you are getting everything to one platform and accordingly taking the decision. But ICA is giving one shortcut. When ICA gives a shortcut, we should not question at all. Full swaha. Yes, no, because ICA always puts extra headache to us. If they're giving one shortcut means, do not question, aram se take it up. Yeah, thanks for reminding that. Sir, will there be chances that value of PVAF will be given in the question? Sometimes they may give, sometimes they may not give. Okay, I doubt PVAF will be given because all these are 2-marker questions. At least something you need to put efforts in. If every data they only give means, yeah, at least PVAF, I think they might expect it from you. Anyway, if they give it, do it. Replacement chain model is not required there. Yeah, that's foolish method. That's the reason. There is one more method under EAC that is not that popular, so leave that. Yeah, it's okay. We'll stick to EAC. That's good enough. Okay, sir. So with this, we have done all our normal questions and normal concepts of this topic. Now we will take up some examination questions and what you can expect from this particular topic. It will take another 1 hour. Okay, now another 3 or 4 problems I will take up and take you through how questions from this topic usually comes in examination. 1 minute, I'll see which question can I take or if there is any pending. MIRR we did, no? This also we did. There was one question on EAC. I think you're comfortable with EAC now? Yeah, I think it's there. So I think we can consider it as done, then not done. It's there in your study material also. If you want, you can go through that. This is done. Okay. Now 1 second, I'll give you a quick recap of the things. Not the entire thing, but for the sake of problems. Now we will be using, they will give you a data, okay, relating usually to one project, and they will say this project should be accepted or rejected. That all a decision we need to take, whether project should be accepted or rejected. Sir, if they just ask for the decision rule, always give the decision rule based on NPV. You don't have to calculate IRR, profitability index, just calculate what? NPV, and accordingly give the decision rule. And we know the decision rule. For one project, what is the decision rule? For a single project, what is the decision rule of NPV? If NPV is 0 or greater than 0, meaning if NPV is positive, accept. If NPV is negative, reject. Okay, that's what we have to do. But for the sake of calculation of NPV, we don't need a profit, we need a cash flows. And in all these sort of problems, cash flow data will not be given to you in the problem. They will give you sales, so variable cost, to fixed cost, to etc. etc. That means from the topmost number sales, we need to derive cash flows. That's what I put up a small format for. Anybody remembers that format? Tell me. You start with sales. From sales, reduce variable cost. You will get contribution. Contribution less fixed operating cost will give you EBIT. From EBIT, reduce interest. You will get earnings before tax. Reduce tax. You will get earnings after tax. This is your normal working. Now your cash flow working starts. The first adjustment after earnings after tax. Now, if you want it as a checkpoint, once you get earnings after tax, 5 adjustment you should always remind yourself to consider. One is add back depreciation. Because for tax purpose, depreciation is allowed. Only after reducing depreciation, you will pay tax to the government. But we want cash flow. Did cash go out because of depreciation? No. Hence, the first adjustment you will do is what's that? Add back depreciation. Then you have 4 more. One is your salvage value. Now, what is the salvage value? We'll go for that table now once again. Salvage value means, sir, you're buying a machinery. Machinery will last forever or it lasts only for few years. Let's say you want to buy a new asset. That new asset will last for 5 years. Meaning the useful life of that asset, I've assumed it to be 5 years. After 5 years, what you'll do? Sell off that asset. Let's say if you sell the asset, it is expected to receive 10,000. That 10,000 only, we call it as what's a salvage value. Correct? Now you are working out cash flows for year 1, year 2, year 3, year 4 and year 5. Tell me this salvage value, which year you will consider? All the years or only 1 year? Because this 10,000 you will receive for all the years or only once? Only once. That too when? At the end of the project you will sell the asset. That means this 10,000 will only come in 5th year. Comfortable. So when you are estimating 5th year cash flow, you should consider the salvage value. That is one adjustment. Got it, everybody? Next is working capital. We discussed about working capital. I just told, right? Working capital should be considered. Now, working capital, no sir, and why to write it here? I have already written. For year 0, you take working capital as an outflow. Outflow is denoted by which symbol in here? Negative. At year 0, you consider working capital as a negative. At the end of the project, you consider this as an inflow, meaning positive. The reason is, sir, if I want to, like here, let's say I want to start a new branch in Hyderabad. ArivuPro, we want to start a new branch in Hyderabad. Can we start a new branch only with our laptop or TV, camera, iPad, or we need money for day-to-day business also? We need money for day-to-day business also. That we call it as what, sir? Working capital. The money required for your day-to-day operation is referred to as working capital. So if you want to do a project, you have to invest in your fixed asset also. You have to invest in working capital also. So at the start of the project, you will receive working capital or invest working capital. So that means investment means inflow or outflow. Oh, that's the reason we say at the start of the project, working capital is taken as negative or as an outflow. Understood? Now, once the project is over, whatever money I have spent, I will leave it or I will recover. Now, if I have invested some money for day-to-day operation, means I would like to recover that also. That means at the end of the project, working capital also we will recover. Hence, it becomes what, sir? Positive. Okay, sir, recovery should happen only at the end of the project, sir? No, working capital recovery can happen in first year only, or second year, or 5th year, we don't know. That data will be not given in the question. When the company recovered working capital investment, that information will not be given. Hence, we assume that recovery of working capital has happened at the end of the project. Just a convention, just an assumption. Okay, Saru? So, for working capital for problems, what do we keep in mind? At year 0, outflow. The end of the project, inflow. That's it. Keep this in mind. Salvage value over, working capital over. Can we go for the third one? Third one is opportunity cost. Opportunity cost. What does opportunity cost means? It's a sacrificing cost. It's a sacrificing cost. Meaning, see, here I am teaching. That means I am letting go of my corporate job. See, either I can teach or I can work in corporate. I can't do both because timings will clash. It will not work. Correct or no, sir? Now, if I work in corporate, let's say I get a salary of, let's say, 40 lakh rupees. If I work in some corporate, my annual salary is how much, sir? 40 lakh rupees, let's assume. Because I am in teaching now, this 40 lakh I am getting or going now? This 40 lakh I am getting or sacrificing? This becomes it now. Now, suppose I'm working in corporate. Now I want to shift to teaching field. Will I ignore this or consider this? Now, for think practically, let's assume that I'm working in corporate. I'm earning how much? 40 lakh rupees. Now I thought corporate job is boring. Let me start teaching. Now I will ignore this 40 lakh or consider this for my decision purpose. I will consider, because in my mind it will be there. No, I am leaving corporate job. In teaching, minimum I should earn how much? 40 lakh. Otherwise it will be loss for me. No. I mean, I'm taking the decision ignoring 40 lakh or considering 40 lakh? Considering 40 lakh. Am I getting this 40 lakh or not getting? Not getting. So in accounts, opportunity cost we never consider because it is notional. I'm not receiving anything. But for decision, will you consider opportunity cost? Yes. For FM, opportunity cost should always be considered. But for accounting purpose, opportunity cost is never considered because you don't get this. Comfortable? Yes or no? No. Now, opportunity cost here, it can either be an inflow or it will be an outflow. As simple as that. Now, you tell me, for this 40 lakh, for me, it's an inflow or outflow. What I should consider? I'm in teaching field. So, this 40 lakh rupees I'm sacrificing. That means my income is getting reduced. Sir, if my income is getting reduced, means I can as well treat it as what, sir? Outflow. I can treat it as outflow. Done now. So, opportunity cost can either be outflow or it can be an inflow depending on the information given to you in the question. Understood? It can either be an outflow or it will be an inflow. In this case, in my explanation, for me, opportunity cost is an outflow because my income is reducing. Because I have cancelled my corporate job, I quit my corporate job, one income of 40 lakh which I was getting, now I am not getting. That means there is a loss of income. Loss of income, we are calling it as negative. Because when income reduces, what will happen? Inflow will reduce. Inflow ka reduction, you can indirectly denote it as what? Outflow. Because outflow also you show it in negative number. Reduction in income was also you show it as what? Negative number. Hence, reduction in income we presented in our working note as what's an outflow with a negative sign. So when I do cash flow estimate, I will show this 40 lakh rupees as a positive or negative? Negative. So how many years will you show this? I'll get salary only once or I may get it every year? Every year. That means this 40 lakh I can consider for all the period or maybe only once depending on information given in the question. That depends. You have to read the question and figure that out. Okay, people? Now, one more, I think we have understood this. So one more discussion I'll do and then I'll go into the problem. This opportunity cost from an application is the very next problem we are about to read. Okay, it will come. So far, did we understand? So we discussed depreciation. Then we discussed salvage value. Then we discussed opportunity cost. Then we discussed working capital. The last one is additional working capital or additional investment. Sir, if you do a particular project, should investment always happen at year 0? No. Some project may say 10 lakh rupees we will invest at year 0. Another 2 lakh rupees we have to invest at third year. Possible. Possible. So if they give you that, that is what I mean by what's an additional investment. This again may be there in the problem, it may not be there, we don't know. We have to read the question and figure it out. Okay. Usually investment in majority of the problem will happen at year 0 only. But sometimes the question may say that we need additional working capital investment or some additional investment. If it is there, you need to consider this also. If you are investing means it's an inflow or outflow. That's the reason if you just check the signs, what have I done here? Minus. Then now people, considering all this, you will get the cash flow. But all this cash flow will be represented on what platform? Future value platform. Consider discount factor and consider and find out what? Present value. Find the NPV and accordingly take the decision. This is what we have to do. Can we take up one question now? Great. One second. Now, which question? One second. Navajivini Hospital is considering to purchase a machinery for medical projectional radiography, which is priced at how much? 2 lakh rupees. So if you want to do a particular project, means you have to buy a machinery and it will cost how much? 2 lakh. This is what? Inflow or outflow? Outflow. Life of the machinery is
8 years.
8 years. It has an expected salvage value of 18,000. The moment salvage value comes, what is it? It will come every year or only once. And when is that? In the 8th year. 8th year, you should not forget to consider salvage value. Annual operating cost of the machinery is 22,500. Some repair cost or maintenance cost. It is expected to generate a revenue of 120. Stop there. For all this decision, we need cash flow. But they give cash flow or they give revenue. That means they have given sales. From sales, we need to derive cash flows using our same approach. And 1,20,000 is a cash flow per year for 8 years. That means, should we have to put cash flows for 8 years or can we do only for one column? Sir, if every year ka sales or expense, if it is changing, that means for year 1, year 2, year 3, up to 8 years, we have to calculate the cash flow separately. But here, if you just check from year 1 to year 8, cost is 22,500, revenue is also 1,20,000. You can calculate it 8 times or you can calculate it only once. Answer which way will be same. Done because cash flow every year is same. That is the reason. Presently, check this line. Presently, hospital is outsourcing radiography work. Some probably X-ray machine we want to buy, sir. Currently, we don't have X-ray machinery. So whenever patient comes and says we need X-ray, no, that work X-ray, since we don't, this hospital does not have X-ray machinery. What we are doing is we are outsourcing this to neighboring test center. We are telling, okay, no problem. We are telling the patient, I will get your X-ray, not in my hospital, but in my testing center, in some other neighboring testing center, and it is earning a commission income of how much? 36,000 per annum net of tax. So that means we are not giving the service free of cost. We are telling the testing center, we have a jugaad, adjustment. Hospital is telling the testing center, I will refer the patient. You give me commission. How much commission? 36,000 per annum net of tax. Done. That means till now we used to get this income. Do you agree with me? Till now we used to get this, hospital is getting this income. Agreed? Now, after I buy X-ray machinery, will I outsource this work or I will only do the X-ray? I will only do the X-ray. I will not go to the testing center. Now means if I don't refer patient to testing center, will that testing center give me commission or commission go in the? Commission go in there. That means what will happen? This income till now I was getting. Now I will get a loss. Loss of what? Income. Now you tell me, sir. This only we call it as OC, as in opportunity cost. Consider or ignore? Consider as what? Inflow or outflow? Consider it as an outflow, because an income which we were receiving till now, we will henceforth not reduce. Inflow ka reduction only, you can present it as what's an outflow. How much so? 36,000. And this number is already given on what basis? Net of tax. Always remember, opportunity cost you should take on a net of tax basis. Net of tax means after tax. If they give you before tax, what you will do? You do 1 minus tax rate and get the after tax number. Analyze whether it will be profitable for the hospital to purchase machinery. You have to give the recommendation using NPV method, profitability index method. Consider tax is 30%, PV at 10%. At 10% discount factor they only given. Sir, if they give you discount factor with 3 decimals, you should compulsorily take 3 decimals. Don't go round off. If they don't give, you are free to choose. Maybe 2 decimals, 3 or 4 decimals. If they give you exactly 3 decimals, solve your answer with exactly 3 decimals only. Now, how do we calculate? Tell me, sir. We need cash flow, but they have given sales. So what to do? First working note is to calculate the annual net cash inflow. Should I have to calculate 8 years or not required? Not required, because every year cash flow anyway is same. Okay. Now first we will start with sales. How much is sales are? 1,20,000. From the sales, reduce all the expenses. What and all expense have they given? It's not necessary you have to present it in same format, like sales minus variable cost, contribution and all. Our intention is what? Cash flow. I mean, simply we will do what? Sales and reduce off all the expenses. You don't have to give any name, contribution or EBIT and all, not required. Here what cost we have? Operating cost, how much? 22,500, reduce. That's it, or there is depreciation also? Depreciation. What is the cost of the asset? 2 lakh. How much is the salvage value? 18,000. What is the life of the asset? 8 years. How do you calculate depreciation? Original cost minus salvage value divided by life. Calculate this, how much is it? 22,750. It's a straight line method depreciation. So will it change or same? Same. So where they have told straight line, so if they give you life and if they give you salvage value, we always calculate depreciation using straight line. If it is WDV method of depreciation, question will clearly specify. If there is nothing mentioned, always calculate using the straight line method. So you reduce all the expenses. That's all they gave. So you will get what's it? Profit before tax. How much is the tax rate? 30%. Where is that? Here. Somewhere we saw, no? somewhere tax rate is 30%. So reduce tax at 30%, you'll get earnings after tax till your normal working. From now onwards, investment decisions are working. How many components? 5. First, add back depreciation. How much depreciation you reduce? 20 to 750. Add back 20 to 750. Clear up. Then 4 more. What are those? First, okay, opportunity cost. 1 minute. Okay, no problem. Opportunity cost we can consider. Have they given opportunity cost? Yes. How much is opportunity cost? 36,000. Opportunity cost should always be considered on what basis? Net of tax. Why net of tax? This is what, sir? This is what? Earnings after tax. Tell me if you are comparing some number. One number is after tax. Can you take this number before tax and compare? No. That's the reason we say opportunity cost should always be done on an after tax basis. Because this EAT is on a what basis? After tax basis. Now in this problem, opportunity cost is an inflow or outflow? Outflow. So negative 36,000. Got it? Second component done. Depreciation done. Opportunity cost done. Then salvage value. Salvage value is there? Yes. How much? 18,000. But hang on. What is my heading? Annual net cash inflow. That means I should only consider that component which comes every year. Because I have presented my working note like this. Can I put salvage value into my table now? If you put in here, no, then it is an indication that you are getting salvage value every year. Will you get it? You will get it every year or only once. That means when I put up my NPV calculation, check here I have written 8 and I have written what? Salvage value. Because salvage value comes only once. If I put up cash flow for all the 8 years, then I could have considered my salvage value. But this is the cash flow for what? 1 year, and since all the data is common, I am calculating only once. That's the reason salvage value I will not bring it in here. It should be considered. Not here, I will consider in my table. Understanding? Because if you consider salvage value here, then it will be what? It's an indication that you will get salvage value every year, because this is net cash inflows per annum. Every year from what year to what year? Year 1 to year 8. Will you get salvage value every year for 8 years or only once? Hence we can't. When you present the cash flow in this format, you can't calculate salvage value here. Done, people? Just over. Next is working capital. Have they given working capital anywhere? No. If it is there, what do you have to do? At year 0, outflow. End of the year, inflow. End of the year means can I bring it in here or in my table only? In my table only. Because working capital recovery will happen every year or only once? Once. Like salvage value, even working capital recovery will only happen once. That too at the end of 8th year. If you just check in my NPV calculation, I have written 8 columns too. 1 8 year is for salvage value, another 8 year for working capital. No, not there, just for your reference. Done. Okay, by doing this, how much you going to get every year ka cash inflow, sir? 39,075. This is what, sir? This is positive number. That means 39,075 is the net cash flow you are getting from the project every year from year. First 39,075 you will get at the end of first year. Next 39,000 you will get at the end of second year. That means all these are what? Present value platform or future value platform? That means using discount factor, now we need to find out what? Present value. That is a normal NPV calculation. How do you calculate NPV? Year, cash flow, discount factor. They have given discount factor at what rate? 10%. And present value of cash flows. Since every year ka cash flow, is it different or same? Sir, if it is same, should I have to calculate 8 years or can I use shortcut? Shortcut means PVIF or PVAF? PVAF. Done. So at year 0, how much are you investing? Check how much did you buy the machinery for? 2 lakh. At year 0, you will invest. Outflows 2 lakh. At year 0, PV discount factor is always 1. So present value of cash outflow how much? 2 lakhs. This is your present value of cash inflow. Since it is same every year, we use PVAF. So how much is the present value of cash inflow? 2,08,426. But in this 39,075, 2 components are not considered. What are those? Salvage value, working capital. Because you will get this every year or only once. That's the reason I will consider them separately over here. Salvage value is there over here? Yes. How much? 18,000. 18,000 you will get every year or once? That to which year? 8th year. That means you will take PVAF or PVIF. At the 10%, you will calculate PVIF for 8th year. 1 divided by 1.1, press equals to button 8 times. How much is it? 0.647. This you will get at the end of 8th year. That means this is future value. Multiply discount factor, you will get present value. In this problem, if they are given working capital, two things I would have done. What is that? Year 0, I would have also added working capital. At the end of 8th year, again I will consider working capital. Anyway, not given, but if it is there, means I would have done it like this. Fine. Now what is your final NPV, sir? 16, 832. So what is the decision rule? NPV is 0 or greater than 0 here. NPV is not negative basically. So if NPV is 0 or greater than 0, what is the decision? You can accept the particular project. They not only ask NPV, they also ask profitability index. How do you get profitability index? Present value of cash inflow, that is these two number, and present value of cash outflow, that is this number. Add these two and divide by 2 lakh, you will get profitability index. Profitability index, the decision rule is also same. If it is 1 or greater than 1, accept. If it is lesser than 1, reject. It is greater than 1, so that means the decision rule is what? Accept. These sort of questions usually comes in examination. Manageable. One or two more I will do since I have some time. Done. Based on time, I will decide number of problems. Any doubt? Any question you have so far? Or okay? All right. Next, maybe I'll take up this question. Question number 31. Look at this. XYZ Limited is planning to introduce, pay attention to this one, sir. XYZ is planning to introduce a new project with a life of 8 years. The total life is 8 years. Initial equipment cost is 3.5 crores. Initial equipment cost means this is year 0 ka. So you have to buy a machinery for a particular asset, for this project, which will cost 3.5 crore. Additional equipment costing 25 lakh will have to be purchased at the end of third year. That means here investment is happening only at year 0, or there are additional investment. Additional investment, then it's happening third year. That means this 25 lakh you will consider in which year? Third year, as an inflow or as an outflow? You remember 5 things we discussed? Depreciation, salvage value, opportunity cost, working capital, and additional investment. In this problem, additional investment is also coming in. Comfortable? Okay, next. At the end of 8th year, original equipment is this 3.5 crore. They said it will not have any resale value. No resale value means no salvage value. But additional equipment can be sold for 2.5. That means additional equipment has salvage value. You will get the salvage value every year or only once? When? Which year? End of the project, which is 8th year. That means this 2,50,000 is year 8 ka inflow. Year 8 ka inflow. A working capital. Now good question. Working capital also came off. Yes, now a working capital of 40 lakh will be needed. Sometimes they will give extra information. Sometimes they'll only give this much. I think this is good enough for us. When there is working capital, what do you do, sir? At year 0, you will consider it as an outflow. At the end of the project, which is in this case year 8, you will consider it as an inflow. Yes, sir. How much value? Same amount, 40 lakh. In fact, I've told that also. Check. A working capital of 40 will be needed and it will be released at the end of 8th year. They've given not needed also. The project will be financed with a sufficient amount of equity capital. Or just maybe 1 minute, just out of curiosity. If they say it is released at the end of 5th year, usually I have not seen that question. Suddenly that thought came. If they say working capital of 40 lakh will be needed, but it will be released at the end of 5th year, that means you will consider inflow for 8th year or 5th year? 5th year. Such adjustments till now I have not seen, but I'm just saying, whichever year recovery happens, that year you need to consider. But usually that recovery date will not be given. Hence, what is the normal assumption we make for working capital? It will be recovered at the end of project life. In this case, which year is that? Year 8. Perfect. The sales volume over 8 years have been estimated as follows. The last problem, sale was same every year. Here check, year 1 it is 72,000 units. Year 2 it became 1,08,000. Year 3 260. For 4th year and 5th year 270. 2,70,000 per annum. Meaning year 4 you will sell 2,70,000 units. Year 5 also you will sell 2,70,000. Year 6 180. Year 7 also 180. Year 8 also 180. Like last problem, can we club and find out annual cash flow or separate cash flow? Because sales for each year is different, here we have to calculate the cash flow 8 times. One particular column, and how many columns? 8 year columns. So they have given sales, so we need to arrive a cash flow. I mean, that is one working out. Once you do that, this is become Chintu problem. Okay, now can we do it? Maybe we'll read off more data. This is selling units. How much is selling price per unit? 240. That means easily you can find out sale value. When the numbers are big, present it in lakhs or thousands. I think here the numbers 72,000 if you have to present in lakhs, how much it will be, sir? Can I say 0.72? 72,000 if you have to present in lakhs, it is 0.72. 1,08,000 becomes 1.08 lakhs. This is 2.6 lakh. This is 2.7 and this is 1.8 because you have to fit 9 columns, no, 1 particulars and 8 columns. So if you take full number, no, then you may have some space problem. So work it out by taking hundreds or thousands or lakhs so that numbers become smaller so you can fit in. Dana. Selling price is 240 per unit, variable expense is 60% of sales. So you can find out variable cost. Fixed cash operating cost will be 36 lakh. So fixed cash operating cost means is depreciation included or excluded? Depreciation is excluded. Why? So depreciation is cash expense or non-cash? That means here I can write that this is excluding depreciation because they did not use the word fixed operating cost. They use the word fixed cash operating cost. That means only cash expenses are considered. Depreciation is a non-cash expenditure. So depreciation we need to calculate separately. It's not included. And this is changing every year or same? Same. Loss of any year will be set off from profit of 2 years. So if any year if you get a loss, no, using income tax act provision, you can set off that loss with future year profit. Anyways, if you have not got, I'll tell you that with problem. Company has 30% tax rate. It considers 12% to be appropriate after tax cost of capital. So discount factor is given to be 12%. Company is following straight line method of depre. Calculate NPV of the project and advise the decision. And at 12%, they have only given the discount factors. The whole crux of this problem is calculating the cash flows. If you calculate that properly, remaining is straightforward. Can we quickly review? Like last problem, 2 columns or 9 columns? So start here, check. Working note number 3, present value, or maybe before that, no? For our cash flows, we need depreciation. We need depreciation. Depreciation given? No, we need to calculate. And that too, we have 1 asset or 2 assets? 2 assets. First asset you purchased at year 0. Second investment is happening at the 3rd year. That's what they said, no? 3rd year, right? That's all. The second investment is happening at year 3. That means you will have 1 asset or 2 assets. So calculate depreciation as one working note. First year 1 I have put it as year 0 ka outflow. Why am I put a separate working notice? 2 components are there. What is it? At year 0 mein what and all you are investing. 1 year buying investment worth 3.5 crore. Then there is also working capital. We know working capital initially should be considered as an outflow. At the end of the project we should consider it as an inflow. How much initially you bought the asset for? 3.5 crore. How much working capital? 40 lakh. Add the 2. I'm presenting every number in lakhs. So the total outflow at year 0 is 390 lakhs. Done. Next one, working out for depreciation. For first 3 years, can I say we had only 1 asset? Because second asset you purchased at the end of 3rd year. That means depreciation on second asset will come from year 4 onwards. Yes. So first asset ka original cost how much? 3.5 crore. They told first asset has salvage value or no salvage value. Divided by life. What is life? 8 years. 3.5 crore minus salvage value 0 divided by 8 is a life. You will get how much depreciation? 43.75. So from year 1 to year 3 depreciation is 43.75. Then from year 4 onwards you will get depreciation only on original asset or additional asset? Additional asset. How much did you invest for additional asset? 25 lakh. How much is the salvage value of additional asset they said? 2 lakh 50,000. 25 lakh is the investment, salvage value is 2.5. Now don't take life for 8 years. Total project life is 8 years. You purchased additional asset at the end of 3rd year. That means you can use additional asset only from year 4, year 5, year 6, year 7, year 8. How many years? 5 years. If you can use extra asset only for 5 years means depreciation also you will calculate for 5 years. Hence the denominator here is 5 years. So what is the depreciation on additional equipment? 4.5. That means from year 4 onwards, you will get depreciation on original also, on additional asset also. Put together, how much is it? 48.25. Any doubt? Got it. Now I think we can go ahead with our cash flow working. But we have to do it for all the 8 years. Hence I've started from year 1 and taken it up to year 8. They gave what data in the project? They started from sales. In that too, they did not give sales. They gave units sold. They have given units sold, and what is the selling price of each unit? 240. So how do you get sale value? I'm presenting this in lakhs. 0.72 into 240, how much? 1 or 2 I'll just show you and the things will follow. 0.72 into 240 is how much? 172.8 lakhs. For the second one, it will be 1.08 into 240. How much is that? 259.2. Like that to calculate for all the 8 years. Take the selling price per unit multiplied by the number of units sold. Okay now. Did they give you variable cost? Yes, they told what in the question. Variable cost is 60% of revenue. So that means variable cost is simply 60% of the above number. That is straightforward. Then what information they gave? You don't have to follow the format. Sales minus variable cost is contribution. We want cash flow, right? So go on deducting every expense. You don't have to give any naming for it. Then reduce what's fixed operating cost or fixed cash operating cost. How much is that? 36 lakh per year. Every year this will be 36 only, correct? One more, since they give fixed cash operating cost, this will exclude depreciation. So should we consider depreciation now? Yes. Have we calculated? Yes. From year 1 to year 3 it is 43.75. From year 4 onwards the total depreciation has become 48.25. That's what I've done. So from sales, if you reduce all the expenses, you will get profit before tax. No. 1 minute, everybody listen. Check the first year. You are getting profit before tax positive or negative? Negative. Yes. Now here the two options are permissible. Some problems when they will tell, see, you have learnt it in your tax that if you have any loss, you can set it off with the future profit. Here in this problem, have they mentioned? Maybe we do. Loss of any year will be set off from profit of the subsequent 2 years. Now, if you get any year loss, you can carry this forward for how many years as per question? 2 years. Now, here what will happen is, sir, if you have a profit, you will pay tax to the government. If you have loss, will you pay tax to the government? No. That year tax will be how much? 0. Next year, no, you will not pay tax on 23.93. Previous year you made a loss. Set off that loss from 23.93, adjust 10.63. How much remains? 13 point some number. You multiply by 30%. On that number, calculate 30%. How much are you getting? 3.9. That's how tax will be calculated. Comfortable now? Okay. Now, the year you make loss, that year you don't pay any tax. So the tax will be how much? 0. Future year you will not pay tax. Next year you will not pay tax on 23.93. Last year there was a loss, no? First adjust this loss. From 23.93 adjust 10.63. All of you do if you're confused. 23.93 minus 10.63 you do. How much are you getting? 13.63. For second year you will pay tax on 13.63. Multiplied by 30% you do. How much is that? 3.3. This we call it a set off of loss. So if any year if you get a loss, you can carry it forward and adjust it against future. All this more detail you'll learn in income tax. Understood? So is any loss pending to be adjusted or fully adjusted? Fully adjusted. That means from year 3 onwards, any drama or normal? Normal. So third year, take 169.85, multiply 30%. How much are you going to get? 50.955. Take 174.95, multiply 30%. You will get 52.48. Like this, it will go on. Done, people? Now suppose there is another way this question usually they will ask. Okay. One is, they will not give anything about set off. They will not mention anything about set off. In this problem, what did they tell? Loss can be carried forward for how many years? 2 years, and you can set off. Like that they mention. In some problem, they will not mention that. If they don't mention, what usually RTP MTP question does is, okay, since they have not mentioned anything about set off, no, take the benefit due to loss. You check here, due to loss, your future tax is same or it is getting reduced. See, for first year, did you calculate tax on 23.93 or you adjusted the loss? You adjusted the loss. That means due to this loss, future tax amount is getting reduced. That means, can I say on loss you are getting tax benefit? On profit you pay tax. On loss you will get tax benefit. Like depreciation. On depreciation we get tax benefit. On interest we get tax benefit. Same like that, on interest we get tax benefit. If they don't mention anything about set off, what you do is calculate 10.63 ka 30% you calculate. How much is that? All of you, quickly tell me. 10.63 ka 30% is how much? 3.18. I'll take it as 1.8. So maybe 1.89. If they don't mention anything about set off, you will get, on loss you get tax benefit. Take the benefit that year only. Take the benefit that year. Which year loss you got? First year. So first year only, right? Instead of writing 0, write off 3.18. Done. Now tax you will pay. Tax you will pay. That means inflow or outflow. Tax amount normally you pay to the government. So it is inflow or outflow. Outflow. This 3.89 you are paying tax or getting benefit. That means you will show this as negative or positive now. Understood? Yes, sir. These are the two ways this tax adjustment can come in the question. One adjustment, they will say you can carry it forward for few years. In that case, what do you do? In the year of loss, make the tax to be 0 and adjust that loss in the future years. That is one approach. If they don't mention anything about set off, then the year you make loss, that year only you take off the tax benefit. Calculate 30% or this ka 30% and write that number as negative or positive number. Positive number, because on loss you get tax benefit, and in these problems benefit you represent a negative number or positive number. Positive number. Understood both approaches? Working. That's all is one of the highlight of this question. So from earnings before tax, if you reduce tax, what are you going to get? Earnings after tax. Now 5 components, 5 adjustments. What are those? Add back depreciation. You already have depreciation here. Add back all the depreciation. Then what's salvage value? Salvage value you will get every year or only once? Only one. That too on original equipment or only new equipment? Additional equipment. What is additional equipment? The salvage value? 2.5 lakhs. When will this come? Year end of the project. Here end of the project is 8th year. I've considered salvage value. 2 components done. Next, opportunity cost given? No. That means opportunity cost is 0. Opportunity cost can be inflow also, can be outflow also. Hence I've written plus minus here. It depends on the information given. Then working capital there. Yes. For year 0 working capital I've already considered in this working note. That's all will come, or one more adjustment. Initially working capital will be treated as an outflow. At the end of the project you will treat this as an inflow. The end of the project means year 8. In year 8 you will take working capital as a positive number 40. Done now. One more, which is what? Additional investment. Here do we have any additional investment? Yes. We did purchase an additional asset. No. When did we buy that additional asset? We invested how much? Additional equipment of 25 lakh will be purchased at the end of 3rd year. That means in 3rd year you will get an extra outflow in the form of 25 lakhs. Got it up? Every year or only once? Only once. Which year? 3rd year. Now 3rd year check, have I taken 25 lakh here? Yeah. Cash outflow 25 lakh. Outflow means we present this as a negative number. Do all this number, you will get respective years ka annual cash flows. But this cash flow of 33.12 you will get at the end of 1st year. This 63.69 you will get at the end of 2nd year. That means all these are there on which platform? Future value platform. Now you can take this data and put up NPV calculation in a table like the way you used to do it. Or here only you can find out present value. Because anyway cash flow is there. To get present value, what is the only component we need to consider? Cash flow is one component, another one is discount factor. So here only put up discount factor. That means you don't have to put up extra table again, saving time. If you want, you can take this number and do separate NPV calculation and a new table again. That is also fine, but that is a wastage of time. Here you anyway have cash flow. Take discount factor here only. So what will you get? All these are what, by the way? All these are cash inflows for respective years. So that means you will get only by what I have written here. Present value of cash inflows. By adding all this, you will get what? Total present value of cash inflows. Not at all. Yes. But for NPV, I need only inflow or outflow also. But in outflow ka present value should we calculate, or outflow happens at year 0? At year 0, total outflow is nothing but present value. I mean, straight away we can calculate NPV. How do we calculate NPV? Present value of cash inflow, we got it here. Adding up, how much is that? 551.127. Minus present value of cash outflow. We already done year 0 ka outflow. How much is that? 390. Reduce that. Inflow ka present value this much. Outflow ka present value that much. So NPV is positive. NPV is positive means reject the accept the project. That's all is this question all about. Okay, Saru. Any problem, sir? EB? Which one? Instead of 10.63, it is 210 negative. And then you will have to carry. Someone is saying, sir, if this is 210 negative, what to do? Now, carry forward the loss. This one, in this problem, you can carry forward the loss for how many years? 2 years. I mean, this year you will make the tax to be 0. Next year you will adjust. But we have 210 loss, but amount is only 23.93. That means you can adjust what, sir? Only 23.93. So second year tax payable also is 0. So in 210, how much got adjusted? 23.93. How much loss still is yet to be adjusted? Do 210 minus 23.93. 186 point something. But you have 186 or only 169. That means you can adjust only 169, and the tax payable for third year also 0. The question clearly told you can carry the forward loss only for 2 years. If you are not able to utilize within 2 years, go in. After that, no drama. Next, third year onwards, normal. 174.95 ka 30%. Okay, because question ka clear requirement is you can carry it forward only for 2 years. If you are able to utilize the loss within 2 years, awesome. If you are not able to utilize, it will get lapsed. Nothing can be done. Good question. Now, that's what the question will mention that. Okay, if the question does not, someone is saying, sir, if the question says loss cannot be carried forward. If loss cannot be carried forward means in that year directly you can write 0, because will you get benefit or no benefit? No. If the question says loss cannot be carried forward, the year you make loss directly write 0. Next year should you have to worry about set off drama or no set off? Because question is saying what? Loss cannot be carried forward. In that case, you will calculate next year 23.93 ka 30%. Like that. That is rare, but it can come. Usually in many 2018-19 questions, they used to ask such adjustment. Possible. Done. 1 minute. I'll take you through replacement decision also. Wait. I'll take you through one question on that also. No need to worry. Okay, thank you, Anjana. She has sent some LDR question in the YouTube live chat. So if you want, you can take up all the chapters. The LDR question which I had referred it in my regular class. A person has pulled up. You can take on YouTube. You can take a screenshot and refer. Fine. Anyways, thank you for that. So can I move forward? Yes, Aru? Or anything else? No. I'll do one more question maybe. Okay, no, we have time. Okay. Sir, I will take up this Paramartha Limited. This is a question which came in MTP September 2024 for 8 marker. Now, this one concept is there called depreciation. Okay, that I'll explain through this particular question. So pay attention to this. That will be one of the highlight of this question. Maybe first I'll tell you the concept. Sir, now we consider depreciation. Why, sir? Initially we reduce depreciation, then we add back depreciation. Correct? Why do we reduce depreciation? Because depreciation is an expense which is allowed for tax purpose. Correct? That means on depreciation, can I say you will get tax benefit? On depreciation, you will get tax benefit. Okay. Then, if since I'm considering depreciation for my working, because on depreciation I get the tax benefit. Now they tell you in the problem in accounts I am following straight line method. For tax purpose, we are following WDV method. Like this, some adjustments some question will have. You tell me for your now NPV calculation, you will consider accounts ka depreciation or tax ka depreciation. You will take depreciation as per accounts or tax? Tax. Why? First of all, why are you considering depreciation in this chapter? Because on depreciation, you get a tax benefit. The reason for considering depreciation is the tax benefit. So is accounts depreciation relevant to us or irrelevant? What we want is what, sir? Depreciation as per income tax. And income tax is suggesting which method? WDV. In fact, Income Tax Act says that every company should follow WDV method only. Certain exceptional units like power generating units and all can go for straight line method. Otherwise, majority of the organization has to follow WDV method. Now, your Income Tax Act says, this is not your FM provision, this is your Income Tax Act provision. What it says is, if you are following WDV method, no, depreciation as per WDV method works on something called block basis. It works on a block basis. Block means a group of asset which has similar characteristics. Like if you have three furnitures, all three put together become one block. Three furniture will become one block. If you have, let's say, 4 plant and machinery, all the 4 put together will become your block number 2, like this. A group of assets which has similar characteristic, we call it as block. Now what Income Tax Act says is, you will charge a depreciation as long as the block exists. Till the time block is there, you can go on charging depreciation. If the block comes to an end, if the block exists means what you can do? You can calculate depreciation as usual, no problem. But if the block comes to an end, if the block ceases to exist means depreciation or no depreciation? No depreciation. That is what Income Tax Act of 1961 suggests as per the block method. What is it once again? Till the time block is there, depreciation also will go on continuing. If block comes to an end, then depreciation also will come to an end. So block continuing means what? Block means what's a group of assets. So if you have at least one asset in the block, means block continues. If you have at least one, here you have 3 furniture, no? Suppose 2 is sold off, 2 I sold off, still 1 is there. Even if still 1 is there, block also will still continue. Here I have, how many missionaries I have? 4 missionaries. All the 4 I sold off. All the 4 I sold. That means block there or block gone. As long as the asset, even if one asset is there in the block, block will continue. If all the assets in the block are sold off, means the block will come to an end. Understood? Again, not FM concept, but basically your income tax concept, but it is relevant for FM. That's the reason giving a quick 2 minutes discussion. Done now. So again, what is the final point? As long as the block continues, depreciation also will continue. If block comes to an end, means depreciation also will come to an end. Done now. Now, how do you calculate depreciation? Let's maybe, or is it okay if I calculate with the help of this number only? Would you be fine instead of making another example? Can we learn through this? Okay. I'll do a thing. Maybe I'll take up one smaller. Is it okay if I take another 20-25 minutes? There are 2 questions on this block. If you're comfortable, I'll go through all the 4. All the 2. It'll take another 20-25 minutes. If you're okay. If you feel fed up to boring, I'll do one and I'll move on. Both or one? Both. They're not answering only. Yeah, you don't know, you understand. This question number 22. We will learn depreciation concept. This is a simpler question. We will learn depreciation with the help of this concept. Once again, if you want, we can apply it in the next question. Check this. HMR is considering replacing a manually operated old machine with a fully automated new machine. This we call it as replacement decision. We have an existing asset. It has become old. Now we want to replace this with a new asset. This we call it as replacement decisions. Now whenever they give you replacement decisions, you calculate NPV on an incremental basis. You calculate NPV on an incremental basis. Meaning, one way to calculate is, now you have one asset or 2 assets. We have old machinery and we have a new machinery. One way to calculate is calculate NPV of old machinery separately, calculate NPV of new machinery separately. Let's say NPV of old machinery is 10 lakh, NPV of new machinery is 11 lakh. Then you can take the decision. What is the decision? Since new machinery is giving higher NPV, you go ahead with a new machinery. This is your normal approach. But if you follow this approach, you have to solve the problem twice. Once for old machinery, once for new machinery. We will not be following this because all our ICA solutions here are based on incremental approach. In incremental approach, what do we need is, for calculating NPV, what do we need? Cash flows. Incremental means extra. Incremental means extra. Okay. What they will do is, they will give you sales. They will not give you cash flow in these problems. They will start from sales. We don't need sales. We need a cash flow. Suppose old machinery generates a sale of 50 lakh. New machinery gives you a sales of 25 lakh. In incremental approach, everything you should take on an extra basis. Instead of sales, you will take extra sales. Instead of variable cost, you will take extra variable cost. Instead of fixed cost, you will take extra fixed cost. Like this. Instead of cash flow, we want extra cash flow. Instead of NPV, we want extra NPV. That is all simply incremental approach. Got it? That means for our NPV calculation, we will take 50 lakhs? No. We will take 75 lakhs? No. Compared to old machinery, new machinery is giving how much extra sales? 25 lakh. How did we get this? 75 lakh minus 50 lakh. Now we will put only extra numbers. So we will get what? Extra cash flow. That means we will get extra NPV. If that extra NPV is positive, accept. Otherwise, reject. Like that is your incremental approach. Got it? Move on. Check this. The old machinery has been fully depreciated for tax purpose. So 1 second. If it is fully depreciated for tax purpose, means what is WDV of the machinery as per tax? It's fully depreciated. That means WDV is 0. It's fully depreciated. Correct? No? But it has a book value of 2,40,000. Just now they said fully depreciated. Now they are saying WDV 2,40,000. It is fully depreciated for tax purpose. Means as per tax record, WDV is how much? 0. Depreciation in accounts and depreciation in tax are completely different. Accounts depreciation is based on Companies Act, Accounting Standard 10 ka provisions. Income Tax Act depreciation is as per Income Tax Act of 1961 provision. Both are completely different. Okay. So Here, what have they given book value? You know, this is as per accounts. Now you tell me, for our FM, we need accounts ka depreciation or tax ka. And as per tax, do we have any WDV or full gone? Full gone. That means, is this relevant or irrelevant? That is just given for us to deviate. We will not get deviated. That 240 number is dead to us. It is not there for us because that is as per accounts. We want as per tax. The mission has begun causing problems with the breakdown, and it cannot fetch more than 30,000 if sold in the market immediately. 1 minute. If you sell this old machinery now, it will fetch you how much? 30,000. It will have no realizable value after 10 years. If you continue to use it for 10 more years, just old machinery ka salvage value is zero. The company has been offered 1 lakh for the old machinery as a trade-in for the new machinery. Now, normally that's what we do, no? We do exchange system. When we have to buy a new asset, old asset we exchange and buy a new asset. So, because we are doing exchange, that vendor is saying, if you give old asset to me, I will take the value of old asset to be 1 lakh. Good deal, no? Because currently market value of that old asset is only 30, but vendor is giving how much? 1 lakh. That means we will sell it outside or this vendor only? Vendor only. As a trade-in for new machinery, which has a price before trade-in, how much? 4,50,000. The new asset actual value is 4,50,000. Should we have to pay 450 to the new vendor? No. 1 lakh he will adjust from the old asset. That means balance we have to pay only how much? 3.5 lakh rupees because we are doing a barter or exchange system. The life of the new machinery is 10 years. Salvage value is 35,000. Do not forget, the moment salvage value comes, end of the project, you should consider. Furthermore, company follows straight line method. I don't need that. I need what is the method you are following for tax purpose. Because your accounts is also there, tax is also there. But for tax purpose, WDV method is relevant. Now you tell me, straight line method relevant or irrelevant? Irrelevant. Because we want depreciation as per tax. And tax allows SLM method or WDV. And have they given the rate? Yes, they have given the rate of depreciation to be 7.5%. Yes, sir, people. And considering that this is the only mission in the block. You had old asset. Only one asset was there in the block. That old asset gone, is there no or gone? But instead of old, what came? New came. So block now has ceased to an end or it is still there? Still there. But you will use new asset for how many years? 10 years. After 10 years, what will happen? The block will come to an end because old also gone, new also gone. That means at the end of 10th year, the block will cease to exist. Understanding of in that year we have to do something. I will tell you what to do. Understanding of, in fact, in this problem nothing needs to be done. But anyways, given below are the expected sale from both old and new. Now we want the total or incremental? Incremental. But just check, one good thing is sales or material cost to labor cost to variable overhead, fixed overhead, same different every year or same every year? Given below are expected sale and cost from the old and new machinery, meaning every year this data is changing or same? Because this is the data not for 1 year, sir. This is the data for how many years? 10 years. Every year you will get the same sales, same cost. That means should you have to calculate the cash flow 10 years separately or we can do only once? You know, we do it. But depreciation will change, no, sir. Because depreciation, which method? WDV method. WDV method means you will get same depreciation every year or different? That means now you have to calculate the cash flow for 10 years. One particular column plus 10 years column. Totally how many columns? 11 columns. So how to fit in exam? You can use 2 sheets. 2 sheets and you can write it, fit it vertically, whatever you're comfortable, do it, but you have to do it. Okay. Alright. Now, one component. Depreciation they have given. Is this depreciation relevant for me or dead for me? Why? Because this is depreciation as per accounts. Because, yes, no people, because see here they have told depreciation every year is what? 24,000. WDV method will give you same depreciation every year. Which method gives you same depreciation every year? Straight line. And you are following straight line method where? In accounts. Is that relevant or not relevant? They have found out profit before tax by considering tax depreciation or accounts depreciation. Because profit before tax is a number from accounts only, no? So they have reduced accounts depreciation, but we don't need accounts depreciation. We want tax depreciation. That means in this one more adjustment you have to do. Whatever depreciation they have reduced, first we need to add back. Then you deduct what? Correct depreciation as per tax. And the tax depreciation will not be same every year, it will be. That means you can't put 1 column, you have to compulsorily put 11 columns. Easy but lengthy. Easy but lengthy. Got it? Now I'll show you the working. I don't have time to run through solving will take minimum 1 hour this. Okay. I'll quickly run through. Tax rate is given. Check this. Analyze whether old machinery should be replaced or not. Ignore capital gain tax. Ignore capital gain tax. So you have to do something called capital gain. But in this problem, they have asked us to ignore. Okay, I'll tell you what, if they don't tell ignore what to do also, I'll tell. So maybe we learn our entire concept with this problem only. So that next problem may not be required, it's the same. So that we'll try to learn this. So first, how depreciation works. Let's understand this. And this is as per Income Tax Act, nothing with accounts, nothing with FM. How Income Tax Act suggests there is, first, do you know the WDV? Listen everyone, this one, I don't know how much of it you remember. So I'll try to be a little more clear, a little slower on this. First, we need depreciation as per accounts or tax? What is the WDV of the existing machinery as per tax? 0. Why 0? Because they told in the question asset is fully depreciated. If asset is fully depreciated means WDV is how much? 0. Correct? Any problem? No. Tax base of the existing machinery is how much? 0. Tax base means on what component you calculate depreciation. On what value you calculate depreciation, we call it as tax base. Tax base here is 0. Why 0? Because as per tax, asset is any which way fully depreciated. That means any more depreciation can you claim on old asset or nothing allowed? That means the tax base of old machinery is also how much, sir? 0. Any doubt till here? Any doubt till here? Okay. Okay. Now, old asset you are giving away. Is new asset coming in? Yes. Now, normally what do you do, sir? In accounts, now what do you do? How much you are purchasing new asset for? 4,50,000. That means you will calculate depreciation directly on 450. But tax, it doesn't work like that. How tax ka block method works is, first to take WDV of existing machinery. How much is that? 0. From this, is old machinery there or it is sold off? Is old machinery there or you are selling off? Selling off. How much are you selling old machinery for? The company has been offered how much for the old machinery? 1 lakh. Reduce the sale value from the WDV. How much is WDV? 0. How much is the sale value? 1 lakh. Reduce. How much are you getting? Negative 1 lakh. To this you add the cost of new asset. What is the cost of new asset? 4,50,000. Now you will get depreciation base for the new machinery. This is how you calculate when you sell an asset. Now first what you have to do is take the WDV of asset sold. From that reduce salvage value. Then you add what? Cost of the new asset. Whatever value you get here, how much value you are getting? 3,50,000. On this 3,50,000 you will calculate depreciation on new machinery. Understanding or got it once more. Now, once more, tell me what is it. Once more. Okay, I'll make another example. Let's say WDV of old asset is 1 lakh. Assumption. And we're building another example. WDV of old asset is how much? 1 lakh. In this problem, it is actually 0. I'm taking another example. Now, this asset there or it's sold off? Or maybe I'll make this, instead of 1 lakh, I'll make this as, let's say 20,000. Okay. Now, reduce the sale value. What is the sale value of old asset? We will use this information. What is the sale value of old asset? 1 lakh. Correct? Huh? Now you are trying to calculate on new machinery how much depreciation you will charge. On new machinery, how much depreciation you will charge. You will not calculate depreciation straight away on new asset cost. First you have to do is, first take old asset ka WDV. Because depreciation as per tax is not on asset, it's on the block. It's on the block. That means we don't want asset value, we want block value. How much was the block value before? 20,000. But this block there, you sold it. You sold it for how much? 1 lakh. Reduce that. That's it. Or new asset came in the block. So new asset came in the block for some value. Add it. So that we call it as cost of new asset. How much is the cost of new asset? 4,50,000. I mean, what is the block value now? You had a value of 20. You sold out that block for 1 lakh. Now a new asset came in the block with how much cost? 450. Now means how much is the block value? 3,70,000. Now you will start charging depreciation on 3,70,000. This is how block method works. Understood? If you don't want so much drama, simple ways, WDV of old asset minus salvage value, add cost of new asset. That will give you what, sir? Block ka value for the new asset. You will charge depreciation on new asset how much? 3,50,000. Okay, now, so on what value you are calculating depreciation, that we call it as what? Depreciation base. Now onwards you will start depreciating or calculating depreciation on what value? 3,50,000. If you had old asset, what was the depreciation base? 0, because it is already fully depreciated. But because of new asset, how much depreciation you can charge? 3,50,000. That means, are you getting extra depreciation? Do not forget, we are working using what approach? Total approach or extra approach? Your old depreciation base was 0. Your new depreciation base is how much? 350. How much extra you are getting? From 0 you are getting 350. So how much extra? 3,50,000 extra. This we call it as what? Incremental depreciation base. Every number we want incremental. Every number we want incremental. Old asset ka depreciation base was 0. New ka is how much? 350. That means how much extra depreciation base you got? 350. That only we call it as incremental depreciation base. Easy, people. Pakka. Pakka. Okay. Now, if you just check, only one culprit is there which we're feeling very bad. That is depreciation. Only that the data now is changing every year. Rest every data was same. Correct? No. That means what I'll do is, instead of finding profit before tax, first I will find profit before depreciation. Shortcut way, a presentation. You can choose to ignore this also or follow this. Your call. I'll find profit before depreciation. Because why am I doing this? Only one component in this is changing every year, which is what? Depreciation. The rest everything is what? Same. So first let's find out profit before depreciation. Okay now? And should I take this depreciation or I should ignore? Ignore. Why? Because this depreciation is as per SLM. So from here, in fact, you don't have to rework again. How much is profit after deducting depreciation? 3,24,750. Can we consider this depreciation or we have to recalculate? Because this depreciation is as per SLM. We want depreciation as per tax, which suggests which method? WD. But they have already reduced 24,000. So what do you do? Add. These two you add back. Quickly do it. 3 lakh? 48,750. Similarly, you do here also. These two you add back. 42875 correct. See, that's what I've done over here. First, I've calculated earnings before depreciation. Okay, the profit as given I've taken. They've already reduced depreciation. I've added back. That's the number you're getting. Now we want this profit or we want incremental. You want extra. Old asset used to give me profit before depreciation 348. New is giving me 428. So compared to old, new is giving how much extra? 80,000 profit extra every year. Every year. This way, now in my cash flow, when I put up my cash flow here, I'll show you also. I will not calculate sales gains and all from the beginning. Directly, I'll start with earnings before depreciation. Shortcut. If you don't do this, every data you have to copy again and again for 8 years. By doing this, I can reduce my efforts a little bit. Understanding, got it or what it. So what did I do? Just quickly tell me once again here. What did we do? Only one number was changing, which was depreciation. Hence, we found out what? Profit before depreciation. But in the question, after deducting depreciation, they had given profit. Hence, what do we do? Added back. I added back these two numbers and we worked out that. We call it as earnings before depreciation. Old asset costs this much, new asset costs this much. Now, under this incremental approach, we don't want old car, we want new car. We want what? Extra. So, old is giving 348, new is giving 428. Compared to old, new is giving how much extra? 80,000. This is what? This is what? Earnings before depreciation. Will this number change for 10 years or same every year? Same every year. Only one component will change, which is depreciation. That is what I'm about to do the next. Is it okay? Since depreciation changes every year, we need to calculate depreciation. We want depreciation or extra depreciation. That means will we take depreciation base or incremental depreciation base? Incremental depreciation base. Yes, sir. This is a block. Old had a block of only how much? 0. New has how much block value? 350. Compared to old, new has how much extra block? 3. Oh yeah, we have to do A minus B. That's what I've written here. See, B minus A. Okay. A ka value is 0. That's the reason clearly I've given. A ka depreciation base is 0. New ka depreciation base is 350. From 350 reduce 0. That's what I've written here as B minus A. You will get extra incremental depreciation base called 350. Now on this, go on calculating depreciation. But unfortunately, depreciation value will go on changing. So opening balance how much? 350. How much is the rate of depreciation? They told as per income tax 7.5%. Calculate. So one I'll show, that's it. 3,50,000 into 7.5% you do. You'll get 26,250. This is your opening balance. After reducing depreciation, you'll get what? Closing balance. First year ka closing will become second year ka opening. Now on this opening, calculate 7.5%. You'll get the value. Like that you calculate for how many years? 10 years. Lengthy but easy. Okay now. Just you need to practice all this. Now when I say maybe you will get it, or sometimes you may feel that you are not getting it. Sit through, revise, you will get it. Or ideally you should practice all this. Now this is the depreciation every year from year 1 to year 10. Depreciation or extra depreciation? Extra depreciation. Do you know extra earnings? Yeah, we already found out that. How much is the extra earnings before depreciation every year? 80,000. So in this 80,000 is depreciation considered or not yet? Not yet. So reduce depreciation or incremental depreciation? Incremental depreciation, which you got it from year 1 to year 10, this number. Copy this number, that's what I've done. Yes, sir, people? So from profit before depreciation, if you reduce depreciation, you will get profit before tax. Now about same working. From that reduce tax, you will get earnings after tax. Now 5 components here same, which is add back, incremental depreciation, which is there, then salvage value. Salvage value Allah, incremental salvage value. How much new asset ka salvage value? So new asset ka salvage value is 35,000. Old asset, if you use it for 10 more years, they told its salvage value after 10 years is 0. New asset ka salvage value after 10 years is 35,000. Old asset ka salvage value after 10 years is 0. So how much is incremental salvage value? 35,000. That's what I've written clearly over here. Yes, sir. That's the reason 35,000 minus 0 I've written. This salvage value will come every year or only once? Which year? End of 10th year we have to consider. Then working capital not there. Additional investment not there. Okay now. Then this is all your cash inflows. Multiply discount factor. You will get present value of cash inflow. From that reduce present value of cash outflow. What is present value of cash outflow here? Sir, how much what is the value of new asset? 4.5 lakh. But should you have to pay cash of 4.5 lakh, or vendor is saying 1 lakh I will deduct from old asset? 1 lakh from old asset. So at year 0, how much to buy you have to spend? Only 3.5 lakh. This is your present value of cash inflow. This is your present value of cash outflow. That means you will get NPV. You will get extra NPV called incremental NPV. How much is that? 44,671. So if incremental NPV is positive, go ahead and accept the project. Otherwise, reject. Yes, sir. Comfortable. Paka. There is one adjustment which we had to do, but question said not required. Only that I will tell, so that this problem only will become full-fledged for us. And all this drama will only come if you are following WDV method of depreciation. Because on straight line method, there is no block concept. There is asset to asset depreciation. Okay. So all this drama will only come for, remember, only for WDV. Now what is that extra fitting is? I think I've solved that. 1 second, hang on. Here, block. Now, one working note we need to put up when they say block ceases to exist. In this problem, block there or block gone? Block gone. Check, sir. Maybe once again I'll tell you. Year 0 mein, in this block mein, how many assets you had? You had one asset called old asset. Is that old asset there or old asset gone? Gone. But it's same year 0, new asset came in. That means block ceases or block continues? Block, I'll write here, block continues. Correct? Old asset is gone. Instead of old asset, new asset has come. So that means a block continues. No. Will this new asset last forever? No. It lasts for how many years? 10 years. In the end of 10th year, what will you do for this new asset? You will sell. The new asset means there or new asset gone now? New asset is gone means now at the end of 10th year, block there or block endo? Block ending. Correct? Now whenever block ends, Income Tax Act suggests that you'll have to do a few things. Okay, actually IT Act suggests slightly different thing, but our material is slightly doing different thing. Forget about income tax, we will follow what is required for exam marks here. Okay, now what you have to do is, first, this which year, when is the block coming to an end? 10th year. That means all this drama will only come in which year? 10th year. That's what I've written here. Block ceases to exist. Which year again here? Year 10. First, to find out the WDV of the asset, of which asset now? 10th year, old asset will be there or new asset will be there? New asset. That your previous working note will give you. See, year 1, 2, 3, year 10 is there over here. What is the closing balance of the new asset at the end of 10th year? 160,504. Any problem? Take the WDV of the new asset. For which year? When the block comes to an end. Here block is coming to an end on which year? 10th year. Take that WDV. From previous working note, you will get it. You can give the references working note number 2. Okay, now compare this with salvage value. Are you at the end of 10th year, are you keeping the asset, new asset, or selling it off? What is the salvage value of the new asset? 35,000. Very simple. Worth of the asset. WDV means worth of the asset. What is the worth of the asset? 1,60,000. How much did you sell it for? 35. Happy face or sad face? Sad face. Why? 1,60,000 was the worth of the asset. You sold it only for 35. That means you made a bumper loss. Correct? No. When the block ceases to when block ceases to exist, no, you will get short-term capital gain or short-term capital loss. One gain or loss you will get. That gain or loss, Income Tax Act calls it a short-term gain or short-term capital gain or short-term capital loss. So 160 worth of asset you sold it for 130 or at a 35. That means it's a what? Short-term capital loss. How much? 125. Now you know. Just now we discussed on loss you pay tax or you get tax benefit. Perfect. On loss you will get tax benefit. Tax benefit means outflow or inflow. Inflow. Which year? Block comes to an end that year. Which year is that? 10th year you have to take this number. Normally they will give you capital gain ka tax rate is 20%, 10%. Like that they will give you a different tax rate. If they don't give normal tax rate, you can take. What is the normal tax rate in this problem? 30%. Calculate 30% of this. How much is it? 37,651. This much you don't have to pay tax. You will get to the benefit. Getting the benefit means is an outflow or inflow. Which year? Year 10. Now we have calculated inflow here now. In this column, one more cash flow will come component here called short term or tax benefit due to what? Short-term capital loss. Every year, 10th year. 10th year. How much is the value? 35 or 37? 37,651. What? Oh, correct number. 37,651. This will come. So why you didn't do in this problem? Because question told to consider this capital gain or ignore. If they had not told ignore, I would have done this. That's what happens in next problem. You got the funda. This is what I wanted to explain the next problem, but I hope you got it. This is good enough, no? Okay, tell me quickly recap once again. What is it? This you will do only when what's it? Block ceases to exist. Block ceases to exist means block has come to an end. In that case, now what do you do? Take the WDV of the asset at the end of 10th year. Actually, Income Tax Act suggests slightly different. Don't compare. Don't say Dilip sir taught something and doing this. Okay, this is wrong only. But our books are doing this. For FM marks, do this only. Don't change it. Don't say I am wrong or he is wrong. He is right as per Income Tax Act. I am right as per FM. Both are right as per the sake of marks. Follow this only. Do not change. Don't compare with this income tax and say he taught rubbish. I am not teaching rubbish. This is what our ICA has done currently. Okay, follow this only. First take WDV at the end of 10th year. Compare this with what? Salvage value. So WDV is the worth of the asset. Compare it with salvage value. If you have sold it at higher price, you have made a gain. If you have sold it at lower price, you made a loss. On loss, you get the tax benefit. On gain, you have to pay tax. Can we redraft one scenario with gain? Because next problem is on gain scenario. Okay. So gain scenario, when it will come? Let's say WDV of the asset is sale 1,60,504. Sale value, no. So let's assume salvage value to be 2 lakh. Now you tell me 160 is the worth of the asset you sold it for 2 lakh. Now it is loss of gain. We call this as what? Short term capital gain. How much is this? 39,496. Sir, on gain, will you get tax benefit or you have to pay tax? Paying tax means inflow or outflow? Outflow. Calculate. 39,496 ka 30%. 39,496 ka 30%. How much? 11,848. This 11,848, when you're working cash flow workings, 10th year, you should consider this as an outflow because you are paying tax. On loss, it's an inflow because you get tax benefit. On gain, you have to pay tax, so it will become an outflow. That's it. Manageable. Now, this is the concept. But all this drama will only come in the block ceases to exist. And mind you, whenever they say this problem, they will not give you tax rate 30%. They'll give you 2 tax rates. If you want, maybe I'll show you that problem once. 1 minute. Check. We'll not solve, but we'll quickly review. Check here. Normal tax rate is how much? But capital gain tax rate is 20%. I mean, now when you calculate capital gain, no, don't apply 25%. Take 20%. But for normal tax, take 25%. If you want, you can go through this MTP September 2024 question. That's the difference. Understood this? I think that's good enough. Yeah, we have spent quite a few time on this. So with this, our investment decision topic finally has come to an end. Thank you. Let's take about how much break you want, sir? 1 hour, right? I think we will take about 15 minutes is good enough. No? Not enough. 20 minutes you want. Okay. So let's take about 20 minutes break. We'll come back and then we will take up the next smaller topic. Thank you. I had this stream on this week. Thank you. I had this stream. It was very nice. Thank you. But it's too much now. Yeah.
ஃபோன் பேச முடியாது அங்க போய் என்ன எனக்கு என்னன்னு சொல்லிட்டு போங்கக்கா எனக்கு ஒரு வழி சொல்லிட்டு போங்க இல்ல மச்சான் நான் ஏற்கனவே கேட்டிருக்கேன்
தெரியும்டா சொன்னான்
பாரு வந்திருக்காங்க
ஆமா ஆமா
Hello? எனக்கு தெரிஞ்சு இன்னைக்கு இன்வெஸ்ட்மெண்ட் டிசிஷன் Kasi yung ano dyan mo. Nagdalian mo ako. Kaya lang.
Hi guys, it's me again, Christopher from ArivuPro. I know this you are seeing it for many times, but it's my duty to say it again and again. You have chosen your professional course journey with us, ArivuPro Academy. In this journey, you will be facing a lot of challenges. How to do a registration, how to book an exam, sir, where to find the study material, how to download the study material, how to watch the recorded classes, how to attend the live online classes. You will have so many queries. But you have one answer only. Please drop a mail or raise a ticket to help@arivupro.com. This is the fastest and effective way to get your support. Right? When you are dropping a mail, please keep in mind, enter your phone number, enter your name, what is the issue, and the screenshots if possible. Message or mail us with some details. We'll get back to you, call you, solve the issue. And if you see, these are the stats which you can see on the screen. Tickets will be coming for my backend team like this, appearing on the screen. And we reply and solve the student's issue. And we call them, and everything is done in a very streamlined manner. Our average response time is 2 to 3 hours. Right? And our resolution, we solve the issue at least within 5 hours on average. But we want to solve all the issues at least by 24 hours. Right? To support you, please support us by dropping a mail at help@arivupro.com. A disclaimer, please do not contact the nearby office boy or the person who is setting up the laptop or a person who is
Yes, people, all of us are back. Can we start? Can we start the next session? No problem. Well, hello people, welcome back after the break. So next we shall be starting with new topic, that is financial analysis and planning, that is ratio analysis. Okay, an easy chapter. There are about few ratios you need to remember the way to calculate those ratios. Usually they ask a fill in the blanks type of questions from this particular topic, meaning they will give you some data, some components will be missing, we need to find out that. First of all, ratio means simply take one number in the numerator and one number in the denominator. It is just a mathematical expression of a numerator divided by denominator. But the problem is, or the thing you need to keep in mind is, you can't take any random number. Like, can you compare GP with current liability? Can you compare GP with current liability? Are they related or unrelated? So ratio always works with a related number. If you are taking one number in the numerator, it's a related number only you should take in the denominator. Like GP is expressed on sales. Sales and GP are connected. So that should be the numerator and denominator. Unrelated variables you should not consider. That is what. Now, why do we calculate ratio is, with the help of ratios, you will be able to identify the strength and weaknesses of the company. Whether the company is doing good or bad, you will be able to identify. That's one of the reasons the ratios we calculate. Okay. So let's do a thing. First, let's quickly run through all the ratios, how to calculate them. Then we will take up few questions, and that's how we're going to cover this particular topic. Is my voice okay? Feeling a little continuous speaking, no? Gets a little daunting at times. Okay. Now, what? I didn't understand. What I've been drinking only. Continuous. No, we're not used to speaking marathon. We have to take continuous, right? So sometimes it gets you. It's okay, no problem. Tomorrow off, huh? I will off and I'll go to Bangalore. Okay, tomorrow I'm traveling back. Anyways, first set of ratio is liquidity ratios. There are broadly few ratios: liquidity ratios, efficiency ratios, etc., etc. You don't have to remember the category. You just need to know weights calculation. First is current ratio. Current ratio is given by current assets divided by current liability. Ideal number is 2. This ratio is trying to measure whether we have enough balance or enough investment in current asset using which we can settle current liabilities. Next is quick ratio or asset test ratio, sometimes also known as liquidity ratio. Given by, instead of current assets, you take quick assets divided by current liability. And how do you get quick assets? Quick asset is nothing but your current assets minus your inventory minus your prepaid expenses. Usually prepaid expenses will not be given. So in this case, quick asset is given by current assets minus inventory divided by current liability. So we are trying to ascertain or find out whether we have enough balance in quick assets through which we can settle current liability. Next is cash ratio. In cash ratio, it's given by the formula. This ratio is trying to ascertain whether we have enough balance in cash through which we can settle current liability. And cash here refers to cash in hand, cash at bank, as well as short-term investments. So numerator will be cash in hand, cash at bank plus short-term investment that they refer to as marketable securities divided by current liabilities. Okay. Next is basic defense interval ratio. This ratio is trying to test if it's a doomsday, meaning if revenue of the company stops, then how many days can business survive? If the revenue of the company completely stops, how many days can the business survive? All right. So that is given by the formula. Same. What is the previous one formula? cash in hand plus cash at bank plus marketable securities. Here we add one more called net receivables divided by operating expense per day. It's like this. Let us say our operating expense for whole year is 365 lakhs. In a year, how many days are there? 365 days. That means, can you tell me what is operating expense per day? 365 lakh. 365 lakh is for 365 days. For one day, how much is it? 1 lakh. Okay. Suppose I have a cash balance of 25 lakhs. Cash in hand, cash at bank, marketable security plus my debtor put together is how much? 25 lakh. How many days can I survive? My expense every day is how much? 1 lakh. I have how much with me? 25 lakh. How many days can I survive? 25 days. That's all is basic defense interval ratio is trying to calculate. So how do you get this as formula? Cash in hand, cash at bank plus marketable security plus net receivable divided by operating expense per day. That's what they're calling it over here. Operating expense divided by number of days. If you do, automatically you will get what? Operating expense per day. Again, all these are not that very important. Whatever is important, I'll tell you in exam what usually comes. Net working capital. How do you get net working capital? Current assets minus current liability. These are your some liquidity ratio. Okay. Next, equity ratio. These are all some capital structure ratio. First capital structure ratio is equity ratio. Equity ratio is trying to measure of your capital employed. How much money has come through equity? You need funds, no? The fund can be arranged through equity share capital or through retained earnings or through debt or through preference shares. Equity ratio is trying to calculate among your funds how much money came through equity. Equity here refers to not equity share capital. Equity here refers to equity share capital and retained earnings, or you can also call it as reserves and surplus. Okay. So that means the formula for equity ratio will be equity divided by capital employed. And how do you get equity? Equity share capital plus reserves and surplus divided by capital employed. There are some different names for this. Instead of equity, you can call it as shareholders equity. Instead of equity, you can call it as shareholders equity, or sometimes it is also referred to as net worth. Same name. Equity or shareholders equity are also denoted or also called by net worth. Capital employed is also called as net assets. Another name, that's it. Okay, na sir? So basically, how much money has come through equity is what we are trying to measure. Similar way, debt ratio. How do you get debt ratio? Of your total capital employed, how much money has come through? Debt. So that means the total debt divided by total capital employed. Either you can write capital employed or you can write net assets. It's okay. Then debt to equity ratio. This ratio is trying to measure the relationship between debt and equity, because this is one of the industry norms. Usually when people invest in the company, they check debt equity ratio. The industry norms for majority of the company is 2:1. Meaning if you have taken 1 rupee equity, maximum debt company should have is 2 rupees, not more than that. More than that signifies that business is very risky. Many people, investors, stay away from such companies. Hence, this is quite popular since we're saying. So, debt equity ratio is given by the formula debt divided by equity. Okay, now usually in the numerator, don't take total debt for our problems. No, we take long-term debt for problems. Actually, the ratio says total debt divided by total equity, but for our problems, we don't take total debt. We take the long-term debt. Usually question will specify. If they don't specify, also take it as long-term debt divided by equity. Equity ka another name is what? Shareholders fund. No, you can call it as shareholders equity or net worth. Okay, debt to total asset ratio. Debt to total asset ratio is trying to measure. Name itself formula. Name only formula is there. Debt to total assets. So formula is what? Total debt divided by total assets. This ratio is trying to measure how much money or how much debt you have used to buy your assets. To buy assets, you need money. Money can come either from equity or through preference shares or through debt. This ratio is trying to measure how much money has come through debt. Because the debt is risky, no? If you're using debt and buying an asset, suppose you don't pay bank interest, what will bank people do? They will take off that asset because that asset will be given as security, no? So that's what this ratio is usually trying to measure there. Capital gearing ratio. Of late, I've seen 1 or 2 questions from this, so this could be considered as important. Capital gearing ratio. So capital gearing ratio is trying to calculate, or capital gearing means what? When we say put gear in car or gear in bike, we want to go slow or fast? Fast. Gearing means to go on high speed. So what capital gearing ratio is trying to signify is, we studied this as trading on equity, remember? yesterday. Leverage, we studied leverage or somewhere we studied trading on equity. Trading on equity means what? Using fixed cost instrument to increase the return of the equity shareholders, I tell. That's the same way as capital gearing ratio. Capital gearing ratio is trying to measure. You basically use a fixed cost instrument to increase equity shareholders ka return. You want to use fixed cost instrument to increase shareholders return. How? Yesterday I gave you an example. Remember? Sales is, let's say, 10 lakh. Current year, let's say interest is 1 lakh. That means how much sales minus interest is how much, sir? 9 lakh rupees. Let's say no other expenses there. That means this becomes profit before tax. Next year, sales became, let's say, 60 lakh. Will interest also increase or it will be same? That means how much will be a profit before tax? What happened? Let's say tax is not there. That means PBT only will become EAT, and preference dividend is not there, means EAT only will become EASH. So you used a fixed cost instrument and your EASH from 9 lakh because of that became 59 lakh. So that means you are using fixed cost instrument because the interest on them is the fixed. Later on, when you start earning higher profit, equity shareholders will get higher returns. Understood? That is what is capital gearing ratio means. You want to use a fixed cost instrument so that the return for equity shareholders will be on the higher side. That is what is capital gearing ratio. Now tell me, sir, how do you get capital gearing ratio formula? Capital gearing means using fixed cost instrument. Which instrument have fixed cost? Preference shares and debt. That is your numerator. Preference share capital and debt divided by denominator. Whose return you want to increase? Equity shareholders. That only you call it as equity, because what and all belongs to equity shareholders? Equity share capital and reserves and surplus. That means the denominator you can call it as equity share capital plus reserves and surplus, or you can call it as equity, you can call it as shareholders equity, or you can simply call it as net worth. Fine, okay with this? Of late, 1 or 2 questions I've seen on capital gearing ratio come in the examination, so be a little careful on that. Move on. Proprietary ratio. This also is used a few times in problems. Proprietary ratio means how much proprietary funds is used to buy assets. How much proprietary funds is used to buy assets. Sir, what is proprietary funds? Proprietary means owner. Who are owners of the company? Shareholders. Who are shareholders? Equity shareholders and preference shareholders. Now that way calculate how do you get proprietary fund. What belongs to equity shareholders? Equity share capital and reserves and surplus. What belongs to preference shareholders? Preference share capital. Adding these three, you get proprietary funds. Okay, now. So this ratio is trying to calculate again how much proprietary fund is used to buy total assets. Hence, proprietary ratio is given by the formula what? Proprietary funds divided by total assets. And this is how you calculate proprietary funds. Okay, G. There is one more way you can express proprietary funds. I'll tell you that in the problem. Okay, G. Any doubts, sir? Whether net asset and you're saying net asset or capital employed and PF is it same? No, sir. Because in net assets, no, you take fixed asset, you take current asset, and you reduce current liability. Debt is not included. Okay, so here we get, excluded there. That's the reason. And yeah, actually you can, no, that number will get excluded. No, it will not be same in that case. Because the way of calculating will be different. You put a balance sheet if you're confused there. Okay, when you put a balance sheet, you have equity share capital here. Then you have, let's say, reserves and surplus. Then we have preference share capital. Then we have debt. All this becomes your capital employed. Yeah, okay, now here is your current liability, then is your FA, and then in your CA. Let's assume some random numbers. This is 10 lakh, this is 2 lakh. So total will be how much? 12 lakh. Here also it will be how much? 12 lakh. Okay. Now let's assume this to be 1 lakh. That means all this 3 should become 11. Maybe I'll make this as 3, I'll make this as 2, then I'll make this as 1. So 3, 5, 6, 7. So that means there should be 4. Comfortable with some random numbers. How do you get proprietary funds? These 3 ka addition. So 3 lakh plus 2 lakh plus 1 lakh. It will be how much? 6 lakh. Okay, now how do you get net assets? Net asset is your capital employed. How much is your capital employed? Add all this. How much is it? 3 plus 2, 5. 5 plus 1, 6. 6 plus, rather 5, 6. 6 plus 4 is 10. Same or different? Okay. If debt is not there, then your statement will work out. If debt is not there, then proprietary fund and capital employed will be same. Okay, G. Can I move forward? Everybody good? Any problem? No? I will use the same table and also tell you one more way to calculate the proprietary fund that I'll tell you in problem. First, let's quickly revise the ratios once. Next is, this is okay, not that importantly, interest coverage ratio. Interest coverage ratio. Interest coverage ratio is trying to measure how much profit you have to pay off interest. Interest coverage ratio is given by the formula. You want to know the profit before interest. Before interest, what profit you get? EBIT. So interest coverage ratio is given by the formula EBIT divided by interest. Let's say EBIT is a 10 lakh. Interest is 1 lakh. So how much is this? How much is coverage ratio? 10. That means whatever indication is, company has profit using which they can pay the interest 10 times. Company has enough profit to pay the interest 10 times. So coverage ratio and all, who will keep in mind? Debt people, because who will get the interest? The providers of debt finance. So they will watch out for this. They want this number to be low or very high. The higher this number, they will have a sigh of relief. That company has enough profit so that they will not default our interest. So coverage ratio should be ideally on the higher side. Done, people? Okay. Similar to interest coverage ratio, can you calculate preference dividend coverage ratio? See, interest coverage ratio, how did you calculate? EBIT divided by interest. Preference dividend coverage ratio, can I take EBIT? Using EBIT, can I pay preference dividend, or with what I will pay preference dividend? Earnings after tax. So you will take EAT or PAT. There it was divided by interest. Here it will be what? Divided by preference dividend. Done now. Similarly, can you also calculate equity dividend coverage ratio? Is profit after tax available for equity shareholders, or what is available? Each or net income. So the numerator will be each or net income divided by total equity dividend. That will give you equity dividend coverage ratio. Any problem so far? This is not required. It's okay. Leave. Now this is quite important in almost every ratio question. This efficiency ratios, no, 2 or 3 efficiency ratios will 100% be there in majority of ratio questions. So this I would probably put it on the rated on the higher side. Excuse me. Now, efficiency ratio is trying to measure how efficiently you are using the components. It could be assets, it could be capital, whatever. First, total asset turnover ratio. Total asset turnover ratio. One simple way. I mean, look at the name and tell me what is the formula according to you. Total asset turnover ratio. Turnover means sales. Looking at the name of the definition, what according to you should be the formula? Total asset is coming first, turnover is coming next. That means ideally the formula should be assets, total assets divided by total sales. Correct now. This should be the way it looks like, but hang on. Now, sir, this is an efficiency ratio. So this ratio is trying to measure how efficiently you are using the assets. How efficiently you are using the assets. Let us say total assets is 1 lakh. Okay. Sales is 1,50,000. Calculate this for me. Let's see. Total asset, I've assumed it to be 1 lakh. Total sales is 1,50,000. How much you going to get? 0.67. That means for one, so this is the right indication. Huh? No, sir, by using asset, you want to generate lower sale or higher sale? Higher sale. Hence, the formula for any turnover ratio is, the formula is the sales should come in numerator. Sales should come in the numerator. So what is the formula? Now reconstruct for me. Total asset turnover ratio is given by the formula. Sales divided by total assets. Now calculate this. What is sales? 1,50,000. What is total assets? 1 lakh. How much are you getting? 1.5. This is efficiency ratio. This ratio is trying to measure how efficiently you are using your assets. How efficiently you are using your assets. It means if you buy asset worth 1 rupee, that asset will give you a generator revenue of 1.5. For 1 rupee investment in asset, you are getting a revenue of 1.5. So you want this number to be on the lower side or higher side? Higher this number, more efficiently the companies are using their assets. Hence, to get the right conclusions, we put sales in the numerator, other component in the denominator. Otherwise, it looks like 0.67. Somebody looks at 0.67 and says, 1 rupee investment in asset, we are only getting 0.67 revenue. Is that say or ulta? That's the reason we put this formula in ulta fashion. Okay, that's the reason. And for any turnover ratio, sales will come in the numerator, other component will come in the denominator. So suppose sales is not missing means, if sales is missing means next preference you give it to COGS. First priority always to sales. Sales missing, then you will take COGS. And in the denominator, I have written total assets. But what is the formula here say? Average. So for all these efficiency ratios, no, priority is average. Priority is average. But to calculate average, we need 1 year data or 2 years data. 2 years data. Correct? Now you need opening balance as well as closing balance to calculate average. Suppose opening balance not given. Can you calculate average? If you are able to calculate average, then calculate average. Otherwise, take what, sir? Closing balance of assets. Preference is average. If you are not able to calculate average, or if average is not given, then take what? Closing balance. They'll only give you 1 year data in majority of the problems. So we can't calculate average. We will take the closing balance of assets. Understood? This goes for every efficiency ratio. Oh, done? Can I move on to the next one? Next one is fixed asset turnover ratio. You construct the formula for me. Let's see. Fixed asset turnover ratio is given by turnover or sales divided by average fixed asset first priority. Missing means fixed asset, the closing balance, or simply you can write fixed assets. And if sale is missing means next priority to COGS, like that. Done. Capital turnover ratio. Capital turnover ratio is given with the formula turnover divided by net assets or capital employed. Now, this ratio is trying to measure how efficiently are you using your capital. How efficiently are you raising the money and utilizing that money to generate revenue. Done. Working capital turnover ratio is given by the formula sales divided by working capital. So this ratio signifies how efficiently you are using your working capital. Inventory turnover ratio. Don't look at the formula. Tell me inventory turnover ratio. Ideally, what should be the formula? Sales divided by average inventory. Otherwise closing stock of inventory. Correct? But 1 second. Sir, inventory you have done. Inventory is valued at selling price or cost price? Inventory is valued at selling price or cost price? Cost price. That means which is a better? See, ratio analysis is one related number in the numerator divided by related number in the denominator. If inventory is valued at cost price, can your denominator be sales? Now, which is the best preferred then? COGS. For inventory turnover ratio, first preference is COGS. If COGS is missing, then we will take a what? Sales. Or if question says it takes sales, then only we will take sales. Otherwise, first priority always to what? COGS. Divided by either average inventory if you are able to calculate, otherwise take closing stock. Done. Now, one more information you can find out called inventory velocity. Inventory velocity. Sir, velocity means, in fact, maybe I'll tell you this. Inventory turnover ratio, let's say, is 6. Inventory turnover ratio is 6. What it means is, if you get inventory turnover ratio is 6, what it means is 6 times in a year you are able to sell your inventory. You are able to sell your inventory in the current year 6 times. That's what inventory turnover ratio signifies. Okay. 6 times in a year if you are selling inventory means on an average how many months are you holding your inventory? 6 times you are selling the inventory in a year. How many months are there? 12. You are selling the inventory how many times? 6 times. So how many on an average how many months you are holding inventory? 2 months. That holding period, no, we call it as inventory velocity. Inventory velocity. Tell me the formula. You did 12 by 6. What is this 12? 12 months divided by 6. What is the 6? Inventory turnover ratio. Tell me the formula again. Inventory velocity is given by the formula 12 divided by inventory turnover ratio. Sir, I want it in days. Then don't take 12. Take what? 365. So inventory velocity is given by the formula 12/365. If you want it in weeks, you will take 52 divided by ITR. ITR is in inventory turnover ratio. This will give you inventory velocity or average holding period of inventory. Move on to the next. So far good. Okay, next is debtor turnover ratio. Tell me, sir, debtor turnover ratio. So sales, the numerator, debtors will arise due to total sales or credit sales. So that means will you take total sales in the numerator or credit sales? Credit sales in the numerator divided by average debtor if it is available. Otherwise, closing debtors. If sales is missing, then you can go for COGS. Yes, no, here actually all this because data will never not arise used because of COGS. They will give you the information. Don't need to. Done, people. So credit sales are divided by average accounts receivable. Accounts receivable, sir, is not just debtors, it is debtors and bill receivable put together. So this debtor turnover ratio considers both debtor as well as bill receivable. In majority of the problem, bill receivable will not be given. So that's the reason we say accounts receivable and debtors are same. But in some problem or in any problem, if they give bill receivable, be careful. I'll take you go through one question in that regard. Okay. All right. Now similarly, tell me how do you calculate debtors velocity? We calculated inventory velocity. In the same way, tell me what is debtor velocity ka formula? 12, 365 or 52 divided by debtors turnover ratio. I can call it as a DTR. So 12, 365 or 52 divided by DTR. If you do, you will get debtors velocity, meaning debtors ka collection period. Debtors ka collection period. Next is payable turnover ratio. Tell me, sir, what is the formula? Payable turnover ratio. Will you take turnover? Payable turnover ratio means payable is related to creditors. Creditor and sale, any connection or no connection? So instead of sales, what will you take in the numerator? Purchases. Annual and which purchase? Total purchase or credit purchase? Total credit purchases divided by average accounts payable if it is available. Otherwise, you take closing balance of accounts payable. Accounts payable means creditors and bills payable put together. But in majority of the problems, bills payable data will not be given. Okay. Similarly, can you calculate payable velocity? Payable velocity. How do you calculate payable velocity? 12, 365, 52 divided by payable turnover ratio. Awesome. These are the turnover ratio. 3-4 of them usually comes in the questions, which we don't know, they keep changing, but these are quite popular. Yes, people. So this is, you are comfortable with the next set of ratio. Profitability ratio. GP ratio is given by the formula. GP upon sales into 100. Net profit ratio is given by the formula. Net profit divided by sales into 100. Operating profit. Operating profit only we call it as EBIT. Operating profit ratio is given by the formula. EBIT upon sales into 100. Next, COGS ratio. COGS ratio means COGS divided by sales into 100. What percentage of sales is COGS is what you are trying to measure. Operating expense ratio means administrative expenses, selling and distribution expense put together. Those two, if you add, we call it as operating expense. That ratio we want. How do you calculate that? Operating expense divided by sales into 100, or selling and distribution expense plus administrative expense divided by sales into 100. Next one is operating ratio, not operating expense ratio, operating ratio. Meaning this ratio is trying to calculate to generate revenue. What is the total operating expense you need to incur? To generate 1 rupee revenue, totally how much operating expenditure we need to incur. So to generate revenue, you will incur only operating expenditure or even COGS. COGS. Sales minus COGS will give you GP. GP minus fixed operating cost will give you EBIT. Correct, no sir? So operating ratio is given by the formula COGS plus operating expense divided by sales into 100. One of the previous examination question used this operating ratio. Okay. So basically again, what is that? Operating ratio is trying to measure what? What percentage of COGS and operating expense is related to sales. Suppose you got, or 1 minute, if I tell you operating ratio is 85%, that means what, sir? That means what? COGS plus operating expense is equal to 85% of sales. The COGS and operating expense put together is 85% of sales. Yes. So from sales, if you reduce COGS and if you reduce operating expense, what are you going to get? EBIT. So if these two are 85% of sales, means indirectly EBIT will be 15% of sales. This is what they used in May 2024 paper or something. The same equation. Same. They gave you operating ratio and they mentioned this. We have to solve this. Everyone, I hope got it. Yes, sir. Okay. Financial expense ratio. How do you get financial expense ratio? Financial expenses divided by sales into 100. Okay. Then return. some profitability ratios relating to return. Return on investment you leave. There are three types of returns usually. One is ROCE, we already know. Return on capital employed. Then return on equity. Then return on assets. These are the three returns. First, you already know. Tell me, sir, how do you get ROCE? Return on capital employed. EBIT divided by capital employed into 100. That is your ROCE. Sometimes they will say calculate ROCE on an after-tax basis. Calculate ROCE on an after-tax or post-tax basis. So in this case, what do you do? Will you take EBIT? No. You will do EBIT into 1 minus tax rate. When you do 1 minus tax rate, you will get after tax. So EBIT into 1 minus tax rate divided by capital employed into 100 if you do, you will get ROCE on an after-tax basis. Now return on equity. Can I take EBIT for return on equity? Is EBIT available for equity shareholders or what is available? Each. So the numerator will be net income or each. Divided by what? Can you take capital employed or equity? So the formula will be what here, sir? You can take net income or you can take each. Divided by what? You can call it as equity or you can call it as net worth or simply it is calculated by equity share capital plus reserves. If you do this, you will get return on equity. Return usually is expressed in percentage, so we multiplied by 100. This is your ROCE and this is your return on equity. Next is your return on assets. Return on assets. There are two ways to calculate return on assets. One, you can take profit after tax divided by total assets. If you know and if you can find out average assets, good. If average asset is missing means take the total assets. So one formula to get return on asset is take profit after tax divided by total assets. That is one. Another way to calculate is sometimes you can use a debt fund also to buy asset. Hence we calculate one more way to calculate return on asset is EBIT into 1 minus tax rate divided by average total assets or total assets depending on the case. Okay. So which one to use in exam, sir? Sir, this one, second one is more popular. If they ask you to directly in the question to find return on assets, use this as what I would suggest. Meaning EBIT into 1 minus tax rate divided by total assets. Suppose they ask you EPS in the problem. They ask you EPS. To find EPS, first we need profit after tax. Which formula in this gives you profit after tax? The first one. Yes or no? So if you want to find out profit after tax, then you won't use this formula, use that formula. Sometimes, as I said, the ratio question will be missing. Fill in the blanks wala question. Many data will be missing. If you want to find out that, then use the first formula. If they ask you to calculate return on assets specifically in the question, calculate this. This is more popular. Both are acceptable, but ICA uses this more predominantly. Fine now. Guys, so can I move forward? Understanding these are all some returns or profitability ratio. Next, you already know EPS. How do you calculate EPS? Each divided by number of equity shares. How do you calculate dividend per share? Dividend per share. Total dividend divided by total number of equity shares. Correct now. Next is a dividend payout ratio. So payout ratio is always expressed on EPS. Any payout ratio is expressed on EPS. So dividend payout ratio is given by the formula dividend per share divided by earnings per share. Always remember payout is always on EPS. So DPS divided by EPS if you do, it's like this. Suppose company earned 10 rupees. Out of earnings they are paying a dividend of 4. That means what is this number? 0.4 or 40%. Basically 40% of the earning company is paying out as dividend. That is what dividend payout ratio is trying to express. How much percentage of earnings company is distributing away as dividend. Good, sir. Okay. Price earning multiple. How do you get P multiple? You already applied this. How do you get P ratio? MPS divided by EPS. If you do that, you will get the price earning multiple. Okay. Alright. Dividend yield. A simple way to remember is whenever you see the word yield, right? NPS should come in the denominator. Whenever you see the word yield, denominator will come as what? NPS. So dividend yield is given by the formula DPS divided by NPS. Earnings yield is given by the formula EPS divided by NPS. So it's like this. Let's say market price of the share is 100 rupees. A share currently is trading in the market at 100. One company in the current year, they gave a dividend of 10 rupees. Dividend is a return for shareholder, no? Dividend is a return for shareholder. Can you tell me what is the return percentage? Shareholder, to buy the share, he is investing 100 rupees. And one share, he got a dividend of 10 rupees. So how much is the return for shareholder? 10%. How did you calculate that? 10 divided by 100 into 100 you did, you got 10%. Express this in formula. What is this 10? Dividend per share. What is this 100? Market price per share. To get percentage, we multiply 100. Yes, sir, people. That is nothing but your dividend yield. Hence, I said any yield, if they ask, always put in the denominator NPS. Good. Yes, sir. Next, market value book value ratio, not that important, but in the name only ratio is there. Market value book value ratio. So it's given with the formula market value divided by book value per share. Something I pulled. Oh, 1 second. 1 second. I think George may pulled out this. I think now it's back. It's fine, no? So here also it's good enough. Okay, this is done. Next, Q ratio. Again, not that very important, but quickly we'll review. Q ratio is given by the formula market value of equity and liabilities divided by replacement cost of asset. Market value of equity and liabilities divided by replacement cost of asset. So they did one study through Q ratio. Basically, every asset at some point of time you need to replace. To replace the asset, you need money. Where will that money will come from? Equity or liabilities. Liability means what's a debt, whether long term or short term. Correct? No, you will take a short term loan and buy some asset, or you will take a long term loan and buy some asset, or you will take equity or preference shares and buy some assets. So what they did a study is usually asset ka replacement cost and market value of equity liability should be same. If it is same, they say if Q ratio is basically 1 means they say share is the share ka price. If it is, it's at a fair valuation. It's valued properly. If Q ratio, if you calculate this market value of equity and liabilities divided by replacement cost of asset, if you calculate this ratio and if you get a number greater than 1, then the asset ka stock, the company ka stock price is overvalued. If Q ratio is lesser than 1, then the share price is undervalued. That is a study. Just know this in case they ask as an MCQ question any chance. But I have not seen this coming in any problems so far till now. Done, Azaru. Last ratio, then we will take up some problems. Next is the dew point model. Dew point model law is little crazy. Why? Sir, one person, I think, I don't know the for some name, I forgot the name now. Okay. As per dew point model, no, you will calculate the same ratio, but not using one component, but using more than one component, meaning rows. Yeah, this is added newly. It is added newly. Or it's there in the new material. Maybe you have old material. In this batch, I added this. Okay, dew point model. Using dew point model, we can calculate rows. So, what is the normal formula to calculate rows? Normal way to calculate rows. EBIT divided by capital employed. Our dew point sir doesn't like this model. Sir is using different way to get the same answer. Finally, how do you want rows? You tell me. To calculate rows, what do we need? EBIT divided by capital employed. As per dew point model, you can calculate rows by like this. First, take operating profit margin. Operating profit margin. It's all written here. You don't have to write it down. Just listen. Operating profit margin multiplied by capital turnover ratio. Here only is there. No, here only name is saying. This is the rows. No. How do you remember? This O for operating profit margin. C for capital turnover ratio. Capital turnover ratio. So if you take operating profit margin and if you multiply capital turnover ratio, you will still get what, sir? Rows. How? How do you get operating profit margin? EBIT divided by sales. How do you get capital turnover ratio? Sales divided by capital here means capital employed. This sales or that sales you will get cut off. What remains? EBIT divided by capital. You got the same answer. But you are not going like this. You are going like this. Okay, now that's what is dew point model. Instead of calculating the answer straightforward, maybe you are using multiple ratios to calculate the same answer. Understood? One or two times I've seen this also asked in the previous year paper. 2 marker or something started asking this. Done, sir. This is using dew point model to calculate rows. Similarly, you can also use dew point model to calculate return on equity. So to calculate return on equity, what do you need, sir, essentially? How do you get return on equity? Return on equity. Can you take EBIT or EASH? EASH divided by what? Equity. You can call it as equity or shareholders equity, or you can call it as net worth, whatever. Now using dew point model, if you have to calculate return on equity, it's a multiplication of 3 things. One, there you took operating profit margin. No? Here you will take the shareholders. No, shareholder means end point. So it will be net profit margin. Take net profit margin multiplied by the asset turnover ratio multiplied by equity multiplier. 3 things you need to multiply, and you need to remember this. Okay. One is net profit margin, then multiplied by asset turnover ratio multiplied by equity multiplier. It's very simple. How do you just see? Equity multiplier, what it is, you will only know. How do you calculate net profit margin? Net profit divided by sales. How do you get asset turnover ratio? Sales divided by total assets. 1 second. You need what number for return on equity? We need EASH, we need equity. Okay. Sir, anyway, in these sort of problems, net profit means profit after tax. In these sort of problems, preference shares will not be there. If preference shares is not there, net profit itself becomes EASH. Net profit itself becomes EASH. So EASH, have you got it? Yes. We need what? Equity. But here sales is there. See here. This sales to that sales are cut. Okay. That means you are left with total assets. We want total assets or we want equity. Now you tell me, how do you get equity multiplier? Equity multiplier is nothing but total assets divided by equity. So if you do, ultimately this sales will be cut. This asset will be cut. What remains? Net profit divided by equity. Net profit is nothing but profit after tax. If you don't have preference shares, then profit after tax in each will be same. You will get the same answer. But you are getting the same answer not directly, but by using 3 components. What are the 3 components? Net profit margin multiplied by asset turnover ratio multiplied by equity multiplied. That's all. This data will be given to you in the question. You just need to multiply and get return on equity. Let me give you all this as a 2 marker MCQs and test. So with this, all the ratio concept we have done. Now we'll have to go through some questions. Based on the time we will see, we'll work out few questions and then we will say bye bye for today. Okay, now today I'll leave you a lot early. Just a minute. Sir, what does operating profit include? Operating profit, no macha, is like this. From sales, if you reduce variable cost, you get contribution. From contribution, if you reduce fixed operating cost, you will get EBIT. This only we call it as operating profit. This only we call it as operating profit. Now operating expense means to run the business, you will have some administrative expense. Like for us, receptionist salary and all, that becomes your one part of operating expense. And also to run the business, you also need some salesmen and all. To salesmen, you will have some selling expenses or marketing expense. That becomes your selling and distribution expense. These 2 expenses, if you add, that we call it as operating expense. Now operating ratio means the total expense you will incur, the total operating expense overall you will incur to generate a revenue. To generate revenue, you have to incur some direct cost also, which will be captured in COGS. And you will have to also incur some operating expense. This is the difference. Okay, now, I think you will respond later. I've told the answer. Great. Now let's go over this question. Sir, majorly the way they ask the ratio question is, they'll give you some data, they will give you some ratios, and they will ask you to construct income statement and balance sheet. Some data will be given, some data will be missing. We need to fill out those data. I will work out few problems so you'll get a basic idea. Now check this. From the following information of Lakshmi Private Limited, prepare summarized balance sheet. So in this problem, we need to prepare balance sheet. Net working capital is given. Okay. So one quick point is whenever they give you net working capital, so usually they will also give you current ratio. Usually they will also give you current ratio because this is a good combination. Check, is it available? Net working capital is here, current ratio is here. These two we will use. How I'll tell you. Always watch out for this. There is one combo. There are 2-3 combo questions here. One combo is this. Okay. Bank overdraft will come under where? Current liability. Fixed assets to proprietary ratio. We know already proprietary ratio. How do you calculate? For proprietary ratio, we need proprietor funds. One way to calculate proprietary fund is what, sir? Equity share capital plus reserves and surplus plus preference share capital. This is one way. There is another way which I'll prove it to you and use it over here. Done. Next is reserves and surplus 3,20,000. Current ratio 2.5. Liquid ratio is 1.5. The moment you see liquid ratio and current ratios, you will be able to find out closing stock. Be aware of this. Okay, liquid ratio and current ratio, the moment they give, that is an indication that you can find out closing stock. How I will show you. This is again a good combo. So in this question, 2 combos we have seen. Net working capital and current ratio, and current asset and liquid ratio. Using this, you will be usually able to find out closing stock. Or if closing stock is given, you will be able to find out current assets. We will see. Now, what you normally do is when they ask you to prepare balance sheet P&L and all, have the format of P&L and have the format of balance sheet ready. And whatever data they have given, first insert that. Now, they ask balance sheet only over here. Let's prepare balance sheet. So here I have already prepared. First, whatever data is given, update. Any balance sheet data given? Yes. Working capital. Or rather, they given bank. Working capital will not come in balance sheet. What will come in balance sheet? Current assets separately, current liability separately. Bank overdraft is there. Okay. Now, bank overdraft will come where? Under current liabilities. And always use this approach when you are doing balance sheet. Have one inner column and have one outer column. This will help you to figure out few things faster. Why? I'll tell you in a bit. Okay. All the components of current liability you write in the inner column. Total current liability you write it on the outer column. This is a better approach. Why? First, let me do on this problem. That way you will understand. Now, first. Bank overdraft. How much is bank overdraft? 80,000. Put it in the inner column because we will show what in the outer column total. So bank overdraft 80,000 you write in the inner column. This is done as and when I find, I'll put off a tick. Yes. Let it be. Anything else they have given? Yeah, they have given reserves and surplus. So reserves and surplus we will show 3,20,000. Done. Okay. This is also done. Next. Anything else in the balance sheet they have given? Nothing. Alright. First combo I already told you. What is the first combo? Working capital and current ratio. Okay. So how do you get current ratio? Tell me. Current assets divided by current liability. So let's use that. Current ratio they have given it to be 2.5. How do you get current ratio? Current assets divided by current liability. When you're solving, that means can I say current asset is equal to 2.5 times of current liability? We got this. Substitute this in the next one. What is the next component they get? Net working capital. Net working capital is given to be how much? 4,80,000. How do you get net working capital? Current assets minus current liability. Current asset minus current liability is 480. Now don't write current asset. Current asset is what? 2.5 times of current liability. Substitute. Instead of current asset, write 2.5 times of current liability. Let current liability be as it is. This is equal to 480. Solve. You will get current liability to be 320. Easy now. Yes. If you know current liability, you know current asset also. How much is current assets? 2.5 times of current liability. Multiply, you will get current assets. Then you are good. That's the reason I said this is a good combo. Net working capital and current ratio. Now you have got current assets and current liability. Where will it come? Balance sheet. There's a total. Total we put it in which column? Outer column. What is total current assets? 8 lakh. Show it in the outer column. What is total current liability? 3,20,000. Put it in the outer column. Why I suggest this is check. Total current liability is how much? 320. In that, if 80,000 is bank overdraft, means balance will be other current liability. Alright, that's what? Balancing figure. If you don't do like this, you will never figure out what is just 240. You will be wondering why balance sheet not matching. That is the reason this inner column and outer column approach, you don't have to even think also. If total is 320 and in that 320 bank overdraft is 80 means the other component, the other could be bills payable, creditors, we don't know. That is how much, sir? Obviously it is how much? 2 lakh. calculated or arrived as balancing figure? Sir, balance sheet, can you show balancing figure? Sir, usually they ask you to prepare summarized balance sheet. Summarized balance sheet means to the extent possible. How much ever extent or how much ever data is given, using that you will prepare balance sheet. There's not exact balance sheet which you prepare as per Schedule 3 of Companies Act. No. Okay, now that way it is inner column and outer column. Now you got the importance of inner and outer. Yes, sir. Same thing do for current assets. What is current assets total value? 8 lakh. We'll figure out other components later. This is done. So one combo we have used. Whenever you use, put up one tick so that we will know. This we have used. Next we have used this. Next, these two are good combinations. Let's use this. Current ratio and liquid ratio. Liquid ratio, they can call it as liquidity ratio or liquid ratio or quick ratio, or sometimes they'll also call it as asset test ratio, one and the same. How much is asset test ratio? 1.5. So let's use that. Quick ratio or asset test ratio is 1.5. How do you get quick ratio, sir? Quick ratio divided or quick assets divided by current liability. And how do you get quick assets? Current assets minus stock divided by current liability is equal to 1.5. Current liability value you already found. How much is that? 3,20,000. Current asset value also you already found. How much is that? 8 lakh. So that means using this you can figure out what's closing stock. That's what I said over here. The moment they give you quick ratio, the idea is to click that you will be able to find out closing stock. That's a connection. So using this you solved closing stock to be how much? 3,20,000. Outer column or inner column? Inner column. Total current asset is 8 lakh. In that closing stock is 3,20,000. That's what we found out. If possible, give a working note reference. How? Which working note gets this answer? Done. Yes, people. So this information we've used. Next, they have given fixed asset to proprietary ratio is 0.75. They said fixed asset to proprietary ratio. That means, can I say fixed asset divided by proprietary funds is equal to how much? 0.75. Therefore, fixed asset is what? 0.7 times of proprietary fund. Yes, sir. That is what I've written here. Easy. Till you're good. Now, this you need to pay attention. How do you normally get proprietary funds? Normally, how do you calculate proprietary funds? Equity share capital plus reserves and surplus plus preferential capital. In this problem, equity share capital given? No. Reserves and surplus given? Yes. Preferential capital given? No. That means equity share capital missing. Preferential capital maybe you can assume 0. But equity share capital given a missing. So you can't use that approach. You have to use the opposite route. You have to use the opposite route. What is the opposite route? I'll tell you here. Wait. Right. Here, let's forget this balance sheet. Let's take a small number. This just for our reference, I've made this balance sheet. I will give some random numbers. Equity share capital, reserves and surplus, preferential capital, long-term debt, current liability is this much. Fixed asset, current asset is this much. Okay, sir. Calculate proprietary funds using this. Don't look at the solution. Directly tell. Proprietary funds is how much? These three addition. These three addition. Yes. How much is that? 13 lakh. There is another way to calculate this proprietary fund. First of all, proprietary fund means this. Either you can calculate direct way or there is an indirect way. Indirect way means you can take the total assets. From that you can reduce current liability. From that you can reduce debt. That way also if you do, you will get the same answer. Express this in equation for me. How much it will be? Proprietary fund is equal to fixed assets plus current assets minus current liability minus long-term debt. Yes, sir. Now, 1 second. Why am I using this? You know current assets and current liability is what, sir? Current asset minus current liability is what? Net working capital. That means you can restructure this equation once more. Proprietary fund is equal to fixed asset. This minus this is what? Instead of that, can I call it as NWC? NWC as in net working capital minus what? Long-term. Yes. Why did I do this? Net working capital was given to you in the question. For proprietary fund, we have a substitute. That means this one we will use and calculate. If you do this, also check if I do the calculation. How much is, how do you calculate this? Fixed asset is 12.5. How do you get net working capital? 4 lakh minus 50,000. That's what I've done. Minus long-term debt is how much? 3 lakh. If you calculate, how much are you getting? 13 lakh. Normal route also, how much you got? 13 lakh. That means this is what we're going to apply in this particular problem. So what is another way to calculate proprietary funds now? Fixed assets plus net working capital minus long-term debt. I'll be using this. That's what I've written here. Check. Proprietary fund is given with the formula of fixed asset plus net working capital minus debt. Now proprietary fund is PF as it is. Instead of fixed asset, I know that fixed asset is 0.7 times of proprietary fund. So substitute. Instead of FAD, you will write what? 0.7 times of PF. Correct? Plus net working capital. Is net working capital given in the question? Yes. How much is that? 4,80,000. Debt is not given. If they don't give it, take it as 0. Solve. This is 1 PF. 1 PF minus 0.75 is how much? 0.25. 0.25 PF is 4,80,000. So PF is how much? 4,80,000 divided by 0.25, you will get 19,20,000. This way you will get proprietary funds. So, got it. Any problem? So if you know proprietary funds, can you find out fixed asset? Yes, fixed asset is what? 0.75 times of proprietary funds. So 0.75 if you multiply, you will get fixed asset also, which is how much? 14,40,000. So fixed asset you can tick off. What is the total proprietary funds? 19,20,000. What is the direct way to get proprietary funds? Equity share capital plus reserves and surplus plus preference share capital. Total proprietary fund we got it as 19,20,000. Equity share capital we don't know yet. Reserves and surplus we know. Yes, it's given in the question how much? 3,20,000. Preference share capital any reference? No. I mean take it as 0. Using this we'll get equity share capital how much? 16 lakh. Go back to your balance sheet. Pick equity share capital 16 lakh. Balance sheet total liability side done. If this side total is 22.4 means that side total also should be 22.4. Any other information given or that's all? That's all. Total current assets is 8 lakh. In that if closing stock is 320 means balance will be others. Alright, calculated or arrived as balancing figure. So by doing this inner outer approach you will be able to figure out this other component easily. Otherwise you will struggle normal way. Okay, that way you will finish off this. And don't worry, this is summarized balance sheet. So every information you cannot find out. Whatever information is available, use that and find the component. Other components you find it as balancing figure. These kind of questions you can expect from ratio. Okay, so this is not complex. It is just that they will do all. So I mean, you don't have to remember fancy ratio problems that they are not testing. They are asking you fill in the blanks well questions. So these are little time wasting questions. So you need to practice enough to know that what ratio is connected with what component. If you are the moment you are able to identify that, you will be able to answer these questions faster. Otherwise, you will get it, but you will take a lot of time. I'll give you a minute. If you have anything, you can ask. So far comfortable? So the takeaway of this question is what connection? 3 things, if you want, you can summarize from this question. 1, the moment net working capital is given and current ratio is given, we can use substitute and find out current asset and current liability. The moment they give you current ratio and liquidity ratio, we can easily find out stock, closing stock specifically. Okay, that is one. And then there is another way to learn or calculate proprietary funds. One is a direct route, equity share capital plus reserves and surplus plus preference share capital. Another route, fixed asset plus net working capital minus long-term debt. So those are the takeaway. And one more is a balance sheet presentation. Have an inner column and have an outer column. Total you present it in the outer column. Like total current assets you put it in the outer column. Components ka value you show it in the inner column so that you will be able to figure out the balancing figures. Okay, we'll take 1 or 2 more questions. Following information relates to Temer Limited. Again, this is also a previous year paper. Now it's added in study material also. Debtor velocity. I think you know what this means. What does debtor velocity mean, sir? Holding. A debtor's collection period. We don't hold the debtors. So we usually collect from them, right? So debtor's velocity is nothing but your debtor's collection period. Okay. Creditor's velocity is creditor's payment period because we have to pay the creditor. First, we will read off the data and see what we can figure out. Stock turnover ratio. Tell me the formulas. How do you get stock turnover ratio? CODS divided by average stock if information is available. Otherwise, closing stock. We'll see. GP ratio is given. How much is that? 25%. 25% of what? Sales. Bill receivables, bills payable is given. Do remember that when we calculate debtor velocity and all our debtor's turnover ratio, it is not debtor, it is accounts receivable. So that means that particular accounts receivable will include debtor also, it will include bill receivable also. In this problem, BR and BP both are there. So be a little careful there. GP is given. Oh, awesome. No. Sir, gross profit is given 4 lakh. GP percentage is given. That means easily using this information you can find out sales. If GP is 25% of sales, then COGS will be, or you can find like this also. Sales, you know, GP, you know, can't you find out COGS? You can directly calculate like that, or COGS will be 75% of sales. Because how do you get GP, sir? Sales minus COGS will give you, gross profit. If gross profit is 25% of sales is always 100%, no? If GP is 25% of sales means COGS will be what? 75% of sales. Like that you can calculate, or take sales amount and take GP amount and calculate. So how do you get now COGS if you wanted an amount? You take sales, from that sales you will reduce the gross profit, you will get COGS. Any which way you can do, you can work out in multiple ways. Comfortable? So using these two you can find out sales and as well as you can find out COGS. The moment you know COGS, you can apply in stock turnover ratio and either get average stock or closing stock. That is a connection. All this question you need to practice, because unless you establish the connection, you'll be going on goal. You'll be wasting time. Okay. So the moment you read the question, that connection should get established. That will come only with the practice. Okay. All right. Next, they'll given fixed asset turnover ratio. You know, fixed asset turnover ratio, how do you calculate? Sales divided by fixed assets. You know sales already. That means using this equation, you can find out fixed asset. That is also sorted. They told closing stock of the period is 10,000 above opening stock. That means, have they referred to some opening stock and closing stock? Yes. So if they have given opening stock and closing stock, in COGS always take what? Average stock. Because there is a possibility to calculate average stock. If there is a possibility to calculate average stock, you should always take average stock. If you cannot find average stock, then only you will use closing stock. Here, since they have given some equation about, because to get average, to find out average stock, we need opening stock as well as closing stock. They have given some reference. So use average stock only. Using this reference, we can figure out closing stock. Fine. Now determine what and all. Sales and COGS, straightforward. Debtors, creditors, okay. Closing stock and fixed assets. These are the 5 components you need to find using this ratio. Now don't worry about this rate. If you are not able to figure out few things, don't worry about that. What you know, start with that first. Then as you do, you will get the more information. Now they have given GP and they have given GP percentage. Using this, what we can find? Sales and COGS. So first working note, we'll put after sales. GP amount is given to be 4 lakh. GP percentage is what? 25% of sales. Yes, no? So therefore sales will be what, sir? GP divided by 25% or 0.25. GP amount is 4 lakh. Divided by 25%, if you do, you will get sales value to be 16. Now sales is 16 lakh, GP is 4 lakh, so COGS has to be 12 lakh. Or if GP is 25% of sales, COGS will be 75% of sales. 16 lakh or 75%, if you calculate COGS, you will get it as 12 lakhs. That is the first requirement which we have done. Any doubt? No. Alright. Next, there's no order, you can follow in any order, it's okay. I've put up next as a debtor. Then what they've given in the question? They've given debtors velocity. Velocity means what, sir? Collection period. How much is that given to be? 3 months. Okay. Very straightforward now. Proration work. Do you know sales? Do you know sales? Yes. How much is that?
16 lakhs.
Now the 16 lakh is for 1 day, 1 month or whole year. This 16 lakh. It is for whole year. Meaning it is for how many months? 12 months. Because here the data is given in months. No? So I'll present it in months. If they give it in days, I will take, instead of 12 months, I will take 365. If it is given in weeks, 52 weeks. Like that. Now 16 lakh is the data for how many months? 12 months. Do you give 12 months credit to your debtors, or what is your debtors velocity? 3 months. So for 12 months, if it is 16 lakh, means for 3 months, how much? That's all as a debtor value. Got it up? Because the debtor comes from what? Sales only, no? So debtors comes from credit sales. Have they told cash sale is something in the problem? No. If they don't give information, we will assume that total sales and credit sales are same. So total sale and credit sale is 16 lakh. That is for the whole year. Will you give whole year credit to your debtors or only 3 months? For 3 months, how much is the sale value? That is only weird. How much is that? 4 lakh. Got it. That is what I have expressed. Now tell me this is formula. Let's see how will you calculate. How do you get X? 16 lakh into 3 months divided by 12 months. Express in words. What is the 16 lakh? Sale. Annual credit sales. Here total sales and annual credit sales are same. Multiplied by credit period divided by 12 months. That is what I've written it over here. Done, sir. Any problem? No. You can also calculate in multiple ways. Sir, using debtor turnover ratio, can you calculate debtor velocity? How do you get debtor velocity? 12 divided by DTR. That means if you want to calculate DTR using velocity, can you do it? Debtor velocity is equal to 12 divided by debtor turnover ratio. Therefore, can I say debtor turnover ratio is 12 divided by debtor's velocity? So if you do this, what are you going to get? 12 divided by debtor's velocity is 3. So that means this will be 4. Yes, no. Now, how do you get debtor turnover ratio? What is the formula? Sales divided by average accounts receivable. If average is not there, we will use accounts receivable. Like this also you can work out. What is debtor turnover ratio? 4. What is the sales? 16 lakh. Divided by accounts receivable. Therefore, accounts receivable will be how much? 16 lakh divided by 4, which is 4. This is a little lengthy route, but you will get the any which way the same answer. Or directly you can prorate. Ratio chapter you can solve in multiple ways. Whatever way you are comfortable, you can solve. But solve properly. Okay, now done. No. Any order may you can press. Absolutely no issues. Now 1 minute. This is not debtor. This is what? This is accounts receivable. Accounts receivable means it is a debtor and bill receivable put together. And in this problem, do we have bill receivable? Yes. Bill receivable is how much? 25,000. That means the 4 lakh no is what? 4 lakh is accounts receivable. And how do you get accounts receivable? Debtors plus bill receivable. Accounts receivable is 4 lakh. In that, a bill receivable is 25 means what will be debtor? 3,75,000. Watch out, especially in the problems where they've given BR and BP separately. If it is not given separately, then accounts receivable and debtor will assume it to be same. Meaning BR will or bill receivable will assume to be 0. When they have given, be a little careful. Done, Azaro? Now, I think they asked closing stock also. Can you find out closing stock? Sir, check. Normally, to find out, if they ask you to find out closing stock, they will give you inventory turnover ratio. Inventory turnover ratio also known as stock turnover ratio. How do you get inventory turnover ratio? COGS divided by first preference to denominator first preference to average stock. If average is missing, then closing stock. So tell me, sir, formula. Inventory turnover ratio is given to be 1.5. Tell me what is the formula for this? COGS divided by average stock. Why did they take average in this problem? Because they told closing stock is 10,000 more than opening stock. So there is a reference given to opening and closing. That means we can't find out what? Average stock. So hence in my inventory turnover ratio, I'm taking average stock. COGS, do you know? Yes, we found out COGS. How much is that? 12 lakhs. Average stock, do we know or we have to find? Inventory turnover ratio or stock turnover ratio given in the question to be 1.5. Substitute and you'll get average stock how much? 8 lakh. Any doubt till here? How do you get average stock? Opening stock plus closing stock divided by 2. How much is average stock? 8 lakh. Do you know opening stock? No. Do you know closing stock in value? No. But what did they say? Closing stock is 10,000 above opening stock. So if opening stock is 1 lakh, then closing stock will be 10,000 more than opening stock. Not me telling, question is given. You can take any number. Yes or no? That means let opening stock be OS. Let opening stock be OS. Therefore, closing stock will be what? OS plus 10,000. Instead of OS, you can also make it as X, A, B, whatever variable. I'm just taking it as OS only. If opening stock is OS, means closing stock will be OS plus 10,000 divided by 2. Solve this equation, you will get opening stock how much? 7,95,000. If opening stock is 785, means closing stock will be 10,000 more than that. So it will be 8,05,000. So closing stock also you have solved. Yes, people. Next, what is the requirement? Sales we did, debtors we did, creditors I think we are yet to do, closing stock we did, fixed asset they've asked. Any information they've given about fixed asset? Yeah, they told fixed asset turnover ratio is 4. How do you get fixed asset turnover ratio? Sales divided by fixed asset is equal to 4. Sales we know 16 lakh, fixed asset we don't know. So substitute and you'll get fixed asset to be 4. That's pretty straightforward. Yes. Okay, last requirement they asked you is what's a sundry creditors. Excuse me. Sir, how do you calculate sundry creditors? How did you calculate debtors in this problem? You took sales. Sales was 16 lakh. 16 lakh was for 12 months. Debtors credit period was only 3 months. Like that you prorated. Creditors also can you prorate? What you will take? COGS? No. You will not take COGS. From creditors, what will you do? You will purchase. That means for finding out creditors, we don't need COGS. We need purchases. We need purchases. Yes. From COGS, can you find purchases? Yes. How do you get COGS? Opening stock plus purchases minus closing stock. COGS is given to be 12 lakh. Opening stock and closing stock, just now we found out. So that means purchases is missing. Substituting, you will get purchases how much? 12 lakh 10,000. Like this. Understood? This 12 again proration you do. 12 lakh 10,000 is for 1 day or whole year? It's a purchase that's for whole year, which is how many months? 12 months. What is creditor ka velocity they gave in the question? 2 months. Velocity means creditor's ka credit period or payment period. For 12 months, if purchases is 12 lakh 10,000. For 2 months, how much is it? Prorate and tell me. 2 lakh 12 lakh 10,000 into 2 divided by 12. If you do, you will get 2 lakh 1,667. Is this X creditor or accounts payable? It is accounts payable. Okay, accounts payable means creditor and bills payable put together. So accounts payable, you will get 2 lakh 1,667. How do you get accounts payable? Sundry creditors plus bills payable put together. Check the question. Bills payable, they have given in the question how much? 10,000. So this you know, this you know. Can't you find out creditors? Yes. So by doing this, you will get creditors to be 191,667. Connection. The sooner you establish the connection, the faster you will be able to solve the problem. That will come only with the practice. Here I can just revise, but same question if I ask you to solve it now, you will take some time because you will read, you will forget, you will do it. On the examination day, if you have not practiced, then it will be like you will be going on in circles, what to use, where to use and all that stuff. So as much as possible, I would say FM is one such topic where if you want to gain confidence, you have to solve as many questions as possible. If you don't have time, no issues. Whatever time you have, do the best in that allocated time. Available time rather. Done, sir. Can you do 1 or 2 more? You are in mood for 1 or 2 more, or you want to wind up? Wind up, Paka. Voice is gone, no, Papa. Sir, an asset turnover ratio, if both sales and COGS is given, which one should we choose? Sir, from asset you will generate cost or you will generate sales? Sales. So, priority will be sales. Okay, first priority for asset turnover ratio, whether it is total asset or fixed turnover ratio, first priority to sales. If sales is missing, COGS. If both are given, still choose what? Sales only. Correct. For inventory turnover ratio, you give the priority to the COGS. Thank you, Anjan. I think you have answered that. Great. Someone is saying continue. No. Fine. Okay. 1 or 2 more questions we will do. This question came in May 2024 paper. This particular question. Let's see what we can learn from this question. And don't worry about number of questions we have solved in class. We have solved more than 25-30. Okay. Now I'll not have time to go through all of them. And if I go through all, then we need 4 or 5 hours just for ratio going through. Yeah. Anyways, Theme Limited provides you the following information. Firstly, read the requirement. What are you asking? Interest coverage ratio. How do you get interest coverage ratio? EBIT divided by interest. That means we need to find out EBIT. We also probably have to find out interest. GP ratio. That is okay. GP upon sales into 100. Current assets. Fine. We'll see how to find out current assets. Now, 12.5% debt they have given. All these are subtle information. 12.5% is what? Means what? Interest rate. For interest coverage ratio, we need a interest. Interest is already given. Or you can easily calculate. Now, again, they will not give you interest in the problem. The moment they gave 12.5%, this 12.5% itself is interest. What is the debt value? 45 lakhs. That means how much will be the interest? 45 lakh ka 12.5%, which will be 5 lakh 62,500. So that means one component of your interest coverage ratio you already found. Another component we need to find out is EBIT. Okay. Whenever they ask you to find out EBIT, sales, COGS, PAT, in case you are getting stuck, put up income statement. Put up income statement. There will be the clue. Okay, if you're getting stuck, you can always put it up. Here, though they have not asked income statement, if you put it up, you can kind of maneuver or you can find out a way. So let's see. Debt they have given 45 lakh. Debt to equity ratio they have given is 1.5:1. 1.5:1 means 1.5 divided by 1 is what? 1.5. So it's as good as saying debt divided by equity is what? 1.5. You know debt. That means using this equation, what you can find? Equity. Equity here refers, means what? Net worth or what? Shareholders equity or equity share capital and results in surplus put together. So using these two you can find, or maybe we'll solve up directly. Why do I again read? So debt equity ratio is given as 1.5:1. Debt is 45 lakh. Equity we don't know is equal to 1.5. Solve this and get equity to be 30 lakhs. Easy now. That part is covered. Yes. Okay, moving along. Return on shareholders funds. Return on shareholders funds means this is nothing but your return on equity. Another way of calling return on equity is shareholders funds. Shareholders funds is nothing but equity, no sir. Right? You can call it as return on equity or you can also call it as return on shareholders funds. Tell me, how do you calculate ROE? EBIT along. Each divided by net worth, or you can call it as equity. And equity you already got through above equation. And return on shareholders funds is given to be 54%. So this is 0.54. Each we don't know. Equity just now we got it to be how much? 30 lakhs. That means using this number, what we can find out? Each. Comfortable? That is the next clue. So you can find out each or in all these problems. Now if you just check quickly, nowhere they have mentioned preferential capital. Read. Nowhere they mentioned preferential capital. That means preferential capital is 0. If preference share capital is not there, means preference dividend also not there. That means PAT and each will be same. PAT and each will be same. So that's the reason in my heading I've given. You can either call it as each, or you can call it as net income, or simply you can call it as PAT. How do we find this? Using return on equity. Just now we did, right? So if you calculate return on equity, you'll get PAT. How much is the PAT you will get? 16 lakh by solving this equation. Actually, this is not PAT. Actually, this is what? Each. Since there is no preference dividend, each and PAT will be same. Done now. Work. This number is done. Next, any other information. Whenever we use, we'll tick off. This we have used. This we have debt equity we have used. Return on equity also we have used. Operating ratio, not operating expense. Operating ratio. I just now explained the same using ratio. Operating ratio is how much? 85%. How do you get operating ratio? COGS plus operating expense put together is what? 85% of what? Sales. Therefore, EBIT will be what? 15% of sales. Done. But we don't know EBIT nor we know sales. That means this information right now is helpful or not so much? Not so much. Ratio of operating expense to COGS. So they told operating expense divided by COGS is what, sir? 2 by 6. That means we can substitute operating expense, we can substitute with COGS, or COGS we can substitute with operating expense. We'll see later. Tax rate is given in the question as how much, sir? 25%. Fixed asset they have given it as 39 lakhs. Okay. Current ratio is 1.8:1. So looks like we are not able to proceed now. Whenever I told you stuck, what to do? Income statement. Put it, working note, income statement. Now, did we find anything related to income statement? Yeah, we found out PAT. How much is that? 16,20,000. Got it up. Check the question. Have they given tax rate? 25%. Now, this is the order. Yes. From EBT, if you reduce tax, you're going to get EAT. In this problem, EAT, you can either call it as EAT or you can call it as EASH. One and the same, because there is no preference dividend. Now check, sir. 1 minute, everyone. If EBT is 100, what will be tax? 25%. 100 got 25%, which is 25. So each will be how much? 75. That means, can I say 16,20,000? 16,20,000 represents 75%. After paying tax, what remains? 75%. Okay, but we want before tax. Before tax represents how much? 100%. So prorate. That's what I've written over here. 16,20,000. This number represents 75%. For 100%, how much? how much you're going to get? 21,60,000. Got it now? This is 21.6. This is 16.2. That means what will be the tax amount? These two cut difference, or you can directly calculate 21,60,000 cut 25% you do, you'll get 5,40,000. That means this portion of our section we have done. Okay. Interest was already given to you in the question. We found out also. 45 lakh cut 12.5%. How much is that? 5 lakh 62. Fine. So this you know, interest you know. Can't you find out EBIT? How do you get EBIT? Adding these two. And you wanted EBIT only. Because they said operating ratio is 85% of sales. Therefore, EBIT will be what? 15% of sales. Now you got EBIT means you can also find out sales connection. Okay. So, in next working note I'll put up to find out sales. I'll stop here. Okay, I don't need because they have not asked income statement. No. Sir, if they have not asked income statement, you don't have to solve it fully. Whatever information you need, till then you solve. Rest of it you leave blank. Nobody will deduct marks for it. If you want, you can solve full also, no big deal. Otherwise, you can stop wherever it is required. Done. Now, sales we can find out. How? Since operating ratio is 85% of sales. And how do you get operating ratio? COGS plus operating expense put together is 85% of sales. Therefore, what will be EBIT? 15% of sales. Do you know EBIT? Yeah, just now we figured out. EBIT is how much? 27,22,500. That is your EBIT. Is equal to 15% of sales. Therefore, sales if you solve, you will get 1,81,50,000. If you want to fill income statement, you can go to the sales and write 1,81,50,000. Done, people. Any problem, people? No. Next, what have they asked? Interest coverage ratio. That we can easily solve off now. We need EBIT and we need interest. Both we have now. This is your EBIT and this is your interest. These two are division. If you do, you'll get interest coverage ratio to be how much? 4.84. Next, they ask GP ratio. For GP ratio, we need GP also, we need sales also. That means I have to fill my income statement here. Yes. Now, how to do? You remember one equation they said, what is that? Operating expense to COGS is 2/6. Okay. Yeah, I'm not saying, problem is saying, correct? No. Operating expense is to COGS is 2:6. Basically, operating expense divided by COGS, if you do, you'll get 2/6. Solve. 6 times of operating expense is equal to 2 times of COGS. Therefore, can I say COGS is equal to 6 divided by 2? If you do, you will get 3 times of operating expense. Substitute. Substitute where? Sir, they gave operating ratio. You only told. How do you get operating ratio? COGS plus what? Operating expense is equal to what, sir? 85% of sales. Instead of COGS, substitute. What will you write? Instead of COGS, you will write 3 times operating expense plus operating expense is equal to 85% of sales. Sales we already know. How much is sales? 1,81,50,000. Do this, you will get operating expense. I think I've already done somewhere here. Just check. Operating expense, we will get it to be 38,50,000 or 56,875. Done now. If you know operating expense, you know COGS also. COGS will be 3 times of operating expense, which will be this amount. Now you know sales, you know COGS. Sale minus COGS will give you what? GP. And how do you get GP percentage? GP upon sales into 100. That's a problem. Okay, G. Got it, G. Yes, G. Requirement over, one more. One more. They asked what's current asset. Somebody used their kidney too much in this problem. See, sir, nothing they gave. You tell me, sir. Don't look at the solution. How can we find current? How can we find current assets here? Tell me, sir. If they're given working capital, net working capital, they're given current ratio. That's fine. If they're given working capital and if they're given current ratio, I could have substituted and got current assets. Or at least if they're given current ratio and if they're given liquid ratio, something I could have worked out. Nothing given. Only current ratio is given. How do you get current ratio? Current assets divided by current liabilities. How much? 1.8:1 means this is as good as saying 1.8 divided by 1, which is same as what? 1.8. Therefore, current asset is what? 1.8 times of current liability. That's all we got. Now, how to proceed? How to proceed? They did not give any data. Now, I'll find out capital employed. From that, we can deduct Sir, the way you have to do is, though they have not asked balance sheet, you should visualize your balance sheet. Tell me, how do you get total asset side of balance sheet? What and all is there in asset side? Tell me. Fixed asset plus current assets. Yes, sir. On the total equity and liability side, what and all components will come? Total equity and liability side, if you add, what and all will come? Equity share capital plus reserves and surplus. Okay, plus what? Plus long-term debt plus current liability. Preference share capital they have not given, so I'll take it as 0. If you want, you can write it in the equation. Plus PSC plus long-term debt plus current liability. This is how you get asset side of balance sheet and liability side of balance sheet. And we know asset side total assets and liability side balance sheet will match. Yes, that means these two equations you have to equate. These two you need to equate because balance sheet ka liability side and balance sheet ka asset side are same. That means how will you solve? Fixed asset plus current asset is equal to equity share capital plus reserves and surplus put together, only we call it as equity. PSC not there, so I'll take it as 0. Long-term debt is given in the question to be 45 lakhs. Current liability, let it be as it is. Fixed asset, do you know? Yes. How much is that? 39 lakh. Instead of current asset, I will substitute. What is current assets? 1.8 times of current. Instead of current asset, I will write 1.8 times of current liability. Do you know equity? Yes, first working note only you worked out. Check how much is equity. We don't know breakup. Equity means equity share capital and reserves and surplus. Breakup we don't know, but put together we don't know. How much is that? 30 lakhs. Preference share capital 0. Long-term debt is given to be 45 lakhs. Current liability as it is. Solve this. So this will be what, sir? 75 lakhs so minus 39 lakh. When you solve, I think I have done it. It's okay. Where? Somewhere it should be here. Right? It's not there. Okay, people, you solve. Okay, here it's there. If you solve, you will get current liability to be 45 lakh. And what is current assets? 1.8 times of current liability, which you will get it as 81 lakhs. It is alright if one or two components doesn't click in the examination day. It is alright. Don't worry about all the adjustments. Each, they have given 5 adjustments here. No, each adjustment will carry 2 marks. One adjustment, if you don't do it, out of 10, at least you will score what? 8. That is still 80%. Good enough. Don't freak out, I lost to 2 marks and all and waste your next question. Move on. Give it some time. Later on, if you are able to figure it out, you can come back and finish it. Otherwise, okay. No problem. Done, Aji. Got it, Aji. Pakka, Aji. Enough, Aji. Enough, sir. Leaves are today, sir. Okay, sir. Okay, one last question we will do. Small one. Okay. MTP May 2024 wala, September 2024 wala question came for 5 marks. You are required to calculate, underline the word you. Yeah, you are required to calculate total current assets of Ananya Limited from the given information. Stock turnover ratio they have given. Sir, stock turnover ratio's formula is COGS divided by first priority to denominator, average stock. Average stock missing, closing stock. Sales they have given, fine. GP they have given. GP is 25%. 25% of what? Sales. Current liability is given. Liquidity ratio is given. Okay. Tell me, sir, how will you proceed? And here they told away stock at the end is 30,000 more than stock in the beginning. So that means they have given some reference to opening stock and closing stock. So that means stock turnover ratio you will take closing stock or average stock? Okay. Tell me, sir, how will you just proceed? Tell me that. Just how will you proceed? Solving, I'll show it to you how I've done.
Find out cost of goods.
Find COGS. Fine, great. Sales is given. GP percentage is given. If GP is 25% of sales, then COGS will be 75% of sales. Okay, first let's find that. Correct. COGS is 75% of sales, which you get it as how much? 5,40,000. Then, which ratio uses COGS? Stock turnover ratio. Stock turnover ratio is given as, sometimes they will say 5 times. 5 times is nothing but 5. Sometimes they will say 5:1. 5:1 is also what? 5 divided by 1 is nothing but 5. So various ways in which they present, but everything is any which way same. So stock turnover ratio is given to be 5. So using this you can find out not closing stock but average stock, because they have given a reference to opening stock and closing stock. So stock turnover ratio is 5. Stock turnover ratio ka formula is COGS divided by average stock is equal to 5. COGS just now we found it as 5 lakh 40,000. So when you solve, you'll get average stock to be 1 lakh 8,000. And you know average stock, and how do you get average stock? Opening plus closing divided by 2. Let opening stock be OS. Therefore, closing stock will be what? They told stock at the end. Stock at the end means closing stock is 30,000 more at stock at the beginning. If opening stock is OS means closing stock will be 30,000 more than OS. So solve this, you'll get OS to be how much? 93,000. So therefore, closing stock will be 30,000 more, which is 1,23,000. Then okay. Now, next what we can use? They're given liquidity ratio. How do you get liquidity ratio? Current, this basically liquidity ratio means quick ratio. How do you get quick ratio? You take quick asset divided by current liability is equal to 1.25. How do you get quick assets? Current assets minus closing stock, not average stock. Current asset minus closing stock divided by current liability is 1.25. Current asset we don't know. Closing stock just now we got how much? 1,23,000. Current liability is given in the question to be how much? 2,40,000. Solve this equation and you will get the current assets. That value is 4,23,000. That's all. Okay. Practice. More and more you practice, the sooner you will be able to get it. Okay. Also maybe written some. Maybe I'll just take you through this. Maybe helpful. 1 second. This we wrote. No. Always write current assets and current liability in the inner column of balance sheet. That will help you to figure out balancing figures easily. Accounts receivable means debtors and bill receivable put together. Okay. Basically, debtor turnover ratio and all will not use debtors. They use accounts receivable. That is one. And proprietary fund, we have another way of expression. One is fixed asset plus net working capital minus debt. Okay. Now, I've just given question reference. This and all I did in my regular class. So, it's okay. Don't worry about this. Then, sometimes what will happen is, maybe this one I'll quickly orally discuss with you. This is question number 14 of our class notes. This was also an LDR, but that's okay. Since you don't want to solve it, 2 minutes, I'll tell you what it is. What they will give you is, sometimes they will give you first year balance sheet. They will also give you second year balance sheet. First year ka closing balance will become second year ka opening balance. Year 2 ka balance will become closing balance. They will give you some component. Sometimes they will give you balance sheet or some component ka balance they will give for 2 years. One major thing is like this, they will give equity share capital 10 lakh, 10 lakh, retained earnings 15 lakh, 20 lakh. Looking at this, and they will also give you debt 20 lakh, 20 lakh. Tell me, by looking at this, what you can make out? Looking at these three figures, is there any point that is clicking in your mind? Perfect. Sir, these two are same, but retained earnings from 15 lakh has become 20 lakh. That means what? Current year, no, sir, you have made a profit of 5 lakh rupees. Not PAT. Current year ka profit after all the adjustments. But in this problem, equity dividend, preference dividend and all will not be there. That means current year ka PAT will be directly 5 lakh. Like this, by looking at the number, because retained earnings balance from 15 has become 20, means current year ka profit after all adjustment is 5 lakh. But there will be no equity dividend, no preference dividend. That's as good as saying PAT has increased by, or current year ka PAT is 5 lakh. One hidden adjustment, one question. This is your question number 12. I think ICS question number 14 we had done this. This one we already used. Right? Total assets will be equal to, or total assets component will be equal to total liability side and equity side. We need to substitute. Operating ratio also be used. If operating ratio is 85% of sale, means EBIT will be equal to 15% of sales. And always check if NWC and current ratio is given, means you can substitute one and get current asset and current liability. If current ratio and quick ratio is given, means you can use the substitute and either get closing stock or current asset, current liability as a balancing figure. These are some quick pointers relating to some questions. So I think we are good enough for today. So we'll take up the remaining questions or topics in the tomorrow's session. Thank you so much for your patience. Take care. Bye-bye.
Thank you, sir.